Okay, good morning, everyone, and welcome. My name is Steve Torsa. I'm the CEO and co-founder of Wholesale Investor. Firstly, whilst everyone's coming in, just want to say welcome to Emergence. There's plenty of seats up front, so please just keep walking down. And obviously, there's plenty of sort of room to stand up the back as well. So today, just want to say, obviously, we're very excited to see the amount of sort of people that have come out today, and also just be happy to be back here. It's our first time that we've obviously done a conference in London since, I think it was September, October 2019. And obviously in that last sort of 2.5 years, pretty much everything has changed for a lot of us in the way we think about business, the way we do business, and also the opportunities which we're looking at from an investment perspective. So to kick off with, I'll give a bit of a summary to say that today we're going to have 30 featured companies. We're also going to have 3 different networking sessions. But what's amazing about today is we've attracted incredible people. We've attracted 20 different keynote speakers and panelists to participate in today's session. So everything that we have done for people is we want to give you a glimpse into what comes next. And that's the way we think about things both from a platform perspective and also as far as how we can provide content from an event perspective. As you can see, we've got an incredible range of speakers from different areas, whether it be from government, whether it be from VCs, whether it be from angel networks, or from the family office perspective. But our role that we see it is to enable, right? Whether it be to enable opportunities with the companies that are presenting, or whether it be to enable opportunities in the way in which you're thinking about your own investment thesis. The risk factors, this is all fairly well known to us, right? Because whenever you're looking at opportunity, you cannot disregard the risk factors. Right now, there's obviously several which are taking place, whether it be from conflict, probably the most politest way I can say that, inflation, which we're seeing both across the UK, Australia, and the US, interest rates, and then obviously the issues related to global supply chain. All those have a lot of knock-on effects in how we're actually thinking about our own investment thesis. For some people taking a shorter-term approach, that obviously becomes a lot more prominent. Taking a 5 to 10-year approach, then you can often have a different perspective. From our perspective, this is what we're thinking about. We're thinking about the exponential era of innovation. We want to showcase, we want to introduce you to, the different elements that we see that are accelerating this transformation. From our perspective, we believe the wealth generated in the next 5 to 10 years can significantly replace the wealth generated over the last 20 years because of the pace at which everything is moving from software, AI, life science, deep tech, advanced manufacturing, and then of course, Web 3.0. That all these areas are transforming the way in which we do business and also, as I mentioned before, how we're thinking about our own portfolios. Now, the way today is designed, whilst we've got a range of different sessions from keynotes and also panel sessions, obviously we're going to be featuring 30 companies throughout today. Now, obviously from our perspective, we're super happy to have the companies. These founders behind these companies work day and night to build their businesses. Some are earlier stage, some are later stage, and to us, that's what makes Wholesale Investor work, right? And just to give you some context about who Wholesale Investor is, we've been doing this for 13 years. We started out as a magazine. Then we moved to this sort of format where we generate interest online and then work in this sort of event capacity. Now we've obviously built our own platform, Crisp, which I'll take you through in a quick second. But throughout the day, if there's a presentation which you really liked, go and meet the founder at their actual booth, right? You can see all their booths outside when you actually walk in. Take the time to go around to those booths. The thing I always love to highlight at these events is that whilst you may be one person, what we do know about this space is every single one of you has anywhere between 5, 10, 15 people in your network that are also active in this space as well. So we proactively ask you to think if an opportunity may not be relevant for you, is there someone in your network that it could be relevant for? And the 3 bases of connection that we like to look at today is one is the obvious one from the investment side, strategic partnerships and commercial opportunities. And every single function we do, or every single conference or online, we see this take place quite frequently, right? So now when you go connect with the CEOs, also you've got the opportunity to connect with them inside Umbrella, right, which is the software app for today. So you would have seen a bunch of QR codes to register on that. Some of the founders may have requested meetings with you as part of that session. Make sure you have a catch up with them. Typically, the meetings are around about sort of 10 to 15 minutes. If you need extra room, just let one of our team know. We've got some space, additional space, we can facilitate meetings with. Right, but really, this whole event is really about engagement and the creation of opportunity, which is the core vision of Wholesale Investor. Now, for me, what makes Emergence different? The Emergence difference is the power of one conversation. You know, from our perspective, time and time again, we see this. If you were to actually take a mind map of this entire room and think about the conversations, the networks, the contacts you have with people in here, and where that leads over a 1, 2, 3, 5-year process, it becomes interesting about how the trajectory of an investment opportunity or the trajectory of a business can change simply by one conversation. Everything we do today will be to try and facilitate and empower and enable that one conversation. These type of events do not happen without our sponsors. So I want to say a big thank you to Nudge Group, Steve Legals, International Investment Services, and also the Angel Investment School as our partners. I said without them, it could have been Nudge Group have been phenomenal to us. For all of you that have got investee companies, that are looking to attract business development talent, they've been incredible at assisting us with that. And Steve Legals is probably one of the most incredible online legal platforms that I've ever come across, and I think has been the core. It sits at one of those core utilities of the UK startup ecosystem. Right? Sounds like a simple area, but the areas they cover for businesses setting up or businesses going through capital raises or businesses hiring teams, they make their lives a lot easier. So big thank you to them for their participation. So the formalities, the boring stuff, as I'll say, there's bathrooms downstairs. We will have 3 breaks throughout today. The hardest thing for an event organizer is the movement between different rooms, right? So when we have breaks and we have lunch and so forth, at the end of those breaks, you don't have a bell to ring, so you'll hear our team over the microphone and also ushering people back in. Please come back into the presentation room for that next session. As I said, we want to do our best to make sure every founder that's presenting today gets their opportunity to be heard and to be and to connect with you during the actual session. So, and of course, the other big formality. Funny, as an event organizer, you always worry about it. Obviously, we're very well attended today, which is great to see. We will have a drinks and networking at the end of tonight as well, which tends to be the easiest session to get people to. So make sure you join us for that session at the end of tonight, where we all sort of get to relax, chill, and have a few drinks and sort of connect properly. One of the things I mentioned is that over the last 3 years, we've been passionately building our platform, Chris, and it's the capital raising, intelligent investment secondary platform. It is, from our perspective, we see as AI-driven capital raising and venture investment. All the companies that are participating today sit within inside Chris. Under the filter, there's a specific Emergence 2022 UK filter that has all the companies featured. You can see which deals are trending, which deals are the most viewed. You can filter it by different sectors which interest you the most. You can put in what if you like renewable companies, you can search by that. AI-driven companies, you can search by that, etc. It's all inside the actual platform. As I mentioned, there's a whole bunch of matchmaking to be done inside Brella. For those that are on the actual live stream at the moment, then I recommend you use the Brella platform to connect with the companies. Just know that you may be having the conversations with the companies because they'll be in conversations today. Those conversations, that's where the camera is if you're wondering why I'm looking there. Those conversations will take place over the next few days. So, and also just so you know, ideally we'd love to have the full screen for the actual presentation, but with the technical side, we had to facilitate the live stream in the corner as well. So just please be understanding of that. And aside from that, enjoy the experience. As I said, one thing is when you're organizing this type of thing, you really want everyone to walk away with the outcome thereafter. For you, whether it's looking for the right opportunity for your investment portfolio or looking for a company which you can add value to strategically or personally by your networks or by your own experience, either way, we want to facilitate that. Throughout the day, you'll see the Wholesale Investor team. If you need any introductions from us or if you'd like to meet any companies, we are here to serve you and here to assist in that process. So apart from that, welcome to Emergence 2022. Now I'm going to do a quick introduction to Paul Webster, who's the New South Wales Trade and Investment Commissioner. I've got to get his title right. I've known Paul for so long and he's got a new title, and I said, I'm going to get his title right. New South Wales Trade and Investment Commissioner for UK and Europe Investment. I think the easiest way to describe Paul is for the last few years, he's been the one that's really been helping us guide our decisions on what we do in the UK and understanding what's happening in the marketplace. Obviously, there's a lot of data out there, but when there's someone that's as well connected as Paul and it's someone that's so close to what's actually happening in the ecosystem and that understands what's happening at a government and at a private level, he's someone that's made a big difference to us personally, but also provides a lot of insight when he keynotes at our event. So please welcome Mr. Paul Webster.
You've got me now? Great. It's wonderful to be back. We have missed Emergence. It's been away for 2 years. Can I just get a show of hands? Who's travelled in from not the UK? Hands up. Welcome. We've missed you. The title of this talk is Moats Are Lame. How many people remember this quote? That's good. So firstly, Investment New South Wales acknowledges the Aboriginal and Torres Strait Islander peoples are the first peoples and traditional custodians of Australia and recognise the continued custodianship of country, land, seas and skies. We acknowledge the diversity of First Nations, cultures, histories and people, recognise their enduring connection to our state, and we pay our respects to Elders past, present and emerging. And I extend this respect to other Indigenous people who may be present today. So why me? Yes, a government official. Ronald Reagan said the most terrifying words for any business person is, I'm from the government and I'm here to help. So you may be wondering, why am I here? Ex-banker, management consultant. I've been fortunate enough to study in Germany, UK and USA. I've been in the UK now for 8.5 years. Founded 3 businesses, 2 didn't make it, 1 did, and still exists without me today. 16 investments, 5 doing all right. Pretty happy. Let's see where they go. 1 did the prayers, it's gone. And we're watching another 10. I've supported over 3,500 companies on their international ambition, people and businesses and intellectual property and capital to prosper around, predominantly through the Australia-UK corridor, but globally. And it's what I'm hoping to share, just a few insights that I can do with you today. I will be around for morning tea and again later this afternoon for drinks. So I'm always happy to have a conversation and provide any support I can. But the main part of Emergence is you're here to really benefit from each other, the network. Nothing works without people, and that's going to be one of the core themes of my talk today. I'm going to go through the past, the present, the future, because we haven't seen you for 2 years. So I thought we'd go back to a quick snapshot. Moats are lame. Elon Musk, 2018. There's a comment back to Warren Buffett using the traditional, competitive, sustainable advantage, saying you must build a moat around traditional industry. Elon tweeted, as he does, moats are lame. And then led to a Buffett-Musk debate that went on for quite a while. What we've seen in that time, COVID, we all closed, the travel, the industry, the retail. How many brands did we lose? We've seen some recovery, but not all recoveries are equal. If you speak to the hospitality section, they surge back. But go and speak to a retailer today, and they're hurting very much. Margin pressure, staff pressure, they're hurting across. FinTech, construction, fantastic. But now they've got to buy land and materials, and that's difficult. Unemployment, it showed the government model worked. Don't give money to banks, give money to people. It's a change from the 2008 model. So far, so good. Treasury coffers around the world are far more resilient than they expected. They have capital to deploy. But anyone brave enough to say COVID's over? We're living with it. But all we need is one strain as deadly, but as transmissible as Omicron, and we're going right back to square one. So we're not over it, but the model has worked. Now, we also had this thing that happened. For those in the UK, it still remains sensitive, topical. But how many of you would have predicted post-COVID that our EU exports actually return to a higher level? And here's a weird statistical economic. I mean, I love economists. They make up any data point they like. But actually, Brexit is GDP positive. Because of the way you do economic statistics, the way you add the exports in, it's actually benefited the UK in measuring GDP. How many people would have thought that? It's just a bit of a statistical anomaly, but it's true. What we did see was interesting is developed market employment in manufacturing. We can see steps, recession, step, declining, And then 2009, after the GFC, well, originally GFC in 2008, believe it or not, for those who were geeks in the credit analyst world like myself, GFC stood for Global Food Crisis in 2007. By 2008, it turned into global financial crisis. But what we've seen is a turn in manufacturing. And again, a dip at a recession, but again, an immediate recovery to the trend. We're seeing an increase. We're seeing a re-establishment of manufacturing in developed economies. Reshoring is a big one. Labour costs and shortages. We've seen wage inflation in the developed markets soar, so that what was quite a substantive advantage in the 80s and 90s was lost. Sustainability and ever-increasing CSR pressures on businesses for full, complete supply chain evaluation and audit means not abusing, that's probably the wrong word, taking advantage of less developed markets that allow standards that none of the same of you expect around the world isn't going to be tolerated anymore. And those four trends together are shifting the dial. So in that time, it brings us quickly to the present. Now, tech's been great. You're a rock star if you pick tech. So for the last 5 years, if you had invested, you would have made a total annual return 30%. Pretty good, not bad. No one's going to complain if you're their fund manager. It's more than double the industry average at 13. Of 33 industries, they average 13, tech average 30. However, look at the bottom stat. 60% of that came through COVID. So was it really outperforming or was it just fortunate? A great mentor of mine had said, there are always tailwinds and headwinds in business. COVID just magnified them. And I believe that to be true. Now, what happens in the present? It hasn't changed. London is still the heart of venture capital in Europe. It comes from around the world as the heart of global asset management. So there's an analogy that asset management in New York is 80% domestic, 20% international. Asset management in the UK, and particularly London, is 80% international, 20% domestic. And that's why international business comes here to receive capital to prosper globally with a global outlook from the very beginning. But what we see in all these lovely big numbers is actually we're seeing more bigger deals. It's still tough to get started. And this is where Wholesale Investor and Chris really will help you. Because one of the things I'm going to show you statistically is getting started is the most important thing. This part, where all the press releases on Deal Room, all the ones you're going to see on PitchBook, they're the ones that have made it through to B, C, etc. And that's where you may wish to get to, but don't get lost in, they may make up a huge proportion of the value, but they don't represent the volume. Why is the UK so good? Well, there's so much on offer. It's attractive for businesses to grow. It's attractive for investors to invest here. What does that mean to those who are international businesses? You pretty much have to set up a UK company. Why? Because your investors are going to want 50 to 30% of their investment back in their pocket. For those who are new, I suspect many of you will know the phrase EIS and Seed Enterprise Investment Scheme. My wife did give me a double glaze over yesterday when I spoke in jargon. I was like, what are you talking about? I was like, sorry, work kicking in. Enterprise Investment Scheme, 30% back to the investor, minimal capital gains tax. Seed Enterprise Investment Scheme, 50% to the investor. So think of what that does to their returns. Firstly, it de-risks it, but the multiples on any return are going to be substantial. You look at the corporate tax, still exceptionally low, the lowest in the G20. Patent box halves your corporate tax rate. A tax-effective deduction that equates to cutting corporate tax in half. Fantastic. If you create intellectual property here in the UK, you have supply of talent, supply of property, you can grow your business. So touching on what they do, EIS, SEIS, the number one thing for international shareholders is what the UK doesn't have. No withholding tax on dividends is exceptionally attractive to international investors. The corporate tax rate is on the creep up, so that is slightly out of date. When we look at the R&D, continuing to invest to grow, there's two things very attractive for investors right now. Firstly, if you are profitable, you'll get 25% back after tax. If you're not profitable, a third of your investment from the business into R&D, you'll get back at the end of the financial year in cash. Larger companies still benefit from it. The super deduction. Right now, till March next year, so you've got a full 12 months on this, you'll get 130% super deduction. So that means you're effectively, after tax, getting 25% back from HMRC on any investment you make. So investing in a business now, one, you get 30% of it back. Two, of the investment made by the business in R&D and in capital equipment, you're getting 25 to 33% back into the business. You're getting a wonderful return on any investment you put into a growing business. And it's not my opinion, it's generally considered one of the strengths of the UK rebound being so strong post-COVID was very much linked to these incentives brought in by the British government. London continues to soar. It's still, you do get to a point where you start calling a startup a scale up when it has market values at $1 billion. For those from Australia, that's a pretty well capitalized business. There are a point where we start using the phrase because they once were 4 years ago, we probably need to stop using it. But you look at how far it's grown and how quickly it continues to soar. But if you read the press, life sciences companies who cleaned up the fundraising last year are now struggling to close out a deal. They're not able to finish their funding. Inflation is roaring back. I thought I was quite clever when I wrote an article in October saying, is your business prepared for 1.5% central bank rates and a 5% cost inflation across your cost base? Probably should have doubled that. Thought it was clever in October, and now I'm like, damn, wrong by half. Interest rates continue to move, but we're seeing the impact on energy. Government regulation. Now, you look at buy now, pay later. Now that the top four are oligopolies, what do they want? A moat. They're now happy to be regulated. If you had asked them 3 or 4 years ago if they wanted to be regulated, no way. But now that I'm big and I've got a market dominating position, bring in regulation, but bring in privacy, bring in control. And this ever increasing debate, who owns the data, the individual, the state, or the corporate? That conversation will only increase. Supply chain issues. We don't have to look just to Eastern Europe to understand that. Shanghai, half of it was closed down overnight. The other half is expected to close by Thursday this week. 25 million people into lockdown in one of the world's most prosperous cities. It will have an impact. Skill shortage. This trend has not disappeared in 30 years. We have an unskilled surplus and a highly skilled shortage. That's only going one way. So when you talk to me about EdTech, it's a given. People need to be educated. People need to move through prosperity. I'm not going to talk about EdTech. It's hardwired into our society. One of the things that this is a great man, Mohammed El-Aaron. He's an advisor to the World Economic Forum. He's now the Queen's University president at Cambridge. Do follow him on LinkedIn. He always says what he thinks. He will be berated by world leaders sometimes, but he is very rarely incorrect. He is normally directionally correct, and he is a great thought-provoker. I encourage you to follow him. You look at these, I mean, fertilizer has doubled. I mean, we said tech was pretty good. How many of you 12 months ago went long on raw commodity? Anyone? Yeah, and we're here talking about tech being amazing. You know, if you bought a farm last year, you're a god. So in all of that, sometimes we forget the basics. The Goodman Group and Macquarie Group are very good at this. If people consume it or people require it, invest in it. This issue will not go away. It continues to sleep and become more and more of an issue. And we begin to see what's being unleashed. Now, I want to call out 2 stats here, 2016 and 2021. Because when I look to the future, I'm going to show you back to the 6.6 figure or near one. It is growing rapidly. It is embedded into our supply chains. It is part of getting into a procurement exercise. Expect to be asked about your anti-slavery. Expect to be asked about your carbon monitoring. Expect to be asked about your supply chain management. And all of these elements used to be quite cumbersome. 4 or 5 years ago, consultants were setting up how to help your business do your climate monitoring. We now have someone in our office in New South Wales, Net Nada. He does it for £300 a month, and in about 5 minutes, takes all the data readings he needs. Those consultants are already out of date. That's the speed of tech. We continue to see Europe with, I don't think it would surprise many, might be confounding to some, particularly from Africa and Latin America, that Europe has a very strong social responsibility company. When you look at what they've been doing, they were the leaders. You look at the Nordics, making all of their investment councils and not selling shares, actually being activist investors. And I believe that's the right thing to do, change from the inside. We're seeing fantastic changes into the carbon economy throughout, in every part of the supply chain. I mean, the concrete construction is only going to continue to increase. But this is where I want to zoom in on. Web 3.0 or globalization 4.0. How many people, just throw out numbers, how many factories do you think are truly autonomous, fully designed, and are of an age where it's fully integrated with digital capability? That's high. 90 factories have met the World Economic Forum standard of being at this level. 90, I mean, this hats off for having the courage to speak up. The rest of you, 90 factories have met the World Economic Forum of being this. This talk came out in 2016. 6 years later, we've got 90 factories, and you can guess how big the companies are who have created those 90. Global corporate. Remember I said, remember that 6.6 billion funding? Manufacturing automation is at its birth. I know we think we see it and it's embedded. It's not even close. It's just beginning. Globalization 4.0 is only beginning its journey. And this is a part that everything we consume, everything we drive, everything that moves us around, we haven't even started really integrating into mass scale yet. So, the future. Moats are lame. This is a bit broader of the conversation and we're touching on. Elon Musk. So, moats are important, as I touched on, the Warren Buffett element. You must build a moat around your industry, and we're seeing that in the buy now, pay later. They are welcoming regulation to build a moat around their industry. So Elon Musk says what matters is the pace of innovation. The Darwinism approach. You must innovate, thrive, survive, adapt. Professor Rita McGrath, the thought of sustainable competitive advantage leads you effectively to a death sentence. Nothing is permanent. You must be constantly changed. And then from the World Economic Forum, those willing to embrace disruption and change the new opportunities. So when we look at Amazon, they already break their own business model. They've got stuff in development. For those who are traveling to London, go check out the Amazon grocery store. You can definitely work out the laggards from the tech leaders, because you'll see the people going, you cannot enter the store if you haven't downloaded the app, and you'll see the laggards walk on, and you'll see the tech young ones downloading an app, walking in to do cashless and counterless shopping. But do have a look. The three things to survive in the future: integrate, scale, and speed. How are you going to work? Most of you, I assume, if you're here with Wholesale Investor, you're scaling, you're growing. There'll be a few purchasers here for you who are looking to innovate and looking and doing the right things, trying to find that global innovation. So learnings from Accenture. Systems must work with each other. We're great at doing modules, but getting the platform right is critical. I know in Australia, I was fortunate enough to work at Commonwealth Bank, but when you look at Sabadell, the Spanish bank who bought Lloyds Bank, this was absolutely one of their innovations. The thin platform, they could run Lloyds Bank technology when they bought TSB branches better than anyone else. They were agile, they were speed, and by operating on a singular platform that connected across all of Sabadell, they were able to bring products to life in half the time of their competitors. When CEOs delegate too much and the systems start running independently, your pilots are at risk. Your success in that business might be jeopardized. So the IT spending forecast, you can have a look. This comes from Boston Consulting Group. We see good growth in tech. Generally, financial services will continue to thrive. Travel and tourism is a little bit of, it looks excessively high as a return because it was so effectively shut down. It will, and that industry, the ones who are well back, have the ability to regrow and reinvest. But unfortunately, we saw a lot of our travel industry peers have to take on new careers in that time. But you can see where we're looking. Now, I touched on the importance of strategy, and still BCG report, when they asked directors and executives, what was the number one driver of IT investment? It's still strategy. The strategy will have subsectors to it. Greater quality, customer satisfaction, cost reduction, all of those elements are still true. But the strategic advantage is still the number one driver. And I believe that conversation gets lost in the noise of tech. We need to come back to how are we going to help this company and ourselves be agile to an agility in the sense, not agile and get a team together and solve a project, actually be agile, adapt and move. Now, what we're seeing, again, 3D printing, it's happening, but it's not happening on scale. We're seeing automation and robots, fantastic. We've seen Boston Robotics do some incredible things, but they're still world leaders in R&D. They're still not yet where they need to be. There's a chart I can't show you today, but when we look at the saturation of robots in manufacturing in Japan and South Korea, it would suggest we have something like a 5 to 10-fold increase in robotics as a minimum. If they are at saturation, measured by robots per 100,000 employees, then Japan and South Korea are so far ahead that we have at least a 10-fold increase here in the UK and Australia on what we would need to do. So what's this going to mean? We're going to see a lot of this work happening. These are the globalization 4.0 factories. 80% of manufacturers are now actively investing in these segments. That is double the amount of 2020. Is exceptionally high growth rate. 16% return on cost savings already identified, and the growth of the sector forecast to at least 2030 and 2035 is 10% CAGR. Now, if I go back to those tech returns that we touched on earlier, that was 12% CAGR. This is a trend that's going to continue to go through. However, it's great that you've got the innovation. If you can't scale and do it fast, you're of no use. So can you scale? Those who are proven to scale are repeat offenders. They're always successful, more often than not. Because they're better at scaling with their projects, they're more efficient in project management, they get twice as many projects through their innovation pipeline. When was the last time you asked one of your clients, how many pilots do you get through? What's your success rate of scaling innovation into your whole organization? Are you just happy to get that pilot on the shelf? Sometimes you as the entrepreneur need to lead the conversation and start changing the analytics at which you look for the right business partner. Because you need to be requiring them to be successful, because if they're not, you'll get stuck in a scaling pilot that will never succeed, it will fail, and you won't get your cross-sell. So interrogate your customers and investors so see how they can help you. We know the revenue growth is going to be, for successful innovation, it will always generate more revenue, and cost savings. Cost savings and risk management are the two easiest sell points to any organization. The revenue is a little bit harder. Scaling also means having a global mindset. And for most of the people in the UK, that means you need to think about the other 99% of the world. Because if you don't, you've accidentally made a decision to limit your business case to 1% of the world. The one thing all of our clients have in common, who have really prospered internationally and scaled, is they remove someone from core business momentum and put them 100% full-time on internationalization. They were removed from this day-to-day elements of running a business and focused purely on global growth. So to go global, we do it for many reasons. They're all well documented. More often than not, it's market expansion, access to investment, why you're all here. Diversification, resilience. We are seeing talent as well. The innovation for larger companies, they go, let's look at Meta. If you're good, Alphabet, they take you out and join their ecosystem. Why is the UK? Well, it's large, fifth largest economy, 67.2 million people and climbing. Third for cybersecurity. I'm not going to call out cybersecurity. I think we can all guess where that's going as a trend. I will call out the Australia-US-UK alliance. Anything in cybersecurity. For the first time in my working life, the distance with Australia has become a massive asset because it gives you true independence and security. You have a complete separate operating model that gives you supply chain, that gives you security, confidence in a market that you know you can work with. Other things that you need to think about when you go global. Is it right? Can we do it? Some of you, bluntly, you're too early. It's not right yet. Get your product ready. Get your team ready. But for many of you, you've got the investor, you've got the backup, you've got the detailed business plan. Start asking these questions. So we know London is doing well, but we've seen more funds coming to London. Something happened in 2017 here in the UK that hadn't happened before. It's created a shift to the fund management industry, which is already very active. Auto-enrollment. Now every single Brit has to save a pension like the Canadians, the Aussies, the Kiwis. All of a sudden, they've gone from 5th to 4th on the global asset management rankings on pension, and those funds need to be deployed. And we're only going to see more and more funds get created and get deployed. So for those looking for investment, there is no shortage of money. It's about being successful. But for those I touched on earlier about getting first, look at the volume of deals and the little bit at the bottom. That's the first time. Getting your first deal unleashes the other 80, 90%. Don't be too proud to get your first deal. Sometimes it does require pragmatic negotiation, that getting started is more important than holding out for the optimal deal that you thought you might get, because you risk the other 80%. So do think about that. For those you come international, you need cash or contracts. That's either capital, contract sales. Otherwise, there's innovation funding. There's plenty here in the UK. Steve, I'm sure, will share the slides later, so I'll flick through these. You will find plenty of opportunities in life sciences and other UK innovation funding parts. When I say be prepared to scale, I'm just going to give a concept of Australia's big 5 banks and compare them to Britain's. So you might be big down under, or Canada, or somewhere else in the world. Keep it in perspective. This is their second banks. So when you say you scale in your home market, put it in context of the bigger market. When you think of America as a very large, fragmented market, the UK is one of the largest singular markets with very strong oligopolies like Australia and Canada. So do think about what scaling means and how well you can adapt. And again, going back to, you could be in a third supplier bank here and still be doing exceptionally well if you're in fintech. So again, don't be too proud. Any start's a great place. Now, I talked about UK is great for Europe. Australia is great for Asia Pacific and Indo-Pacific. Between them, you can cover something like 70% of the world's economy in free trade agreements. How many of you think that Australia and New Zealand combined is the 10th largest economy in the world? Now look at our cyber security. It's growing threefold. And our fintech economy is one of the most rapidly maturing in the world. New South Wales is a great capital. We're here to support you. And more names that you start to become familiar with. The buy now, pay later scheme has basically blossomed in Australia and taught the rest of the world, with fast followers coming across. From that, we have funding to support you, which I touched on. We also have world-leading R&D with Data 61 and the Commonwealth Science Industry Research Office. So, and, you know, you get to go to work on a ferry and look at that. So it's pretty good. So that's why you go global. Now, speed. How can you do it? What scares me the most is quantum computing. And it scares me in a wonderful way. But when we think how long it takes to break your password on a standard computer, quantum's not even 5 minutes. In the last 6 months, I was supporting 3 American companies to set up here in the UK. 150 to 300 jobs. The commercialization of quantum is much closer than you think. 2 years ago, I would have been lucky to do 10, 20 people on an R&D project. We now have clusters in San Francisco, Berlin, Paris, Oxford, Cambridge, Bristol, Sydney. So when you start looking at how fast things are going to get, they're going to get really fast. And unfortunately, the first one is going to get a much greater advantage. So think of those Tour de France guys going up the big mountain. They get that downhill slope, and that 100 meters turns into 1 kilometer. When they hit the top of those Pyrenees peaks, that's what we're talking about. The tailwind shifts, the spinnakers are up. The leaders and this comes back to the interrogation, how many led around a platform when you're talking to your clients? Or are they still talking about my business unit, my problem? Who are you speaking to? The lighthouse, that's what the World Economic Factory called the lighthouse factories, the 90 lighthouse factories. Are they cross-functional? How many of you think the MBA is out of date? Come on. How many of your team can talk cross-functionally across an entire organization? I think the MBA is back. I think you need good general managers. Without general managers who can join the dot, when you pull this string, that one rattles. That knowledge is going to be incredibly important, because with the platform cutting across the organization, without knowing truly how the organization operates, it's going to get lost in the noise. Do invest in your middle management. Don't think it's heavyweight. Make sure they understand left and right. And this is why teamwork matters, and that's why all the digital collaboration elements are so important. Who is going to manage the control and make sure on the risk management, nothing is changing that's going to impact someone else across the organization? For Barclays, it's always, yes, we're looking to find ideas, but they must fit into the Barclays ecosystem. So, 5 things I would like you all to take away from today. Globalization is only just emerging. We've started the party. There's a lot of support if you know where to look, and your first investments are absolutely critical. Look for partners with proven success in scaling pilots. Interrogate your partners and customers. And most of all, people and your partners are absolutely fundamental in funding and scaling. So whilst we have all these lovely robotics, don't underestimate the importance of your people. Thank you.
Thank you so much, Paul. I'm Megan from the Sydney office. It's very good to be back on home soil after all this time. Thank you for joining us today. I'm going to be taking you through the presentations. So first of all, we have one of Wholesale Investors' key partners and sponsors, the Nudge Group. Steve Grace will be presenting on video, but here to represent them, we have Helena Terminer and Chloe Shields.
Morning, everyone. Morning, everyone. So this is a unique experience for me today because I've never given a speech as a sponsor. And when they asked me to do that, and we don't sponsor a lot of things, when they asked me to do that, I really didn't know what I was going to talk about. So I sort of sat around, spoke to the team, we threw around a whole bunch of ideas, and then I just came to the conclusion I wasn't going to talk at all. I was like, nope, I'm not talking. I don't want to talk. We'll just be the sponsor and no one needs to hear from me. And the reason I said that, and obviously I changed my mind, but the reason I said that is, let me give you an example. I don't know how many people here like tennis. I'm a big tennis fan. I love going to tennis tournaments. I love spending 2 weeks watching people battle it out all the way coming to the final, right? And you get to this final and you sit there for 2-3 hours and you see, you know, doubles, singles, women's, whatever it is, you see them battle it out through all the way to the end, and someone's a winner and someone's a loser. And it's exhilarating and your heart's racing and it's sensational. And then it comes to the presentation and you're sitting there and, you know, sort of come down and you want to hear from the players. You know, you've come to watch a tennis match, you've seen them play, you want to hear what they've got to say. And then the first person who comes up on the mic, a bit like today, is, I don't know if you watched the Australian Open, but it's always the Kia guy. Now, I don't know about you, I don't go to tennis tournaments to buy a car, ever. I don't mind Kias, there's nothing wrong with Kias, but do I want to hear the guy from Kia come up and tell me how much he loves tennis and how much, you know, he's invested in the tournament and how wonderful he thinks it is that they get the opportunity to sponsor? No, I really don't. I just want him to get off. I don't want to buy a car and I want to hear from the players, right? So I'm sitting here thinking, well, who the hell is going to want me to come up on stage and tell them about any of the companies that are behind me on that slide? Probably no one. So I'm not going to do it. And then as we got closer to the event, I thought a bit more and I thought, well, there's some things I think that are quite important that I wouldn't mind saying. So maybe I will go and talk. And they've only given me 10 minutes and I'm down at 8 according to the screen here anyway. So I'm going to bore anyone. So I'm not going to talk about any of the companies that are behind me. I'm not going to talk about what we do. I'm not going to try and sell you any of our services because it's not relevant. What I am going to do is talk about an area that my team and I are incredibly passionate about, which is pre-seed to Series A. Now, if you look out right now across the world, the startup and scale-up ecosystem is the healthiest it's ever been. It's super exciting, right? It's gone more mainstream. There's a lot more founders. There's founders who would never have been founders if we hadn't have had pandemics. And there's huge amounts of innovation going on and completely new technologies. It's super exciting, right?
And that's all supported right now by this massive flow of capital that's coming in, which is probably, I don't think it's ever happened before, particularly in this country. And our ecosystems have grown to a healthier and larger space than you've ever seen, which I'm loving. And I think everyone here is loving, and that's, part of the reason of today. However, if you, I don't know how many people here subscribe to things like Smart Company or Startup Daily, but I'm sure a lot of you read the AFR as well. If you look at the headlines out there, and there's quite a few, they're very focused on Zilla and Employment Hero and the new unicorn and a $10 million or $180 million raise. And there's absolutely nothing wrong with that, right? It's fantastic and it's amazing. And look, congratulations to all those companies who've achieved insane things in the last 12 months. But that's all they talk about. They talk about the big deals and they talk about these companies who they've already established themselves. They've already had a certain level of success. Their chances of survival and continued success are huge. So that's great, and we should celebrate that. But no one's talking about the next level down, which is a lot of what this event today is about and why we decided to sponsor it. And I think we've got this scenario where we've got mass capital coming in. That's not going to last forever. Jason touched on it earlier. There's going to be a turn in the market. And if we want this ecosystem, which I know I do, to continue to grow and to continue to flourish and more innovation and Australia to become more of a leader in this stuff, then we need to start looking at the top of the funnel. We need to start looking at the pre-seeds. We need to start looking at the seeds, because when you get to Series A, although your future is by no means guaranteed, your chances of success are relatively high. You've got a product, you've got a market, you've got revenue, you're on the right route. Before that, you've got a really, really difficult journey ahead. And I'm very lucky in that my role has changed enormously in the last 12 months. And I probably now meet 5 to 10 new founders every week, which is insane, right? And it's possibly the most enjoyable thing I've ever done, because I get to meet people who are passionate, who have new ideas, who are driving towards a goal, right? And I get to just sit there and talk to them with no real agenda, which is a very cool thing to do. And there's obviously some continuous sort of things that pop up. So we talk usually about challenges, and sometimes it's growing their brand, sometimes it's putting together an employee share option plan. There's numerous things. But the one thing that always comes up, always without fail, is funding. How am I going to get my funding? Now, a lot of founders that have come into the market are not necessarily fully immersed in the ecosystem yet. And they've heard of Airtree, they've heard of Blackbird, they've heard of all these Square Peg, these large ones. They go to those guys and they're obviously turned away. They're nice to them and they want to keep an eye on them, but they're way too early for them. And then they get a little bit lost and they go, okay, well, I'm going to go and try and find some angel money. Well, that's very difficult, right? When you want to get 50 grand, 100 grand, 500 grand, no one wants to talk to you. When you want 5 million, 10 million, everybody wants to talk to you. So you've got this huge plethora of founders who aren't after a lot of money, but they need that money to get to the next stage. And they don't know where to go. They don't know which VCs to talk to. They don't know what money is good money. They don't understand the difference between an angel investor that will be good for their business and an angel investor that could potentially be bad. And that does happen quite a lot. And I feel that us as what we do, and you guys here in terms of investors and all that kind of thing, we have a sense of duty right now, because if we want our ecosystem to continue to be where it is and continue to be growing and almost hopefully become a world leader in specifically in the Asia area, then we need to prepare for those darker times which are coming. And who knows, maybe they're 2 years away, maybe they're 4 years away, no one's really sure, but the market is going to turn, and it always does. And when that happens, that money's not going to stop flowing, but it's going to be far more difficult to get. So what we need to do, and this is what I'm really passionate about, and I hate that word passionate because everybody says it in startup, but I just said it. I promised myself I wasn't going to say that. So what I'm really passionate about is helping as many of these pre-seed and seed companies get the funding they need and get them to that Series A level before we hit this market downturn, so that we have a lot more players ready to go and continue to grow the space. Because otherwise, I fear what will happen is it will start to contract again, and we don't want that. We need to help them get more publicity. We need to make them more mainstream. We need to help them get the money. We need to do everything we can to really grow this pre-seed and seed space up to Series A whilst we have this opportunity during the good times. And that's what my team and I are trying to do in all of these companies behind us. And that's what I am here. And that is what I would love to talk to anybody about who's here. So please, if that's something that interests you, if you want to learn more about how we do it, if you want to just talk about startup stuff, come find me. We have a stand, can't miss it. It's right by the front door. It's one of the joys of being a sponsor. You get right by the front door. Come and talk to me. I've got some team members here as well. Happy to talk about anything you like. And I've still got 2 minutes left, which means I've nailed it because we were running behind and I'm going to help them pull it back. But thank you for listening to me. I hope that wasn't the worst sponsored talk you've heard. I'm not the Kia guy. Don't think of me as the Kia guy. And hopefully I'll get to talk to lots of you throughout the day. Thank you very much.
Thank you, Steve. And please make sure to go and see Pauline Rosemary if you want to speak to another group. Now we have our first panel session of the day. We're going to be hearing insights from angel investors. We have Augustine Rubini, co-founder of Angel Investor School, and Ulrich Masset, founder and CEO of Vauban and an angel investor. Edmund Holton, founder of Paradigm Talks and Icon Family. Maya Goshen, Vitara, early investment advisor, and Pauline, the managing partner from Madonna Capital.
Augustine, you mentioned that you actually have some tips for networking in the angel space, and I think that's obviously very relevant now. So I'll start with you. What are your top tips for actually networking with prospective investors and making connections in this kind of sector?
I don't have a microphone. So
okay, so we have to share.
Let's do the following. You keep this microphone and the other one we can move around. So you're the moderator.
Okay.
So sorry, the three of us will be sharing this microphone. So hi, welcome everybody. And it's really exciting to be here and in this room, which is quite amazing. Yeah. Look up if you haven't had a chance yet. But yes, it's really good to see people back again in meetings. I don't know, raise of hands of how many people have actually been in physical meetings recently. Not many. So yes, we might get a bit rusty. People might get really good at Zoom meetings and team meetings and all sorts of meetings. But actually being here live, we might be feeling a bit uneasy. And that's something that we need to get better at. And what a great opportunity, knowing that all of us haven't been talking to actual people, wearing these masks and doing things remotely. Yeah. So I think the first tip that I would say, and I will welcome the other panelists here because they came on to me and they were all bubbly and happy to talk. In Angel Investor School, we like to start with a value that comes from Techstars, actually, which is one of these big accelerators, which is give first. Yeah. So try to get that into the mindset of first, how can you give something if you don't have anything? So first is recognizing the value that you have inside of you. And this applies not only for angel investors, but for any type of investor. Yeah. Like, I'm sure we have some of the startups in the room, some of the founders, and sometimes when you look at a founder, you think, oh, give me money, that's all I want. And actually, if you have a good startup, that's not the case. Yeah, you're looking for other things. You're looking for a person that is well connected, a person that can listen to you, that can help you solve certain problems with their expertise. So I think starting with that element of give first and even giving your ear, just allowing them to speak and clarify what's on their minds, that's something that you can give. Yeah. So when we're in and it's not for the room, it's for the people that are online. That's good. So I say think of that. Give first and give proactively. Yeah. So go and meet people proactively and beyond this conference. Yeah. So my point when we exchange emails was, hey, there's an opportunity in this room that by the end of the day or by the time you need to leave, you have made some nice connections, which might be good for business, might be good for the other people that you're meeting, might not be good for you. But at the end of the day, you'd made something good for others and hopefully something good for yourself. And when you go remotely, also try to be proactive. Get into LinkedIn, try to set coffee chats with people, even if you're not going to see them. And try to think of that, adding value to people. Yeah, I think that's the best way to do it, and recognizing inside of you that there's value, and clarifying. I'm over talking, so I'm gonna stop here. Don't worry, it's just important. Clarify what you want. What you want? Do you want to be a super investor in artificial intelligence, or are you mixed up between 5 different industries? I say just be very laser clear of what you want, and then there's so many billion people in the world that don't even know how many. So you have a laser focus and just pick one thing, yeah, and then focus on that thing and grow your network in that respect.
And don't be afraid to ask. You know, I think it's always good to. There's nothing to lose. You know, just get out there and ask the question. So that brings me to Maya. Sorry, yeah, I think we need to pass. Oh, you're mic'd up. Okay, excellent. So you mentioned there's some misconceptions about angel investing that we should work on clearing up. I was wondering if
yes, absolutely. I would love to talk about that. I apologize. I don't. Is my mic working?
This one.
Okay.
We will share.
Okay, great. Thank you so much, Edward. Yeah, misconceptions about angel investing. I think there are a couple of them that I'd bring up today, and I think were really relevant for me at the beginning of my angel investing journey. I think the first is the ticket size. I think that a lot of people think that you need to be investing 10K, 15K minimum to be angel investing. I don't think that's true. I think that there are a lot of new tools and structures and vehicles that make it possible to be investing $100, $200 as an angel investor, whether that's equity crowdfunding, certain syndicates are quite flexible, SPVs. And so I think that's the first thing I'll say, because it really is a barrier for a lot of us. And so I think it's a flexibility that does exist. It enables you to invest at an amount that feels comfortable and feasible for you based on where you are. A second one for me, and again applied, was the notion that to be an angel investor, you need to have investment experience. You need to have worked with a startup. I don't agree with that. I think that brings me to my third point, which is a lot of what comes back to feeling like, oh, who am I to be an angel investor? I don't have value to add to the startup. I can agree with that. I think that at the early stage of a company in particular, there is a wealth of opportunities to drive value. Whether that's, hey, I have an accounting degree, I can help you with your accounting. I can support with graphic design, with research, with user testing, user interviews. There are so many ways, regardless of your background, that I think it can be really valuable to a startup. And so I think that that's something that's important to internalize, that you don't need to be an expert in marketplaces to be helpful to market startup. You don't need to be an expert in digital health to have a health degree to help a digital health startup. And the last thing I'll say is you don't need permission to call yourself that. I don't agree. If you make one angel investment, you're an angel investor. And say that and share that with your network, because that's going to, I think, drive and attract more deal flow to you. So I think that's what's top of mind for me. I'm sure there's a very long list, but it felt relevant for my own journey.
great, fantastic. And 200.
Yeah, sure. Hi, everyone. Just one tip for networking, as well as Augustine said. You can wear orange or red and colorful shirts. Like that work really, really well, because people go talk to you because you look a bit weird. Yeah, starting your own angel syndicate. So let's say you are successful angel, investors. You made your first 5-10 investments, and now you want to level up, right? Like you want to step up and start professionalizing your investment activity. So the best way to do it is that next time you go talk to a founder, instead of asking, can I invest like 5 or 10K on 1K, you ask, can I invest 100 or 200? Like, can I bring investors with me? Like, can I bring friends? And ask for like a 100K allocation. And if the founder say yes, then you can start like sending the pitch deck to some of your friends, some people from your network. Are you guys interested in investing in this company? And if they say yes, and if you group enough people, you can go to an SPV platform or a syndicate platform where you can put together the syndicate. And just essentially a syndicate is like an investment vehicle where 10 investors invest in an SPV, in a special purpose vehicle, and this SPV invests in a startup. So it really lowers the minimum ticket size, right? Instead of investing 100K in a startup, it's like 10 people investing 10K each in a vehicle that invests in the 100K. And then the sponsors, so you as an angel investor, you can charge a performance fee, like a carried interest. So let's say 20% of the profits if there is an exit of the startup. And I would really recommend that you charge a carried interest right away. Like some syndicate, like some lead syndicates are really tempted for their first deal to charge no carry. But the problem is that, it's like a shop, right? Like if you are really low in terms of price, it's very hard to increase your pricing, right? Like you can always go down. So if you already charge 0 performance fee, it's hard, to go higher, right? So I would suggest you start charging like 10, 20% carried interest for your first deal. And then when you close your deal, it's pretty satisfying, right? Because you've become a venture capitalist, right? You are doing one of the sexiest job on earth to be a VC. So that's pretty cool.
I like the sound of it.
Hello. Yeah, thanks for that, Edward. So I'm going to give everyone some very shocking statistics. The female funding gap. So 25% of founders are female, but only 1.4% of funding goes to all female founded businesses, despite female founded businesses outperforming male founded businesses. So that's stat number 1. Stat number 2. In terms of women in the UK, when they start businesses, they start businesses with 53% less funding than men. And on top of that, when you're talking from a, like a raised early stage rounds, women raise 20% less at seed rounds and up to 50% less at Series A. So I think the stats speak for themselves in terms of the female funding gap. There's a huge gap, but also a huge opportunity for the right investors. And in terms of female funding gap, that is one of the reasons why I co-founded Madonna Capital. It is to help female founders be connected with the right investors. And, the right investors could be both men or women, because it's not a female-only issue. It's an issue for everybody in the ecosystem. We all want to have better returns. We all know that diverse teams yield better results. And that's where all you guys come in, whether you're an angel investor, thinking about angel investing. As Maya mentioned, you can start small. You can start having conversations with different founders, establish a relationship, because in terms of the life cycle, when it comes to a startup, not in it for about 7 to 10 years. So it's very important, I think, to have the right chemistry with the founder. In terms of the founder, it's important that they're passionate about what they're doing, because it is very challenging. As a female founder myself, helping other female founders, it is a a bit of a journey and you want the right investor to take you through that journey, whether it's with capital or in my case, also with my skills and experience and also the skills and experience of my team. So yeah, it's a great opportunity out there. And if it's not on your agenda to back female founders, then I think it should be.
I was filling. Yeah, sure.
Awesome. I think I just want to echo everything Pauline mentioned, and also I think emphasize two other points. I think one thing is that if you're like asking yourself, but where do I find the female founders to invest in? I'm having a hard time accessing deal flow. I'm having a hard time finding female founders in a specific industry. I would say join communities of angel investors focused on female founders. So you've got things like Alma Angels, based in the UK, but I think covers Europe and even globally, that has a wealth of deal flow as well. And so I'd say that's really important and an opportunity for you to kind of increase your deal flow. The second thing is I just want to mention, if you want to invest in more female founders, start with investing in female investors like Pauline and others that are able to really, I think, source that talent as well. And I think are going to bring a different lens to investing. And so you've got some like, I think, CU Ventures, you've got Pink Salt Ventures, incredible, phenomenal, female founders and investors who are starting funds themselves that are exclusively focused on finding the female talent for co-founding teams that are doing great work in a range of industries.
Yeah, and I want to add to that, if you are looking for, deal flow, you can come to us. Or there's also, we're investing in Women Code. So you just Google that and you have a list of different investors who have pledged to deploy capital towards female founders. And Maya, actually, her portfolio, one of her thesis is, I'm speaking on her behalf, but, she invests in businesses built by women for women. And I think that, when you talk to Maya or myself, in our network, we have lots of, deal flow, quality deal flow that we would have kind of vetted and put our names behind.
Is that limitation also works in terms of the time horizon? Are there opportunities available to investors who potentially recognize a company's ability to raise money, maybe over the next few years, but aren't quite so confident to turn into the next?
Yeah, sure. I think with angel investing and in investing in any early stage business, we have to remember that it is very risky. And not to kind of scare you all away, but I think if you go in knowing that you're making a risky investment, then I think you're off to a good start. In terms of the life cycle and the amount of years that you need to kind of invest. There are, if you invest in an earlier stage, for example, if you come at pre-seed or seed, oftentimes, once they hit the milestones, they'll be raising a Series A, Series B, and at those points, if you really want to exit, you can. So yeah, there are always kind of ways around it, and depending on your own personal financial circumstances as well, but definitely, invest with that in mind.
Yeah, because I don't think thinking long term is a problem. Like before starting Vauban, I used to develop like algorithm to trade like on crypto and to trade on equities. And I was this guy that would always like check every 2 minutes my portfolio while I was talking to you, right? And the problem with that is that it drives you completely crazy, right? And that's how I lost all of my money trading crypto. So with angel investing, basically you can't sell for 5 or 10 years. And it lasts, longer than your average marriage, right? Like 10 years is a long time. So basically, it forces you to be kind of, stoic philosopher, and not, to be like addicted to, refresh your portfolio, etc. So thinking long term and not selling is actually, I think, a good way to build wealth and to be invested over the long term.
Just to complete that view, you talk about long term, but also you need to talk about diversification, which is you cannot put all of your eggs in a basket. And it's good that you explain how you don't need to be investing 50K per deal. You could invest in Vauban very easily and put like 2,000 in each of your deals and build up to a portfolio of whatever your target is, yeah, through this span of 5 to 7 years.
As an angel investor, totally. And I'll again share my own experience, and hopefully some of this resonates with you. I think in terms of getting started, the first and most important thing is to just get honest with yourself about why you want to be angel investing. What are your goals? Is it learning? Is it impact? Is it really about the returns? I think as Pauline cautioned, it is a very high risk investment. So just get honest with yourself about what are your goals and what are your priorities. And then also just set an intention around what specific areas that you're interested in investing in, whether it be specific industries or specific types of companies. The second thing is to just do a lot of learning up front, but also throughout the journey. And so there's a wealth of amazing resources online. You've got awesome YouTube videos and podcasts. I'd say also do things like look up angel investors you admire and follow them on social media. They're typically quite vocal on their various platforms and are very generous with their advice and their own experience. And another idea, and I think this is really important, is to look at your own network and of course meet with and talk to angel investors you know and pick their brain and buy them coffee, but also talk to founders and understand from a founder's perspective what makes a good angel investor, how do they think about angel investors, where can they be most informed, when are they actually most disruptive, what do they look for in an angel investor. I think that can be really insightful from a learning standpoint. And then I think the third thing is starting to generate deal flow. And I think that can be quite intimidating at the beginning, but there are a couple of different ways to join angel investor communities. A lot of them don't even require having angel invested before. So Alma Angels, as I mentioned before, you can join with the intent of investing, and it's a great source of deal flow across different industries. It's also an awesome learning community. It's great for friends generally. The second thing I would say is to do creative things like look at your local institution, academic institutions, and they probably have pitch days for some of the entrepreneurs coming out of those universities or those schools. Like attend those pitch days, join those pitch days, look up online, virtual, thanks to COVID in some ways, we now have much more access beyond our geographic limitations. Join online and virtual pitch days from different groups. I think those are some of the ways you can generate deal flow. And I'll say, last but not least, good old LinkedIn can be incredibly helpful. When I first started angel investing, I literally searched founder or co-founder in my first and second and third degree networks. And that is how I started to filter and populate it into spreadsheets. So I think just getting started, you've got so many tools and resources at your disposal.
Yeah, I'm glad that you asked. So all in all, what we're seeing in Angel Investor School is a lot of queries coming in about what's happening with the war in Ukraine, the new geopolitical situation. What do I need to do differently in my investments? Yeah, shall I stop deploying capital? And actually, we've had to write about it because so many queries have been coming in. And all in all, we've been seeing that the world has been changing a bit from the total free trade onto the more restricted free trade or different areas of free trade. We've also been looking at what's happening with commodities, which we've seen on the keynote before, how prices are going up and how things are changing. And we need to recognize new realities. Some countries will be hit more than others, like Russia and Ukraine, specifically the startups are going to have a lot of problems, finding resources, finding right talent. But all in all, as we were saying before, 5 to 7 years, we're looking at technology investments. Technology is here to change the world. And if we keep on investing in technology, that in the long term should pay. So I think more tactically, there's some industries that are coming in as something that is more investable or something that we should be looking at more in detail. I love fintech, for example. And inside of fintech, we will have crypto and new uses for crypto with the new situation, new regulations, people trying to get money into Ukraine, people trying to get money out of Russia. So how do we sanction people? How do we check that things are being orderly followed? So I say that's one of the key industries that look at and looking at renewables. So we're looking at commodities prices fluctuate a lot. New commodities being and becoming critical, such as lithium, nickel, and other precious metals that are hard to extract. So can you invest in companies that are looking for better extraction models for that? And I say finally, cybersecurity. We've seen at a military level or at a country level that these are being used as weapons. But that's also happening at business level. So how can we protect ourselves better? It's something that's going to affect every single company. So I think investing in cyber and choosing the right companies, then that's going to be an area where you can really profit.
I agree with, in terms of one of the best things about investing and helping, startups is that they're at the forefront of their industry. They're being disruptive and innovating. And so being a part of that is you're not just giving them money to build that business. Personally, I mean, my background is in consumer and luxury retail, but personally, I'm interested in kind of STEM because I think we need more of that deep tech and that technology in order to move us all forward as a human race and to make the world a better place. So yeah, I agree with, not just investing in the UK, although UK is a very great place to start. But I'm seeing a lot of the companies that I help looking to expand in the US, in Africa, in Asia. And I think it's very important for angel investors to be involved in early stage businesses.
I have a funny story. One of our clients is launching a space tech fund, and in his pitch deck, he put like it was in January, like 1% of the fund will be allocated to like defense tech, like military, etc. And his investors were like, "I want to invest in your fund, but can you just remove like the defense element? Like I don't want to invest in like military, startup, etc." And then the war in Ukraine happened, and now they are calling him back, like, can you bring it up to 10% in defense? Which is pretty insane. Yeah, I mean, that shows that, it became quite trendy nowadays, like all these kind of defense and space tech, unfortunately. Yeah.
Great. We have 2 minutes left. Does anyone have any closing remarks? Anything snappy or?
I'm not sure I would describe it as snappy, but one thing, you'll be the judge. One thing I did want to mention is as it relates to investing in women and female founders, I think the most important step actually is to just acknowledge your own bias. And so there's really interesting data that I think DocSend just published about essentially how different types of investors process different pitch decks. And what they found was that investors typically spend about the same amount of time looking at a pitch deck, whether it is an all-male team versus a mixed team versus an all-female founding team. But they saw huge variation in which slides investors focused on. So whereas for men, investors tended to pause and really digest slides on, let's say, product or purpose, with women, they really paused on the slide that said team and traction. And I think that is really telling in and of itself. And so next time you look at a pitch deck, next time you are investing or considering investing in a deal, just ask yourself, what bias am I bringing into this? And consciously consider, approaching that differently.
No, just to add as well, when you angel invest, everyone is telling you need to add value, right? Like you need to be a value-added investor, etc. But people don't realize how low the bar is actually. Like if you help a founder hire one engineer, you are already in the top 1% of value-added investors. I mean, I hope no one is has invested in Vauban because they're gonna kill me. But if I say that, but essentially, yeah, like you can just DM someone on LinkedIn, like, oh, I have an engineer for you, and can I invest in your startup as well? And they will say yes, right? Like the bar is so low, so don't be afraid to help.
That's it. I think that pretty much wraps it up. So thank you to our panel. Thank you.
Thank you so much for coming in, guys. We really do appreciate it. So now we're going to start off with our presentations from our fantastic founders today. First of all, we have James Graham, CEO of Recce Pharmaceuticals.
Okay. Hello, ladies and gentlemen. I've got a bit of a exodus going on here, but I do appreciate those who stay. My name is James Graham, and I am co-founder, CEO, and managing director of Recce Pharmaceuticals Limited. Wrong way. Here we go. So, what is Recce? Recce is good people backing great science. I have the privilege of supporting what was the invention of former head of Johnson & Johnson Research of Australasia, Dr. Graham Melrose, in his retirement. And talking about his retirement was he wasn't any good at the carpentry, so he picked up his test tubes in his garage and had another go. And the other go is creating a compound that overcomes the hypercellular mutation, also known as bacterial resistance or superbugs. So talking about earlier, the little incremental things you can sometimes do as a passive investor to support an active founder or entrepreneur. Really, the biggest thing I did for the first couple of years was take stuff from that garage into the laboratory to give him and his fellow scientists a chance. And that chance was utilizing the equipment, identifying the compound and patenting it, from which we managed to build upon. I was the first investor in a passive investment context. I'm now the second largest shareholder. I get to work with brilliant people such as Dr. John Prendergast, who's dual New York Stock Exchange chairman, and his doctorate is in the study of bacteria and blood diseases. And of course, as you'll hear with this company, we are the only clinical stage blood disease or sepsis company in the world at this stage. Next slide. So as a snapshot, we are an infectious disease company with the first new class of antibiotics in over 30 years, in fact, some say 40 years. We have two clinical stage compounds at clinical stage programs. Sepsis, septicemia or blood poisoning is, of course, where you get a break in the skin, bacteria gets in. It's the number one most expensive condition treated in health, double the second most. And there's actually no existing drugs approved specific for the treatment of sepsis. We touch upon that in a moment. We are the only US FDA QIDP designated company in the world, which is the prestigious legal designation, giving an additional 10 years of market exclusivity above and beyond our patent position. And in this instance for sepsis, we're 3/4 of the way through our phase 1 intravascular study, which is according to obviously international regulatory purposes, the most advanced sepsis drug in the world, and I'm flattered here to represent that. Our additional clinical study is burn wound therapeutics. So some may have heard of Professor Fiona Wood, the lady who was Australian of the Year for her burns work, and is leading our program as a spray-on antibiotic solution. So 2 methods of administration, and particularly 2 areas of indication, that being the topical agent for broad-spectrum antibacterial infections. As an infectious disease company, we have a portfolio of products, or compounds, I should say. But there's a suite of them in the preclinical stage, with the 2 clinical working side by side with news flow that supports that. This is really a kind of a snapshot from the different ways of looking at it. We're looking at major market sizes, near-term catalysts across our various clinical programs. And as you'll see further in, this is one of the few presentations today which isn't raising capital. Our capital is for the purpose of supporting these preclinical candidates to become clinical candidates, which obviously generates wealth and opportunity as the capital gain towards the market suggests. So sepsis. What is sepsis? Sepsis is blood poisoning. Any bacteria that gets in your skin, a basic cut, a basic cosmetic surgery, and at every hour left untreated when that bacteria is in your blood, the likelihood of survival decreases by 8% each hour. So there's about 50 million incidences each year, 11 million result in death. That's obviously a 1 in 5. That is a terrible unmet medical need. In hospital, obviously a 1 in 3. And the result of that is it's the most expensive condition treated in health, double the second most expensive. So on a per patient basis, you're looking at around $100,000 US per patient. That's extraordinary. I didn't make that number up. Of course, it's behind the references we see there. And there is no drug specifically for the treatment of sepsis. The reason why is the challenge of identifying what type of bacteria that patient has and what type of antibiotic that bacteria is susceptible to. So this compound is a broad spectrum synthetic polymeric antibiotic. It breaks down, of course, water soluble across all pHs. And we don't rely on, in fact, we don't frankly care what type of bacteria that patient has, because any bacteria is bad bacteria. Our goal and our positioning, beginning with the end in mind, was designing a compound that could be intravascularly infused, attract to, bind to, and interact with, regardless of the bacterial stain being the reference of that type of bacteria, regardless of the type of cellular mutation, and get on top of patient infections and patient presentation. So we're going to pick up the speed just for time purposes. Really, what's different from a technology perspective, all existing antibiotics to date are natural. They're bacterial, fungi, cultivated out, and you're only as good as what you find with specific mechanisms that don't keep up with the hypercellular mutation that is effectively antibiotic resistance. With ours, we began with first principles in mind. We wanted to be attracted to, bind to, and interact with the cell walls particular to bacteria, and there's a particular protein we're attracted to. We wanted to work and keep on working with that repeated use, meaning as that cell mutates to survive, they always have and they always will, we wanted a compound that will continue to evolve with that. And we've achieved that. So this is essentially the real detail of mechanism of action as to how we work when others don't. Multiple layers or multiple methods of attack taking place there. This is independently done. As you can see, Linnaeus Biosciences, they identified the mechanism of action for vancomycin. The next one that they identified was for Cubist, which shortly after went on to sell to Merck MSD for $10 billion US, right around the stage of our company. This is an example of being able to work and continue to work when others don't. That's amoxicillin. They stopped working after 8 cycles because I actually was the first capital in this. I had to pay for this study. It was one of the best things I've ever paid for because it was that inflection point to demonstrate the technology. But we went 25 repeats, case proven. We've lodged that patent, granted all around the world, and we've informally done it hundreds of times since. Never has our compound failed to work and keep working with repeated use. Touching upon our phase 1 intravascular study, we have completed dosing for the intravascular infusion of 1,000 milligrams per kg. It's around a 10-fold increase on our initial dose. The goal of a phase 1 is actually to find the ceiling. So obviously, when you know where an overdose is, which is the intention of a phase 1, you then look to where the therapeutic window of efficacy and safety come together. So there'll be multiple news flow events surrounding this. If successful, which I believe based upon where we are, we would then go into a phase 2, which is where, of course, you see the efficacy indications. This is our topical activity happening in West Australia's leading teaching hospital. It's sponsored by the West Australian Health Department, so it actually doesn't cost us any money. It's on a vulnerable burn patient population led by global experts, Dr. Ed Ravi, Professor Fiona Wood, of course, this brown skin lady thing. This is the type of bacteria we've been put up against. Many antibiotics work against one type of bacteria, but they'll be utterly useless against another. And of course, they rely on time-consuming diagnostics and guesswork. These are the types of bacteria we've come across. Every patient has had a complete clinical response, or is in fact been cured of their infection. And some of those infections have been reoccurring multi-drug resistant infections. so much so that the time of dosing has been halved because there was no more, by the clinician's request, no more bacteria to treat, and you'll certainly see continuous news flow events around that. That's a phase 1, phase 2. This is briefly our preclinical activity happening in the background. Any good infectious disease company has an exposure to COVID, obviously. Uniquely in our instance, to get the term antibiotics, we're an anti-infective. We are attracted to the proteinaceous layer of viral envelope cells, and thereby example, which is as a priority 1 test candidate in Australia, we're showing good efficacy without toxicity specific. Patents, land grab opportunity by way of ownership and patent protection, composition of matter, manufacturing claims, curative claims, methods of administration across the full suite of infectious disease type activities. And uniquely in our instance, of course, we have our QIDP, government-backed protection. We make our own compound in Macquarie Park, so we don't rely on external providers. You know, the bottle costs more than the liquid that goes in it. We're fully funded. Our third or second largest shareholder is Fidelity International, by example. We're listed on the Australian Stock Exchange or Frankfurt Exchange, if that's closer geographically. And really, what are we doing? We're utilising our capital as a tool to create value as we utilise this unique, potentially highly valuable technology in the fight against antibiotic resistance and emerging viral pathogens. So thank you very much for listening. I think we got the time there, and I wish you all the best for today's event.
Brilliant. Thank you, James, and thank you for coming all the way over. Now we have Barnaby Procopio, CFO and co-founder of Cashero.
Fantastic. Excellent. Good morning. Sorry, guys. Is that the clicker? Perfect. Thank you. Excellent. Good morning, everybody. Nice to meet you all. My name is Barnaby Procopio. I'm the co-founder and CFO of Cashero, a blockchain-based payment ecosystem. Now, there are a lot of competitors, a lot of fintechs popping up in this area at the moment. What makes us different? That is the point of today's seminar, to try and explain where we are, what we're doing, how we're different, and how we are looking to revolutionize banking moving forward. So we have 4 key services, and of course, with those 4 key services, we fall into 4 different markets with that. So we provide solutions for instant and global payments. Not only do we do them instantly, but we also do them for free, which has never been done before. We provide FX or multi-currency accounts or wallets. We allow people to hold their local currency and also convert into a more stable currency, protecting them from currency volatility, again, at no cost. And we provide the highest rates of interest from any financial institution. Not only do we do that, we provide that in real time. So we actually credit that interest every 20 seconds to a depositor's account. Now, where did this all begin? So this all started through our work across sub-Saharan Africa. We saw a real problem across many different countries across Africa when it comes to banking. So from the simple access of banking itself to actually holding money in a wallet or an account, people are facing absolutely extortionate fees when it comes to sending and remitting funds. Furthermore, because of the volatility across African territories with the currency, people are opting to hold pounds or dollars, for example, to, let's say, alleviate that currency volatility or devaluation risk. The problems that people face, however, is the access to banking in the first place, the charge that it costs to open these accounts and to hold these accounts open. So our team, across the work that we did across Nigeria, Ghana, Zambia, South Africa, and Benin, saw this problem and tried to tackle this problem. Now, the irony is that when we set out to provide this solution to the African people, we realized that we were actually solving a much greater problem. And it's not just for Africa, but it's actually a global problem. And I think this has been made more clearly with the crisis of the pandemic of COVID-19 and also more recently the crisis of Ukraine. So what am I talking about? I'm talking about the economic uncertainty. So the fact that people are needing to hold cash, or the benefits of holding cash, but the penalty of holding cash is simply that people are facing very, very low interest rates with rates of around 0.01% currently, high remittance fees to actually send, receive, transfer that money, and of course the payment friction that comes with that as well. Now, it's not just the problem across Africa or the UK, but it is, of course, global. And we've highlighted some of the G20 countries here that you can see on the table. And what you'll see is that the real cost of inflation in many of these jurisdictions and areas is far above 4%. So to have a solution, you need to have a solution that will, of course, eradicate or help eradicate these problems, but at the same time provide an interest that actually beats that inflation as well. Okay. So here is the solution as we've highlighted before. So it's high yield savings. We offer on the current account between 2 and 5% interest to users. If people are willing to lock in that money for extended periods of time, so we're talking a month, a year, or 3 years, the rates surpass that 5%, and they're capped at about 10%. We pay that rate of interest in real time every 20 seconds, and the idea behind that is to promote saving, okay, promote financial education. Of course, if users can see that the balance of their capital is increasing in real time and that they're able to spend that money in real time, the idea is that they'll, of course, add more money to that account, they'll save, they'll bring their business accounts to the platform as well, and of course refer friends to the platform as well. Of course, as I've mentioned, the multi-currency wallet as well. So whether I'm in Dubai, the UK, Nigeria, I'm holding the Naira or the Ghanaian cedi, for example, I can hold my local currency, but I also have the opportunity to flip between the US dollar, the pound, and the euro. These are our version 1 currencies. Of course, as the platform develops, we'll add further currencies as well to the system and to the mix. And as I've said before, instant payments, we allow and facilitate global payments across 120 different countries, not just instantly, but also for free, which is revolutionary. A side note, which I guess pushed on the ethical and sustainable side, is that we do also allow charities to receive their donations for free. Typically, charities face a fee of around 3 to 7%. So what does that mean? So we, of course, fall into 4 different markets: the high yield savings, the instant payment, and the multi-currency side. There's a global market of around $29 trillion, okay, which of course does put us in line with a number of competitors. There are, of course, many competitors in the space, the likes of which you will have heard. Why and I being the most exorbitant. In a nutshell, what are we offering? We're offering the highest rate of any financial institution to consumers, so whether they are individuals, businesses, charities, we take that full market. And we're also running or operating the system on a premium basis. And you may ask, why is it to do this? Very simply, by offering these premium services and premium models to people, we're bringing in as many users as possible, as much volume and traffic as possible. And of course, with this comes deposit or assets under management, AUM. It's on those that we make our money. Okay? We're yielding around 18%. The system's been tried and tested over the last 3 years. We yield around 18% on a over-collateralized loan basis. We provide liquidity for the financial institutions and okay. What we do with that interest is we pass around 5% to the front-end user, as mentioned. Around 2.5% to 3% goes to our joint venture partners in marketing. The remaining stays within the business as profit, okay, and for the investors as well. At the moment, as we're in growth stage, we recycle. Where are we at? The technology is built. That has been done by US military biggest problem across these sort of platforms providers is now either a license when you're handling people's money, you really don't get All well and good having a fantastic idea, a great revenue model, but it's wanting to finish the product. And now we are, I would say, that's on an online basis. You'll have effectively we're approaching them, we're offering them, deploying them to opportunities where they can make money on their account. They're providing different to their clients, they're providing income in their clients in real time. So metrics now, these are our meeting level projections that from the reality is that very harsh on ourselves, let's say. But let me look at on most have already and with when it comes to investment pounds and bed, so we have a investment fund. So the use of funds is predominantly the marketing and credit development, around 40-45% goes to this arena. The rest is, of course, look after the clients that we've onboarded, so operations general on the salary of the primary. The offer as it stands is around £1.5 million left in May, and around 1 million today. Where does this leave us as a bit of a summary? We're targeting in 1 or 3 million users approximately 3 years from now, so March 2025. With that base of users, it's around 1 million users, forecast around 5 million on the platform. Was it 3 million on the platform? Around 9. Base value is about 6 million. Management in part of finance. We've worked with a number of companies, one family across Far East and also Africa. We've refined our knowledge to bring effectively a fintech digital bank solution which has the blockchain edge behind it. Pushing that, of course, the team now is 45 strong, and we're expanding around 85 prior to.
I've got to stop you there. Sorry, we're out of time.
No problem.
But thank you so much for coming in, Barnaby. Give him a clap. Next up, we have Andrew Lawton, founder and CEO of ResCube.
So which button is it?
Yeah, just forward
Okay, great. Good morning, and yeah, thanks for taking a little bit of time to hear about ResCube. ResCube basically provides always-on power and internet for remote workers. And obviously that pretty much includes probably all of us. My name's Andrew Lawton. I'm the founder and CEO. Rescue actually comes from a previous business, Fortress Availability Services, that provided work area recovery and recovery services for financial services and legal firms in the City of London. And if you've not come across that, basically it's offices with desk chairs, PCs, phone systems, all set up, ready and waiting for people to have disasters. And we were basically selling that to financial services companies that are regulated and need to have some fallback provision. So they would basically buy this, in effect, annual subscriptions payable in advance, for the ability to pick up the phone and say, we're having a disaster, we're going to bring all of our critical people across to your recovery center. Now, of course, that was all going very well. We were winning awards and winning customers. And then March 2020, we all went home, and the world changed. And so many of our customers came to the conclusion that actually all of our workers working at home are doing a great job. You know, they're very productive, and there's no reason for this fallback office. If we have a problem in our main office, if anyone's actually in there, we'll send the staff home. And so we needed to think very quickly about what was, how we could continue to deliver value and be relevant in this new world and this new way of working. Now, what struck me was that all of the people that were doing the critical work in the recovery centre are now doing that critical work at home. And the other thing is that when we were always talking about these recovery centres, our customers were saying, you know, how resilient is your fallback office? Because they didn't want to have a fire or a flood in their main office and then bring all their critical staff across and then have another fire or flood or a problem with their recovery centre. And that's where the problem arises. That's the complexity of this new world. Building resilience into a recovery centre is actually pretty straightforward. You have dual feed power and dual feed comms, a UPS and a generator, and you have a resilient building. But of course, all those people, as I say, doing that critical work in the recovery centre are now doing that at home. And that's where the complexity comes. It's very difficult to build resilience into your home workers' homes. And you could, of course, send out a UPS and a 4G failover router and a load of cables. But a lot of these key people, these critical workers, people trading at home, key execs, critical call centres, etc., aren't necessarily technical people. So you're never quite sure, if you're an enterprise, say you're a JP Morgan or Morgan Stanley, you're never quite sure whether these home workers have their resilience set up correctly. And the other thing, of course, is because they're consumer devices, you send them out and you'll never really see them again. You can't log into them remotely, you can't control them. And so what we've done basically is put the UPS and the 4G failover router into one box, which is very simple for the IT team or the IT service provider to send out. It's very simple for the remote user to just take out of the box, plug in the wall, connect up to their Wi-Fi as they would do an Alexa or a smart TV, and then they have resilient power and comm. But the other important element here is that, and it's actually key, is that there's a remote dashboard. So you can almost think of Rescue as like the Peloton home work. It's a platform over which we overlay services. So we have support services, enterprise management services, all of which enable these IT teams of these large financials to remotely log into the Rescue for two reasons. One, firstly, to ensure they're working properly, because they need to prove to regulators that they have resilience, and they need to prove that they're a PLC, for example, to their board and shareholders that they are a resilient business. But also very importantly, that it enables them to support these remote users more effectively. These remote users that would have this are key users for the business and therefore need fast turnaround. Rescue provides a window into their remote infrastructure to enable them to understand, diagnose faster, and also remediate. What about the market size? Well, this is actually surprisingly large. Gartner have estimated there are about 1 billion remote workers around the world in 2022. And in our experience, about 5 to 10% of those require resilience at home rather than fallback. And what that basically means is we've got a market size here of about 50 million individuals. And that's obviously a reasonable sized country. That doesn't take into account all of the other markets, such as call centers I mentioned, retail. Obviously, you can't take any contactless payments without both power and internet, or any use case where you think actually we're running a critical element of our business that requires both power and internet in an environment where they're non-technical. And actually, the use cases, the more we look at this, are greater and greater. With having come from finance and providing services to finance, we have excellent access to that market. And many of the top banks and asset managers and lawyers are already considering rescue for their senior execs and for their traders and for crisis management teams, security operations centers, etc. And we have outside of that advertising company as well, the world's largest, using it for their execs as a sort of proof of concept, and then expanding that out to other individuals. So how about going to market? Well, we're working with a company called Schneider Electric. Some of you may have heard of it. It's actually a massive company. They're the largest producer of uninterruptible power supplies in the world. And they're our technical partner, helping us build rescue and provide logistics. But they also want to license rescue and basically put their ad, which is APT, on rescue and sell it through their channel. Our launch partners are Computer Center. You may have come across, very large IT services provider. Kyndryl, a name you might not be aware of, but actually it's IBM. IBM's old services business that rebranded themselves. And Exclusive Networks, which is a distributor that distributes in about 50 countries worldwide. We've also started getting referral partners. This is just two of quite a long list. These are insurers, obviously, that are referring their business insurance customers to us, thereby reducing their risk of insurance claims, but also improving the resilience of their customers. So what are we looking for? Well, we are seeking funding of 1.5 million at a valuation of 8 million. And what we're going to be doing with that basically is to build out our sales team and our marketing team using our existing product, which you'll see outside. We can very happily give demos of how it all works and take that to market. Finalize the license with Schneider Electric and also the agreement for them to manufacture and distribute our products worldwide. And also there's two further versions of Rescue Hub, which is for small teams. We've already got interest from one of the largest health service providers in the States for all their vaccination centers and testing centers. So it's a great use case. And that's for Rescue Hub. And then Rescue Edge is for edge computing. So smart home, smart infrastructure that, again, needs both power and internet together at the same time. And also to expand out. So we need to get this out into market. We already have our partners, but we need our own team to support those partners as well. Now, obviously, just really scratch the surface there. If you'd like to find out more, there's obviously plenty of detail that goes behind that. And look forward to hopefully speaking to you a bit later on today.
Thank you so much, Andrew. Now we have David Baker, CEO and co-founder from Issuer Pixel.
Good morning, ladies and gentlemen. This one. Okay, sorry about that. My name is David Baker. I'm the CEO of Issuer Pixel. So Issuer Pixel is a B2B video audio crowdsourced indexing, that's the key, sharing and networking platform connecting companies to the world. Think of it like YouTube, but for companies with highly indexed video and audio so companies can actually be found. This is an example of our production homepage, a screenshot, if you will, when we launch in the summertime. You take a look at the categories throughout this slide. You'll see they're something you wouldn't see, for example, on a YouTube or a Vimeo, Daily Motion, etc. So the problem for companies is that they don't have a centralized media library that's structurally organized and highly indexed, again, so that the companies can be found. It's difficult for investors to find them, no economic way to achieve or measure visibility, and then planes, trains, and automobiles are expensive for due diligence. So we'd like to think that we're eliminating that. Here's an example of a use case looking at YouTube and Google. In this case, we're looking for turbofan jet companies. Beneficial for us, unfortunately for YouTube, that there's only one result that's accurate, meaning showing actually the associated video and audio of a company. It's 4 years old, as you can see here, and the rest is sort of editorials about turbofans, physics of it, but it's really not the companies and their associated video and audio. So this is an issue or a company-specific problem and an industry size problem, and what you usually come up with on a YouTube as an example, the best example is irrelevant and disparate results. So the solution is a video audio platform that's indexing, and it's being crowdsourced indexed by the companies. And the way that works is companies fill out a profile and they answer more than 72 different questions in various categories that I'll show you here in a moment. And all of that information gets populated to database tables. Then they categorize themselves in an industry or multiple industries, depending upon how many products or services they have and whether or not they're a conglomerate. Then they categorize their video and audio in the various industries in which they participate. So if it's a conglomerate company, then for example, it's, I don't know, TRW, just as an example. The missile videos get classified under missiles, the helicopters under helicopters, the elevators under elevators, etc. So that's how it works. So the relationship between a company's classification is independent of the video and audio, depending upon their product service level. Our platform is 4 major things. It's a video audio library, the video audio database, which is our crown jewel, and we'll go into that a little more here in a moment. It's distribution and visibility of companies' video and audio. And finally, it's company-to-company communication. Think of it as LinkedIn, but for companies. So in a lot of ways, we're YouTube, but for companies, LinkedIn, but for companies. It has an individual profile, your resume, we all use it. In this case, we're creating a corporate resume, corporate profile, if you will. So those are the 4 main aspects of the platform. In the future, we'll get into commerce, but I won't discuss that today. This is our video audio database. What it is, it's a combinatorial query system. So what's happening is there's 125,000 industry categories. It's proprietary to us, this classification system. It's based on products manufactured, services performed. And then there's other company characteristics that you can see in these tabs: video type, audio type, social media presence, fundamentals, which would be operating metrics and financial ratios, technical stock market criteria, etc. So what you can do with this platform is you can say, for example, give me all companies and systems under manufacturer, under attack helicopters, that have an audit committee, that have less than 400 employees, that are based in Texas. I only want to see their annual shareholder meeting video from 2020. You'll only get that. So it's a very, very sophisticated video audio database, 72 different filter criteria, 1,250 different drop downs, and growing, and again, all the categories that you see at the top. So our industry classification system replaces SIC codes and NAICS codes. The problem with those codes is that they're based upon company description, not products manufactured, services performed. And that's what really you have to focus on, is products manufactured, services performed. Here we're using aerospace as an example. You can see videos are attached here at the appropriate place within the aerospace industry. Again, we have 125,000 categories within what will eventually be 200 industries. And when we get there, it'll be about 1 million categories, if not more. Total available market, 130 billion globally, and you can see the US market, which is our first focus, if you will. But that being said, the platform is able and starting to take in companies from any country, of any organizational structure, and soon of any industry. So we have companies from Australia on the platform now in beta. We have companies, one from Ghana. We have companies, lots in the US, of course, and various industries. Business model is freemium for companies, premium for users, promotional services for increased visibility. That consists of things like CRM email integration for video audio, VPN messenger distribution, so distributing your video audio via WhatsApp web, Viber, Telegram business groups. We'll be launching Issuer Pixel TV, which is part of promotional services. So you can video cast across our platform to both companies and users, and then licensing and advertising revenue. We have 1 patent issued, 3 pending, 5 more planned. It's an omnibus family of patents. We're waiting to see how the examiner reacts to the current 3 before filing the next 5. This is a competitive map. I think it helps people understand where we fit in. On the top of the y-axis is abundant video and audio content. At the bottom, scarce video and audio content. On the x-axis to the left, all content. To the right, company-specific content. As you can see, companies like Google, YouTube, Dailymotion, they have a lot of video audio, but again, it's not indexed, it's not crowdsourced indexed, it's not granular, it's quite a messy set of results. But again, it's not indexed, so it creates difficulty finding things. In the lower right, PitchBook and Crunchbase, they have a lot of company industry-specific information, but again, it's not video and audio. You look at companies like Wistia, it's more of a marketing platform. And our platform, again, for us, the video audio library is just incidental. It's necessary, but it's not sufficient. It drives the video audio database, which is unique, and it drives the other things, like the visibility, the distribution services, and the company communications. And that's it for the slide. We're raising up to $5 million. You can see the spread in terms of use of proceeds is fairly even, except for sales and marketing. Number one thing we need to do is sales and marketing to get scale. And we're in beta, so that will happen as we move out of beta. I have 0 minutes left. So lastly, let me talk about this. In our beta, we're doing a beta that is quite slow and methodical. What we care about most is product market fit. And for us, that's the incorporation of the platform into the daily workflow of the companies. So this is a year of beta. Next year, we'll start generating revenue. Plan is in January. Exit strategy, either public offering or a sale. Leadership team, I have 30 years of experience in Wall Street as a hedge fund manager, banker, trader. And our development team, like 2 co-founders that lead 10 other developers. They had their own software development firm for 9, now 10 years. Thank you very much for your time. I appreciate it. Have a nice morning.
Fantastic. Thank you, David. Up next is Agamemnon Epenetos, co-founder, chairman, and CEO of Anastasia.
Can you hear me? I can hear me better. I'm going to present to you Anastasia Biotech. Anastasia is a cancer therapeutics company. To take one step back, cancer is a disease caused by mutations in normal genes in normal cells. These mutations cause the cancer and drive it to become more and more aggressive. The company will have a technology that allows us to create human proteins that inhibit these mutations. If you inhibit these mutations, you kill the cancer. The technology we have allows us to develop multiple products, but we're mainly focused developing products against cancer mutations. So the pointer can hardly point. Cancer is a common disease, 1 in 2 in the UK, and these statistics apply to Western Europe, North America, etc. It's a common disease, and unfortunately, it's a common killer of patients' cancer. The technology that we have allows us also to develop human proteins that can kill coronavirus, whether it's Corona A, Omicron, Omega, or anything. We can develop cytotoxic treatments against the coronavirus based on the same technology that allows us to deliver human protein to areas of disease. And for those of you who like cartoons, this is our technology. It's a protein that is made of 3.5 helices. It's a helical structure, which it has two advantages. This protein can go in and out of every cell unnoticed. It's a stealth protein, which is very interesting. It's harmless. It goes in and out of every cell in the body. However, it has a little hook at one end, which allows us to attach something that can kill specific cells. So in this case, our main area is cancer. We attach proteins that block and destroy the mutated cancer cell. Or we can attach an antibody that can destroy the virus. So this is really our platform technology and what we try to do with it. So our solution for serious illnesses in humans, including cancer and coronavirus, is this, is the platform technology that our products are human products made of human proteins, some of which we already have in our body, is non-immunogenic. You give it, doesn't cause any reactions, is non-toxic because it's a human protein, and is well tolerated because it's a human protein. We're developing human protein for a therapeutic purpose. Our pipeline is simple. We have 4 products in development. One we call S4. It binds to a receptor in mutations. A mutation is called Notch. And this mutation is of interest because it's highly expressed in hormone-resistant relapse prostate cancer. Prostate cancer is normally treated with hormones, but after a few years, there is relapse of the disease. And as the disease gets more aggressive and relapse, something is switched on, the so-called Notch receptor, which shows you that the cancer cell is dangerous, is resistant to treatment, it can spread and kill the patient. So our drug blocks Notch mutation. The second drug, and that's the most advanced, we're ready to go into clinical trials. The second product, AB1, blocks another mutation known as P53. P53 is expressed on more than 55% of all human cancers. So we don't choose the patients on what disease they have. We choose the patient on what mutation they have. And for whatever mutation they have, we can give them this drug or that drug. And finally, as a spin-off during the lockdown period, we realized that our technology that can deliver any protein to any other cell, we can deliver a small part of an antibody that can inhibit viral replication. If you inhibit replication of coronavirus, that virus is dead. So we have granted patents in North America, in Europe. So we have an extensive patent portfolio. We're manufacturing human proteins, which is actually quite a low cost. Proteins that we're developing have exquisite specificity against other proteins. Like human body is made of proteins. So you need a protein to talk to another protein. All the chemicals people develop are artificial. The body is not really born to tolerate chemicals. So it's well tolerated because I keep saying we're rechanneling human protein. And this is a great team. For the purpose of this meeting, we have Sarah Nawaz, our business developer and fundraiser. She's in the audience. Any of you can get more information from her. Mahindra Denoren, going backwards, Mahindra Denoren is the chief scientist in our laboratories. Our laboratories are in the government biocatalyst at Stephen H. And he's running our laboratories. Larry Cohn, who is in the audience here, is an expert. He's a lawyer with experience and expertise in patent law, etc. So it's very important, whatever you have to be strongly patented. Raymond Mollering is a professor of chemistry at the University of Chicago. He came out of Harvard, went to San Diego, Scripps, and now he's in. And basically, what I presented to you is our sort of iPhone number 1. Raymond is working on iPhone number 2, 3, 4, and 5. We need to continuously developing an R&D because in research and development, you can either go forwards or backwards. You cannot stay still. So we need to, whatever we have, we think is extremely exciting, but we keep improving it. And just, we have a strong advisory board, either from Harvard, John Astor in pathology, Sir Walter Bodmer and Adrian Harris from Oxford University, which want to do the clinical studies. He was the head of the human genome. Cambridge University, somebody who is into the genetics of the Notch pathway. UCL and so. So we are very pleased with that. The oncology market, I'm not going to say anything that is big and is growing fast. And the same thing with the virology market. This is outside the vaccine. I'm not talking about the COVID vaccine. This is about therapeutics that can destroy the virus. Because with the COVID vaccine has been a fantastic success, but you need at least 2 vaccinations plus a booster. And for how long? And it would appear that you need to repeat it every 4 months or so. How long can you keep repeating it? It may have side effects, and it may also cause problems in the longer term. So we want something directly that can kill the virus. And these magic circles is with these fantastic numbers. Basically, S4 is telling us how many people are in the world at the moment that have relapsed prostate cancer. Now, we're not going to treat everybody in the world today. If we focus just in the UK, the serviceable market, even in the UK today, which we have only allowed 10% of the people in the UK with this disease, is still substantial. The other one, the AP1, which is the P53, is a much commoner mutation, and again, it's bigger, and the COVID is also substantial. But these are interesting figures. So our revenue stream could be either from licensing out our platform technology. Somebody else may wish to develop our platform technology for its own product. For example, in neurology, you may want to deliver a product that can go in the brain. And of course, our proposed exit is that what I've just told you is being shown convincingly on preclinical models, either at Imperial College or elsewhere. What do we wish to do for the next 3 years? We want to demonstrate the same effect in humans. And the effect we want to demonstrate is that the drug is safe and effective. And these are the collaborators. Again, these are people that we engage on specific projects. I'm not going to go through every single one individually. So basically, we're aiming to raise a Series A round of just under 10 million pounds to allow us to accelerate the R&D program. And this is really, we have this proposal. Again, to summarize, if I'm allowed 30 seconds to summarize, cancer is a disease caused by mutation of normal cells. Number 2, we have a technology that can destroy these mutations in these dangerous cells. Number 3, the same technology can be used to destroy viruses because viruses in the human body are quite strange and foreign. They can be addressed. However, it will take us 3 to 5 years to finish our clinical evaluation, to show clinically that our drug is safe and effective. And at that point, we would expect a bigger pharmaceutical company that has a potential to market things worldwide to buy us for in excess of $1 billion. I'm using this word in excess of $1 billion because if you look at similar companies that exited, this is actually an undervaluation. But even if one drug works, so basically as an investor, you come in with 10 million at the moment, or 9.5. You wait for 3 years to 5 years, and you wake up, and then we have something very substantial. Thank you very much.
Fantastic. Thank you so much. So we now have a short 10-minute break. So feel free to go and chat to any of the founders that are interesting to you. Have a cup of tea or coffee, and we'll see you in 10 minutes for some more presentations. Great.
In a fast-paced world, time spent navigating the ins and outs of raising capital can either make or kill a business idea. This adds complexity to your life, keeping you up at night. Where do you start? Failing to raise can mean setbacks. Losing momentum and shareholder support can make your vision seem out of reach. For most, backing by VCs are hard to come by. They only back about 1 out of 100 ventures they see. So, what are your other options? And if you get a pool of them, then what? It takes talking to 30 qualified investors to land one. And if your idea is a big one, you might need more. Well, say hello to Wholesale Investor, a global leading investment platform. We're on a mission to give you access to an expansive pool of investors. At last, ditch the uncertainty. Use state-of-the-art AI to cast a wide net. Want to grow at scale? Why not pitch at scale? And zero in on investors that are a match for you. Our platform, Chris, works hard on making you visible 24/7 so you can get a faster yes in your very own deal room. Your dashboard gives you oversight, empowering you to know your next move, getting you to a faster yes, and freeing you up to focus on getting to the exit line while keeping 100% of what you raise. Our successful clients know that building a business is hard enough without the ongoing pressure of raising capital. That's why we make it easy to expand your network from the palm of your hand. So to get to a faster yes, ask yourself, are you ready to get backed? In a fast-paced world, time spent navigating the ins and outs of raising capital can either make or kill a business idea. This adds complexity to your life, keeping you up at night. Where do you start? Failing to raise can mean setbacks. Losing momentum and shareholder support can make your vision seem out of reach. For most, backing by VCs are hard to come by. They only back about 1 out of 100 ventures they see. So, what are your other options? And if you get a pool of them, then what? It takes talking to 30 qualified investors to land one. And if your idea is a big one, you might need more. Well, say hello to Wholesale Investor, a global leading investment platform. We're on a mission to give you access to an expansive pool of investors. At last, ditch the uncertainty. Use state-of-the-art AI to cast a wide net. Want to grow at scale? Why not pitch at scale? And zero in on investors that are a match for you. Our platform, Chris, works hard on making you visible 24/7 so you can get a faster yes in your very own deal room. Your dashboard gives you oversight, empowering you to know your next move, getting you to a faster yes, and freeing you up to focus on getting to the exit line while keeping 100% of what you raise. Our successful clients know that building a business is hard enough without the ongoing pressure of raising capital. That's why we make it easy to expand your network from the palm of your hand. So to get to a faster yes, ask yourself, are you ready to get backed?
Hi, everyone. So we're going to be starting off the next session of the day with Marcus Ballinghouse, founder and CEO of Scalable Global Solutions.
Does it work? Yeah. Cool. Hi there. I've been told 8 minutes, so no time to waste. Forgive me if I'm too fast or too excited about my baby. So therefore, I try to be as quick as possible. A few words to myself. I originate from the southern part of Germany. So if you've never been, Lake of Constance Go is beautiful. So I'm neither Croatian, don't speak Croatian, but have put my company into Croatia. My career, I spent the past 25 years in companies like Cisco, Juniper, Microsoft, Xerox, and ATI. I have helped to co-build 2 startup companies before. First one, Parabit Networks, successfully sold to Juniper. Better? Yes. Second one, Whale Communications, sold to Microsoft. We called it Secure Application Aware Remote Access. Now it's called Microsoft SharePoint Portal. So coming to SGS, I invented DAS, Department as a Solution. It needs a little bit of explanation, even though I think DAS is self-explanatory by itself, but let's go into this. Imagine every company has departments anywhere in the world or anywhere in Europe, and they employ the people in those departments. They have selected them, interviewed them, and integrated them. And I basically say you can do all of this with us in Zagreb in Croatia. So next slide. So we make it easy to implement, employ, pay, support, and manage team and departments for you in Croatia. The benefit of doing so is we solve 4 problems for clients. Business growth, they can get the people they need in the time they need. I have a client in Munich who needs development engineers for optoelectronic sensors, and he loses 25% of staff to Siemens, to BMW, to Audi, because these are the big corporations. He has just 480 employees and 40 in R&D. So guess who has no problems finding and keeping top talent, and guess who has massive problems finding and keeping them? We solve that problem for him. Operational cost reduction up to 50%. It's usually bigger. Finding and keeping the employees and efficiency increase by 15%. Another fact about people in Croatia and the Balkan is they work 15% more than Western European people due to bank holidays and work environment hours. Headquartered in Zagreb, we're a business-to-business solution. We cover 8 corporate functions of companies with multiple sub-departments within each. We're currently in the seed stage. Since the start, we raised 1.6 million. In the seed stage, I'm now looking for the remaining 2.3 million. It was 2.9, but in September, we had an investment round. And just 3 weeks ago, I closed an investment round. So now I'm at 2.3 million I'm looking for. We want to use the money to accelerate sales and implement growth channel partnerships, so to sell indirectly via channel partners like the big ones do, Cisco, Juniper, Microsoft, Apple, etc. What's the problem? Our target audience is small, medium-sized enterprises. So companies between 50 and 5,000 employees. That's 96% of the worldwide market. That's 96% of the UK. So these people have the following problems. 61% have operational cost increase since 2019. 50% have a market shortage of competent and skilled talent in 2024. This morning, when I heard from the gentleman regarding the public affairs, then he basically stated there is enormous shortage. Solution. So department as a solution, we make it easy for you to create your teams in our country. You retain 100% of control of your team, so it has nothing to do with outsourcing. It is legal and compliance, 50% more affordable talent than in Central and Northern and Western Europe. And we deliver the piece of software, SGS1, who helps you to run, maintain, and manage your departments. It's basically like a light version of SAP, Oracle, Microsoft. So from the competitive map, services, all departments, is on the top, and to the right is 100% control of operations. Our target audience has never outsourced, and they don't like outsource. They fear loss of control, and they fear that knowledge walks outside the house. With the department as a solution, neither of that is happening. The market potential pre-corona, let me repeat that, pre-corona, it's 353 billion and 44 here. Now, I worked in the tornado market called the IT industry in the 1980s and 90s. All analysts predicted how this will grow. And over 20 years, none of them ever got it right. The real numbers were much higher than reality. So the sky wasn't the limit. I believe that the next decade, this will be a tornado market. And this is all thanks to Corona. Because now the small, medium-sized enterprise companies have actually realized that working from home is a possibility. Well, if that is a possibility, they can work from Croatia, where you save 50% of your cost of operation. So client study, that's a typical client. We sign clients usually with 2, 3, 4, 5 people, and then they realize how wonderful this works and that they keep everything under their control, have selected and trained the people, manage and operate them. So a customer who started with 3 people in our contract will be, by the end of this year, 30 people, probably 70 or 80, and then grow over the next year. So this is the typical development of a customer being implemented with us. We will break even by the end of quarter 4 this year. So we're searching, we want 2.3 million for 18% of the equity. We're currently evaluated 10,845,000. By the conversations we had with current VCs and family offices, they all said, we think you are undervaluated, so we have started a new evaluation process for the organizations. Milestones, and then I'll be finished. We signed clients, 44% monthly revenue growth since December, raised 1.6 million today, launched a channel partner network. One way of selling is direct sales, more like by Global, Cisco, Apple, by many sellers. We implement the same. The beauty about that is you train people, knowledge about consulting, cost saving, our solution. That's why we want to sign up 200 consulting partners here, and about 500 trained people, not on our So I hope I could raise a little bit of your interest, and you're welcome to come to our booth and talk about this in more detail. I think is a wonderful solution, and the fact that we already have so much traction. Our pipeline is 4.5 million already, and I have 2 salespeople. So imagine what I could do with 10, 20, and an entire channel organization. Thank you very much for your attention. Pleasure to be here.
Thank you so much, Marcus. Next, we have Chris Moore, co-founder and CEO of Pick a Play.
Okay, hello everyone. My name is Chris Moore, and I'm the CEO and co-founder of KickPay. I'm here today with my co-founder, Philip Godden, and together we set up KickPay. We are a market-leading payment provider leveraging open banking, and we are disrupting the card payment market. We saw inefficiencies in the way payments were collected by both small and large merchants, both online and in the high street. They pay too much and receive a poor service. And those costs are passed on to customers, but also the use of cards sometimes the most vulnerable in society pay the most, and we see that as unfair. Our solution is fair, fast, and secure. We have a great leadership team with experience in payments and shaping the industry at government and at industry level. We have experience in integrating solutions into large companies, into their billing and finance systems, as well as experience in setting up startups and supporting the tech through a growth phase, as well as in business development in payments. We have a fantastic support team. Tim was a ex-partner of Deloitte's, heading up their core banking and payments division. Pat, at the back, you can just put your hand up, ex-CIO of Virgin Media. We have an amazing set of partners already supporting our business, and we're connected to 99% of all UK bank accounts to provide this service. So what's the problem we're trying to solve? Well, for many years, the card payment market has had many intermediaries and many different companies that make up the industry, making it complicated and slow. It's expensive. We did some research with BT and found even for the biggest of companies, for £100 payment, it costs them about 87 pence. But for normal companies, it's anything between £1 and £3 for a £100 payment. It's slow, taking 2 to 14 days for the merchant to receive the money, and it's insecure. You see on the news often about fraud and lost payments and declined payments from card. Kicker is the solution. Kicker sets up a direct from bank payment from the customer's bank account to the merchant. It is fair because we charge a flat fee for our transactions, normally at 80% cost reduction for the merchant. It's fast. It's immediate settlement with between 1 and 2 seconds, so the merchant receives the money immediately, and it's secure, virtually eliminating fraud. And indeed now, the payment is guaranteed by the customer's bank, taking the risk away from the merchant. The merchants love it. The customers who use Kicker love it too. Come to our stand after the presentation and we'll show you a demonstration. Or if you get your cameras ready, on the last slide, there's a QR code that you can scan and make a donation to a charity just to see the journey, how easy it is. But it's smooth. There are far fewer taps that the customer has to make in order to make the payment. It's familiar because you get fast in the payment journey to the bank that you'll commonly use on your mobile or on the internet, and it's secure. The only place the money can go is to the merchant's bank account. We launched last year and have an amazing set of early clients, including Northumbria Water and MasterCard for a European product. We're in discussions with a number of leading brands and channel partners, including companies like Cognizant, Western Union, and BT. And BT are looking to take our product potentially and sell it to their clients. And we've got an amazing set of leads, warm leads that we could take as well. We just need now the people to go out to these companies and sell our product. That's why we need the investment for business development. The market we're looking to approach is huge. 540 billion card transactions every year globally. And all of those will be moved to a push payment in the next 15 to 20 years. Open banking is the best example of a push payment globally. And the UK is leading the market in open banking, and we are at the forefront of open banking. We've selected a certain number of sectors we're going to go after, and we predict 75 million transactions by the end of 2024. There are competitors in our market, but we're different. We have a great customer experience, no friction, no app needed, as you can see if you try it. It's flexible. We have different integration solutions for large companies, which they really appreciate because billing is very important to our clients. It's error-free. We have a reconciliation engine, and we understand the need for a brand. We want to be like PayPal in the future with a customer-facing brand. We're now taking it to the next stage and adding functionality to our product. Charities, we have gift aid. Retail, we have a contactless, touchless checkout where you have an embedded payment solution, which is Ticker. And our latest development is Help to Pay, which is to add intelligence to payments so that customers struggling to pay their utility bills have one place and the best place to go for help for those for paying their bills, be it a flexible way to pay as you earn, or just understanding the better tariff that they might be on or specialist help. The ask today is for 400,000 at a valuation of 6.5. This is a bridging round because we're raising later this year at more than double the valuation, we believe, Q4. This has tremendous exit opportunities, particularly in trade, simply because of the interest in this sector at the moment. Please feel free to scan the code and try and make a payment. This is for to a charity that's helping Syrian and Ukrainian refugees, and you can see the payment journey itself. Thank you very much.
Thank you so much, Chris. Next up, we have Adam Callow, co-founder and CEO of MyBricks Finance.
Are we on? Can you hear me, guys? We good? Thank you. Quick question, who's heard of the blockchain? Let's get everyone moving just a little bit. Blockchain, cool. NFTs, cryptocurrency. Those of you that are smiling today are happy with the Bitcoin price. No. Guys, quick introduction. My name is Adam. I'm the co-founder and CEO of MyBricks. What we do is we leverage the power of new technology to increase efficiencies in property investment. That new technology is the blockchain, smart contracts, and NFTs, making a very high barrier asset class properties accessible to everyone. The problem is, we all know property is one of the most tried, trusted, reliable asset classes, but you basically need too much time, too many money, and too many contacts to make it work. It's just the barriers are too high for everyday people like myself, so I wanted to fix it. So how do we do that? Well, this is our mission. We're trying to make property investment accessible to everyone and deliver extraordinary returns for ordinary people. And we do this by giving people contractual fractional ownership of real world assets. A great question outside. Someone said, is this in the metaverse? Oh no, these are real bricks and mortar properties that we break into thousands of little pieces and make it so anybody can invest as much as £10 into the property space. Let me just talk you through a model. So firstly at MyBricks, we take a bunch of capital and we invest it in property. With my team and our team's experience, we add value to that property portfolio. Let's just say we take a property portfolio for 1 million quid, we put 300k into it, and now it's worth 1.5 after the renovation stage. We add some value during that time. Next, we do something called minting. You don't need to understand what that is. That's basically the creation of an NFT. And NFTs aren't just pretty pictures. The underlying technology is really cool, really smart, and it allows us to access information. Allows us to give contractual ownership to a real-world asset, such as a property, to any user on the platform. We then sell those NFTs to our community. They can pay what's called a fiat, cash, or in our own utility token called the Bricks token. Then our user has contractual fractional ownership of that property. And we're really focusing on short-term rental properties, specifically those properties that do well on the Airbnb market, where people are staycationing more and more in the UK. Our users receive this yield on a monthly basis. Again, because of the use of blockchain and cryptocurrency, this process is completely seamless, allowing people to invest as little as £10 because we remove all these headaches and all these legal fees that have made these barriers too high so far. Then, very simply put, we just repeat the process. So we take a portfolio, we add some value, we fractionalize it, we sell it, and we repeat. And over time, we increase our properties under management, which is one way that we make money. In terms of the market size,
These numbers are always fun to put on a slide because everyone goes, well, where do we get these from? So I've really tried to zoom it into the smallest opportunity that we can focus on right now, which is on the right hand side, which is the £450 million, which is 5% penetration of the UK short-term rental market. In terms of live property, we all know it's reliable. Problem is, barriers are too high. So on a 20-year risk-adjusted profile, we can see that risk volatility is low, but the yields are consistent and high. This is an asset class we all want to participate in, but we don't because it's too complicated until now. In terms of now, these three things have come together. Firstly, technology. What we're doing, to be honest, isn't brand new. It happens in the form of crowdfunding in REITs today, but the ability to choose your own property, the ability to pick your own portfolio, actually be part of a property you yourself can stay at, and by holding our token receive benefits from. This is only possible with blockchain, smart contracts, and NFTs. Next, growing market continues to grow. The short-term rental market in places like Airbnb continue to outperform hotels and service departments. That's not going anywhere. COVID's actually accelerated this. And third, we've got new investors. Generations are getting more educated at a younger, faster clip. We've all seen the likes of Robinhood that allow you to not only buy a share in a property, share in a company, but a fractional share in a company, which has made it more accessible. We're doing that for property. In terms of where we make money, 4 ways. Firstly, we create value through the renovation process. Secondly, it's property management fees. We take 15% of the properties under management. They're the properties that are on places like Airbnb. We manage those properties. Third, we have the BRICS token, which is that utility token that people can invest in that unlocks more benefits on the platform. As an aside, that's how we've completely funded the business today. We've had no external capital. We've purchased 2 properties outright, spent 6 figures on technology, and currently going through the FCA legal process for authorization. And fourth is the secondary market NFT sales. I understand that probably sounds like a lot of jargon to most people in the room, which I appreciate because it kind of is. What this basically means is we have a very illiquid asset normally in property, and we make it liquid because you own that property as an NFT. It is contractual, but you can wake up today and go, actually, my life has changed. I need to dispose of this £5,000 ownership I have of this property. You can go to our market and sell it. So we take a very illiquid asset and make it liquid also, which is great for the user. In terms of a couple of small successes, our first property is complete. We bought it at a place called Callington. It's now on Airbnb. If any of you do want to stay, hit me up afterwards. I will give you a discount code. We're looking for good reviews. Next, we have a property in Red Roof that we completed on 3 weeks ago. That'll be on Airbnb by the end of next month. Again, there's no finance against these properties. These are purchased outright, and we'll make up our first portfolio when the platform goes live. In terms of our partners, all incredibly important for the success of the business. One, we've got Tech Alchemy, award-winning technology platform. Trustology, which is the only FCA authorized custodial wallet provider in the UK. Again, that's a lot of words in a sentence. What that basically means, it's a secure wallet that is regulated and covers a user up to £70,000 worth of assets. Then we have places like Persona, because KYC, know your customer, is incredibly important. What's that what you're doing there? I've got 2 minutes. That's Persona. And then we've got MoonPay, which makes it very easy to access our cryptocurrency platform. We don't want to be thought of as a crypto project. We are a property project that is just increasing efficiencies using crypto technology. These guys allow you to put a debit or credit card in and access the platform. And last is the Growth Foundation, which is our marketing partner. These are the people that have taken places like Gymshark to a $1 billion valuation, and they're helping us scale this once we pass the FCA authorization process. In terms of the team, personally, I spent the last 13 years building my career in the construction sector, the whole vertical from selling building materials to running a community of over 27,000 trades. So we've got property renovation nailed. We've got Alex, who's the head of electronics, amazing at deal flow, worked for a company doing deals in the crypto space for the last 7 years. We've got an operational expert in the business called Sam, and we have 2 award-winning creators of content and marketers in the team. That's our founding team. In terms of the ask, we're raising £600,000 as a convertible note that will then be part of a £2 million raise once we get our FCA authorization. The reason we're doing it this way is because we understand there's risk. As an investor, we want to de-risk it for you. All of that 600K is going to be spent on properties. We just want more properties on the platform when it goes live. And it's de-risked because your cash will never leave the balance sheet. What does that mean? It means it's always in cash in the bank or it's in a property. We will only convert it into equity once we get our FCA authorization, which is due in 5 to 10 months' time. Any questions, guys? We'd love to hang you at the end. Very quick. Oh, I've got 30 seconds. Any questions? Yeah, let's go. 30 seconds. Exactly that. So for every portfolio, we create an SPV. So we purchase it, put the property into the SPV. Our company ends up on the transfer form at the land registry, but your contract is ownership of that SPV. Perfect. Both. So when we're doing properties that are worth over £1 million, one property into one SPV. If it's a smaller value, we'll bundle multiple properties into one portfolio into that SPV. No worries.
Oh.
Yep. Completely agree. Yep. So when we went live, we launched our BRICS token. We've got 5,500 people today that have and own our token. That will create our first form of liquidity on our secondary marketplace. Hope that helps.
We can ask questions. Can you ask questions afterwards?
Sorry, couldn't help myself. I apologise. Guys, thank you so much.
Thank you so much, Adam. Now we have Andrew Ducanaris, CEO of Blue Kite Group Limited.
Thank you. So I always say doing this, but can you hear me? Because if you can't, then there's a problem. So good morning, everybody. I need my clicker. I'm Andrew Ducanaris, representing Blue Kite here today. Now, you may never heard of us, but you will do in the future. But before we start, I've got some terrible news for you. Cash is no longer king. Cash is now dead. And as our good friends from Kika mentioned this morning, there's going to be a new way to pay very soon. And that very soon is now. So I'm going to tell you about our journey and how we're going to make a big difference to card payments and to digital payments. The other way. Just the arrow. Okay. So we're going to be first open banking network. Now, you heard Kika talk this morning, a little while ago, about how they're also in that space. What does that do? That tells me, and hopefully tells you as investors, that we've come up with the right solution. Now, Kika talked about, and I don't want to spend a lot of time talking about Kika, but Paul mentioned this morning that when you invest, you should look about the people that are investing with as well. I spent 10 years at Visa. Many of you took a taxi here this morning and hopefully paid by card in that taxi. That was me. That wasn't anybody else. That was myself and my team. We launched that project here in London just before the London Olympics. And the biggest challenge was not how do we get the technology, but how do we persuade the merchant that this is the right thing to do? And the merchant in those days was the cab driver, who in those days paid something like 17% of their revenue to their schemes in order to accept cards. Now, we broke that system. Fortunately, working for a very large organization and working with the mayor's office, we persuaded the people in London and the mayor's office that actually people coming to London didn't want to fork out in cash. They wanted to pay digitally because it was safe and secure. So the argument around using cash has kind of disappeared. COVID has accelerated that. We've seen cash payments decline, and many of you are now using contactless and paying up to £100 using contactless. But for the merchant, I don't think many people have stopped and thought, what does this mean for the merchant in terms of costs for their business? As their share of digital payments goes up, the cost of their running their business has also increased. What we're trying to develop is something that will reduce the cost of running that business. So the problem today, many of the systems that are out there are outdated. They work very well, but they're outdated. One issue that we worry about is security. It's easy to clone your card, adaptability, and the focus on who the customer is. Now, the consequence of that is, as I mentioned, high cost for merchants because they pay a high fee to their acquirers and to their banking partners. The delayed settlement. Now, many of us will know when you talk to small businesses, their biggest issue is cash flow. When they wait 3 days in order to receive a settlement from a card fee or a card payment, that can be make or break, especially today when suppliers are trying to pull in funds earlier. So what this system will do is that it's an immediate payment. The moment you use your card, that merchant receives their money. They don't wait 2 or 3 days or up to 10 days. So that's a huge difference for the merchant. There's hardly any fraud because our system uses bank-to-bank account.
You use your account, it goes directly into the merchant's account. So our solution, as I say, is instantaneous. And one of the biggest differences here is we will be on the high street in stores. This isn't just an online thing. This is to make sure that merchants in stores can accept payments today using the technology that we will create and using open banking. Now, we could have put a number of companies on here to say this is what we do, and you would expect me to show this. So here's what we do, and here's what some other people don't do. And I think the biggest thing that we should take away from here is the top line. We're no longer reliant today on the large organizations, and I worked for the two of the largest, both Visa and JCB, around the world. And most payments today are reliant on using their network. So whether you use Apple Pay today, Samsung Pay, there's a card payment behind that and a plastic card, which means the merchant has to pay a fee again to somebody else. That hurts the merchant. We're taking that away because it's a direct payment to and from us. So we talked a little about the touch points. We're reducing the touch points. It's us and the merchant, and of course the people using our technology. So the friction is just between two people. It doesn't include all of these other parties who are also fighting for margin in that space. Market is huge, as always. You'd expect us to put a slide up here that talks about just how much money is going through. These numbers are probably already out of date because what COVID has done is to generate more and more digital payments, and this is just the UK. If we look at the huge opportunity, Town, Sound and Som, a huge number of payments can go through. But we're being realistic, and I think probably quite conservative, at saying there's about 500 million digital payments, but that number is increasing daily. So where are we now? Where do we plan to get to? One of the things that I'm excited about joining Blue Kite was I can bring my international experience. I've lived and worked in New York, San Francisco, Singapore, and I've ran payments across 120 countries. I've worked on the merchant space, so I understand the merchant pain. And so what we're planning to do is not just to launch in the UK, but with your investment to become international. And again, the point that Paul Webster was making this morning was looking at beyond the boundaries of just the UK. Our fees and our income will come from a number of places, but the biggest one is from the transaction fees, which will be much lower than what merchants pay today, but it forms the basis of our revenue. We'll start to look at some other things as well. Buy now, pay later is an interesting area, but it's one that we need to be very careful to make sure we steer the merchant in the right direction. But it shows you that we'll have not just payments, but value-added services in terms of handling money from currency conversion, and then also looking at where we sell the terminals to the merchants, but hopefully they become very self-funded very quickly. So, our slide here, we think we'll get to about IPO and exit in a couple of years' time, and we're running out of time. So just want to focus on terminal rollout in the UK. We think that within about 2 years, we'll get to around about 200,000 terminals being deployed in the UK. The first 3,000 will go out before the end of this year, so active and operating. And our call for today is we're looking for £5 million to make that happen. And you can see how we're going to be spending your money in our business as well. And that 5 million gives you about 16.5% in our business. A group of masters, leaders, whatever you want to call us, of people with experience. We've had our fingers burnt, we've been successful, but we know what we're doing, and we've worked around the globe to try and deliver this. So please, look, you're going to hear a lot of stats, a lot of information. Why don't you come and talk to us? We're right down at the end on the far right-hand side, and we'd love to talk to you more about what we're developing and how that can help the merchant community. So thanks so much for your time this morning.
Fantastic. Thank you, Andrew. Next up, we have Guillaume Kendall, CEO and founder from Sedosh.
Good afternoon, everyone. Can you hear me? My name's Guillaume. People call me G, and I'm the founder of Sedosh. Our AI-driven attention exchange is the first regulated marketplace for consumer attention. How much is your attention worth? Really, what's it worth? What's it worth to McDonald's? What's it worth to American Golf? What's it worth to, I don't know, Apple? Or what's it worth to me? Without knowing many of you here today, I've chosen that it's enough of value in order to pay the wholesale investor for this platform. But actually, if any of you decide to share your transaction info with me, your bank account, what's within it, I would know, unfortunately, that only a very small percentage of you are actually relevant attention holders for me today. And that's what we built with our attention exchange. We've basically, the summary of our attention is what ultimately our lives are comprised of. We spend 4,000 weeks on Earth, so why are we spending so much time giving our attention away for free to big tech? Actually, it's far worse than that. You're paying big tech. Advertisers are paying them in order to access your attention whilst you use these platforms online. And of course, you'll say, well, that's great, but I get free access to YouTube and Twitter, LinkedIn. Advertising is a small burden to pay in order to get access to this amazing platforms and content. It doesn't have to be that way. In fact, I'm pretty sure if you're using YouTube today, when an advert appears in the middle of your screen, the first thing your attention does is move to the bottom right. Why is that? Because that's where the skip button is. That's not a good experience for the advertiser. That's not a good experience for you. So why are we putting up with it? Advertising doesn't have to be crap, right? People pay premium prices to go ad-free. We think open banking enables that entire ecosystem to be turned on its head. Your attention is funding a $400 billion market. It astounds me to know that over $150 billion of that will be lost to ad fraud by 2025. We just soak that in. $150 billion gets lost to fraudulent clicks, fraudulent accounts, duplicate accounts, just bots. Real people in real click farms are basically taking money, $150 billion of it, and putting it in their pockets instead. Have you seen any of that money in your bank account? Neither had we. And they're laughing, right? Laughing all the way to the bank. And we think it's time to change that. So we built a solution, fortunately. Our attention exchange enables brands to get direct access to immutably relevant consumer attention because they know they're worth it. And in exchange, they pay them for it in cash directly to the account. That 400 billion, Robin Hood style, we're putting it into the consumer's pocket. Well, how do they do that? Use open banking. Our consumers connect to our platform, Zedosh, and give us immutable access to their transaction data. No guessing. We know exactly where they spend their money. We know exactly how much money they make. And we know, therefore, what their attention is worth to brands. And why would brands want access to it? Why would consumers do that? Because they get paid. Using faster payments, and there's a lot of payment pitches today, using faster payments, we use straight, immediate, no limited, not cashback, not any sort of other token or voucher. Cash goes instantly and directly into the consumer's bank account. And brands are starting to like it. Now, I need to look into my eating habits, but this is where I spend my money with Deliveroo, right? And yet, Just Eat spent 314 million on advertising in 2020, 5 million went to Snoop, and I didn't see a single penny of it, despite the fact that I spent £4,030.94 on Deliveroo last year. So we're making that right. We've launched Zedosh. Zedosh is a fintech application that does many of the things you'd expect for a fintech app to do. It looks at your spending, it categorizes it for you, it puts it in different buckets, it gives you trend analysis when you're spending. What it also has is a unique advertising model. Our consumers don't pay to go premium ad-free, our consumers get paid to be advertised to. Right? This is Benno, one of our customers. What else then is that over 10,000 users now are sharing their live transactions with us in the UK. We're growing at about 1,000 downloads a week at the moment. And we're today 140th in the App Store charts. And our user acquisition cost is a fraction of the average fintech app download cost. The reason is because of advertising, not despite advertising. Take that in for a second. That's a real transaction coming into my bank account. Watch Benno's message. There we are, the top 20. I'll point out that the value of the businesses above us was $770 billion. That's a lot of value above us, and yet we spent under $500,000 getting there. Our average revenue is £1,000 per brand. We keep 80% of that revenue to ourselves, run our business. 20% gets redistributed to the consumer instantly, directly by their payment. And it works, right? The first thing that people say to me is, well, then people just watch all the ads and just get the money and that's it. two things. One, if you don't have any money, you don't spend any money, you're not getting any ads. Right? Your attention is worthless, I'm afraid. Right? I mentioned the fact that people share their banking transactions. This is it. We know the value of attention. And what's more is that the fact that they're invested, well, this advert from Panair, 1 minute 58. When was the last time you spent 1 minute 58 watching an advert online? Never? Right, okay. So yeah, 20% of people who watch that ad click through to Panair's website. Facebook's average, 0.89. And bear in mind, a view on Facebook is 3 seconds. And of course, just you left your phone accidentally, right? Our completion rate and our users only get paid, the brand only pays on a unique, full completed 100% view. Oops. Our brands that we're working with, great. And Mark is third. Now, I think we have a once in a lifetime, once in a generation ability now to take benefit of this unique moment in time. That's a 40% loss of share price. And it's because it's driven by iOS and transparency, turns out being on TikTok and fast platforms, attention is very difficult to get hold of. So what we're doing now is raising a bridge round of 500,000 by an EIS qualifying a subscription agreement in order to build an API that enables other apps to connect to our attention exchange. We're building infrastructure here, not an application. We've got a letter of intent signed with SUNY. You have 250,000 UK students signed up, and that will enable us to use our exposure to Apple and Google. Hopefully, start competing with Google. This morning, there's a lot of focus on building building bridges, I guess. We're enabling other apps competing with us. That's a smart idea to do that. It's easier to try. And then 1%, 150 billion plus app for help. Thank you for your attention. Please feel free to download our app, get paid for the today, and if you want to ask questions, I'm down there on the right hand side. Thank you.
Brilliant. Thank you, G. Next, we have Angelique Mooring, CEO and founder of GainX.
And now we're green. Everybody can hear me okay? Good afternoon. My name is Angelique Mooring, and I'm the CEO and the founder of GainX. GainX is an enterprise platform that provides decision intelligence to executives, leaders, and the board exclusively that are managing complex businesses, strategies, and programs today, which is pretty much every leader. We know that we're in a new economy. It goes without saying. In 2020, GainX made a decision to rebuild and redesign our platform. We did so by expanding the IP, rebuilding the architecture, bringing in cost strategies, underpinning all of those insights with those cost strategies for executives. Piloted that platform with the Big Four last year and a top 20 global bank. The bank then, impressed by the findings, decided to have a Big Four independently validate our findings. It all went very, very successful. This year, the Big Four, PwC, has moved to year multi-million contracts in a partnership with us, and the big bank to a 3-year multi-million pound client relationship with us as well. So we're proven in market. In just days, GainX platform can surface millions in immediate cost savings, predicted cost increase. Just a few examples of those. A low-hanging fruit for executives is our ability to look at large organizations and identify duplicate work. In one such organization, it was 31 million in duplicate work to take out of that cost budget this year immediately. 27% of resources not getting information that they need to do their job effectively. Show that in your typical hierarchical views. We also show it in network views. What this meant was nearly 20 million in productivity losses and 78 million in delays sitting across their portfolio that they were trying to deliver on. So that 27% certainly adds up. We've got further traction. We are on a short list for an HS2 pilot. Happy to talk about that over at our booth. We've got a strong direct pipeline of over 17 million. The partnership is worth 30 million over the next 3 years in forecast. We've also got an exciting launch with Microsoft. We've been working with them for some time now, in which we're going together with a joint solution. Their forecast is 500 million over the next 5 years on that. Ours is 19 million. We're pretty excited about that. How does it work? KNX ingests data from what we call 3 core themes. The first theme is the people data. Emails, chats, org charts, and so on. The second theme is the work that people are doing, or the project, productivity, work streams, projects, and so on. And the third is finance data. What are the executives spending on any given strategy or portfolio, and the resources that are involved? By ingesting those, we're able to deliver those cost findings as well as help them prevent dilution of their ROI. Reduce the compliance cloud, given the sensitivity of the data. We are system agnostic, so we can use and results. We definitely continued our focus on ensuring that our platform is secure, it's much more powerful, and it's very fast. We also made it much more modular. This means that it's very easy for us to now add transactional products. That first product, called KNX Perform, is what we're going to market with Microsoft on that I mentioned earlier. Why are we different? One of the reasons, and there are a few, is that we have years of anthropology and the math-heavy social network analysis built into our algorithms. I'm actually a published anthropologist and archaeologist, and I spent the last 20 years of my career as an executive working in enterprise software and technology. We've also spent millions just in the UX experience for executives. Importantly, our insights are horizontal and vertical. And by that, I mean we're providing decision intelligence driven by artificial intelligence that can go across a complex organization, multiple business units, multiple functions, multiple geographies, but it can also go vertical. We can look at a sales organization, we can look at a particular business unit, we can look at a different function. Oftentimes, competitor data becomes a source of data for us. Microsoft is a perfect example for that. One would expect that they would be competitive, and yet they've identified us as the top independent software vendor to work with them throughout the next couple of years. We're targeting 3 markets: transformation, work, productivity, sometimes their work, and the M&A market. The first 2 with the direct channel as well as our partners. The third one, we're going to go to market with partners. Importantly, we eliminate noise for executives today. And we all know that we're going to be getting bombarded with data. It tends to be complicated. We tend to have to compare apples to oranges. The platform is very configurable. If you're the COO, the CFO, or a member of board, configure your dashboard so that they're raising the information that you need the most. Again, we've got 3 core products in market that are proven. KNX Lens is the enterprise platform. KNX Perform is the one that is transactional and allows us that land and expand strategy. We have a fantastic team. Everyone on my management team has over 20 years of experience in their field of expertise, working for large organizations like IBM and Microsoft, some who have exited several startups of their own. We have an incredible board. Very excited that Leo Apothecare has recently joined our board. He's the previous CEO of SAP and KC and brings terrific mentorship and connect with him. We're currently raising 2.5 million. We want to beef up our ability to do marketing, to expand our sales channel, and to be able to service those contracts that we have. We have a really clear mission to be the global leader in this space and to work towards that £1 billion valuation within the next 5 to 7 years. Happy to share those details with you when you can see us at our event. We also have very strong social commitments. Our part of society is good. Lots of work in our so we've got board, we've got partners, and we've got traction.
love to share more with you about our 7-year roadmap that's going to take us from here, growing 4x year over year for the next 5 to 7 years.
Thank you so much, Angelique. Now we have Dr. Montagna Sylvester, CEO and founder of Nanosons.
Good morning. I'm Dr. Josep Montanyà, CEO and founder at Nanosons. We are a British startup in the field of semiconductors. If you open your smartphone, you will see something like this inside. So there is plenty of integrated circuits, chips, and about 10% of them are a special type of chips that have micro mechanical parts that move inside the chips. The reason why we want these mechanical parts inside the chips is to be able to implement a variety of sensors, so chips that can detect and measure movement, pressure, sound, gas, magnetic field, and also to build radio frequency circuits with super high performance. It would not be possible to do all this without these mechanical elements inside the chip. These chips with mechanical parts are called MEMS, and they are a large market of about $40 billion per year, growing at 7% per year. But actually, the market wants to grow a lot more because in the last years, there's been a new number of applications that have been defined, like in addition to smartphones that require MEMS chips, like smartwatches, wearables, IoT, RFIDs. All these applications have the potential to increase the market of MEMS chips by 2 orders of magnitude. So instead of selling billions of units, as happens today, we could be selling trillions of units in the market. No? But this has not happened because these applications require MEMS chips that are smaller, have lower cost, consume less, and somebody has to be able to produce this very large volume of chips. That's something that nobody can do today except Nanosons. The reason is that there is no manufacturing standard for MEMS today. So each company has its own manufacturing process. So the economy of scale is limited. However, for solid state chips, so that most of the chips that don't have mechanical parts inside, there is a de facto standard in the industry. It is called CMOS. So most semiconductor companies use a fabless model, outsourcing production to these mainstream foundries that are mainly located in Asia, but also that is changing quickly. At Nanosons, what we have managed to find is the way to use this standard manufacturing process for non-MEMS chips, CMOS, to build MEMS chips. And this way, we benefit from an existing huge economy of scale, which means that our chips are smaller, 10 to 20 times smaller, they have lower cost, they consume less, and we can produce in very large volumes. This means that Nanosons has a key technology to enable a massive deployment of the Internet of Things and to enable this explosion of the MEMS market. Our business model is to sell product. So we design our chips, we outsource production, and then we sell to our customers, which are the smartphone wearable companies, through our distributors. However, because we're using a manufacturing standard, it's unavoidable to have requests for IP. So intellectual property, it means selling the designs to other semiconductor companies so that they can embed the mechanical parts into the chips. Still, our focus initially is to sell product because this is what will give us a very large revenue in a short time frame. But longer term, selling IP is strategically important to increase even more the value of the company. We have many competitors because each one has a specific manufacturing process, so each competitor focuses on a given type of product. There are 3 exceptions: Bosch, ST, and Syndicate, because they are large companies and they have several manufacturing processes. At Nanosons, we can do everything because we don't have a specific manufacturing process. We use the manufacturing standard for non-MEMS chips, so we just adapt our designs to make whatever product we need. We are a pre-revenue company. We plan to start volume production next year. We have first samples, we have customers aligned, There's a customer has signed an LOI to buy 10 million chips per month, which means $18 million of revenue. Just this very first customer. We're talking to several smartphone companies. They want to evaluate our samples. There's a leading RF company in Europe that is in the process of evaluating our samples. So this year we need to make final samples and get everything ready for volume production. Supply chain is also refined with global mainstream players. And according to our business plan, sales forecast for next year will be 40 million pounds. And in 2 years, it will be 200 million pounds. We've been developing this technology for many years. We've invested 6 million pounds. Now we are fundraising a bridge round. We are finalizing it. We started it in December. Our goal was to raise 1 million pounds. We've already raised 2.3 million pounds. So actually, we wanted to finalize that, but I wanted to come to Emergence to see if there was somebody who wanted to join us in the last minute. So we will finalize the round this week, because then we need to move forward and start working on a Series A. The plan is to raise 12 million pounds at a high valuation before the end of this year. And then by the end of 2024, early 2025, we plan to IPO. According to our business plan, investing now in the bridge round, it means that in 3 years, we should get a return of more than 100. So the plan is to IPO in 3 years, but I'm sure there will be offers for trade acquisition before that. So when this happens, we'll see what we do. Who would be interested in acquiring our technology? There are basically 5 groups. First of all, our competition. What we are doing is a revolution in the semiconductor field. So once we are in the market, either our competitors buy us or they have a big problem. Then semiconductor companies that don't have MEMS technology, because acquiring our technology would be an easy way, a quick way to win the MEMS market and with a leading position. Then our customers, smartphone, wearable companies, to offer the advantages of our technology and exclusivity to their customers. CMOS foundries, again, to offer this technology to their customers, the semiconductor companies. And then also the big techs, because big techs are focused on artificial intelligence, but AI needs data, and data comes especially from sensors. So thanks to our technology, it's possible to deploy the largest sensor network in the planet. So thank you for your attention. I will be here all the day. So if you are interested in the bridge round, please talk to me today, because as I said, we will close the round this week. If somebody is interested in the Series A, so investing later at a high valuation, happy to talk again also. So thank you.
Thank you so much, Joseph. Now we have Webster Karamamet, founder and CEO of the Breath Hub. Sorry.
Do you hear my voice clearly? Okay. Hi, I'm Nevşa Fidan Karamehmet, founder, CEO of Breath Hub. Before I start my pitch today, I would like to take a moment for all of us to connect with the power of our breathing. So if we can all close our eyes and start breathing real deep, just a couple of breaths, a few deep breaths, to just connect with the power of our breathing. Right now, we're basically breathing in oxygen, carbon dioxide, nitric oxide, and also exhaling some of them. And some of these gases stay in our system and turn into ATP, pure life energy. That's why you can live without food and water for weeks, but without breathing, you die in a matter of minutes. The quality of our breathing determines the quality of our lives, and the better we breathe, the better we live. Our organs, our cells, our tissues stay alive and healthy because of our breath. So just take a moment to really feel that, the importance of that. And yet, millions of people are suffering from dysfunctional breathing habits and also the symptoms because of wrong breathing habits. Did you know that there are more than 200 scientifically proven symptoms of wrong breathing habits? Panic attack, anxiety, migraine, headaches, ADD, ADHD, many symptoms breathing disorders. Many symptoms people experience, they are because of long breathing. And these symptoms remain unsolved because people don't know the benefits of regular breath work, or even if they do, the access to breath work is very expensive and very limited. And these are some of the symptoms. We are offering Breath Hub is a guided breath work app for people who would like to stay healthy and well through practicing breath work. If you don't want to go through the process of trying to find a breath worker nearby or pay hundreds of pounds for a session, offer hundreds of guided breath work sessions and workshops and courses on one platform that can be accessed anywhere, anytime for a much lower price. With Breath Hub, you can heal more than 200 breathing-related symptoms. You can make breath work a daily habit, and with our unique algorithm based on behavioral sciences, you can start a customized journey by analyzing your breathing. In the end, you can have better health, better fitness, better appearance, better mindfulness, and better sleep. I founded Breath Hub a year and a half ago, but my journey with breathwork started 25 years ago. The first time I started breathwork, I was in a very dark space, depressed, out of control, feeling lost. And with regular breath work, all my psychology and physiology, everything started healing. I had more health, I was more happy, more inspired. And I also was very clear on my mission. I wanted to introduce this amazing tool and teach to hundreds of millions of people. I was on a path for the past 20 years. I had the privilege to have more than 40,000 students. I certified more than 2,000 breath workers. I was featured in many magazines, TV stations, newspapers, and I worked with major companies. And at one point, a few years ago, I started thinking to myself, there has to be a more scalable business model than just going out there teaching at retreats and workshops. That's why I founded Breath Hub. And I'm happy to say we just passed over 260,000 users. When you look at the market, of course, we all know, maybe most of us know, that global wellness economy is thriving, and right now, breathwork is still wellness trend that is on the rise. If you Google it, you're going to see that it's on the news, there are articles, research, celebrities started using it, even NHS suggests it. And we are inside this market in the digital fitness and wellness apps market. So anybody who's on the digital platforms and want to stay healthy and well, they can use breathwork as a tool to stay healthy and well. When you look at the competition, we have some direct competitors and some potential competitors. We see Calm Headspace, popular meditation apps, as not direct but potential competitors, not because we're doing the same thing, but because we have similar business models. We are very different than guided meditation apps. Let me give you an example. We are a guided breathwork app. So if someone is having an anxiety or panic attack, a doctor or a psychologist wouldn't tell them to close their eyes and meditate, but they would tell them to close their eyes and slow down their breathing and teach a breathing technique. Or if you have headache, you can't use it with meditation, but you can ease your headache in 2 to 3 minutes with breathwork. So breath work is more on the physiological level, because the more breath work you do, the more oxygen you have in your cells regenerate faster, you literally become healthier, your whole body performance starts changing, and breath work can be used on fitness, bodybuilding, Pilates, everywhere around fitness and wellness. When you look at the breathwork apps, we see that there are not much guided breathwork apps, so we are the first platform of its kind with hundreds of guided breathwork sessions. They just offer some techniques people have to do by themselves. Our business model is a subscription model. We are doing events because our target is being the first platform of its kind. Our target is building a community of loyal customers. That's basically why we have events. We have corporate practices in an educational platform, educational video platform of courses. As an adoption strategy, we've been doing events, partnerships, social media. We have over 150,000 followers on social media. And I am privileged to be working with a team I can call family, with my two co-founders, Jill and Atta, who are also my good friends. We developed a great team, and some team members I've been working with them for over 10 years. So this is the result. We have over 4,400 paying subscribers. We've been focusing on decreasing the acquisition cost since July, and till July on, we started growing 450,000. We decreased the acquisition cost by 60%. our target is having 4,000 paying customers. And right now we are raising 1.7, which we're going to be using most of it for performance marketing because we see that we found a formula and we are very much ready to scale. We want to keep on doing events because we see that building that loyal community is very important. We have 83% renewal rate, and we also would like to invest on a breath analysis device because we just launched the breath analysis system a few weeks ago, and over 10,000 people already started using it. And we want to also invest on a little device that can use it. Thank you for listening to me, and we are all dedicated to helping people reach to a sustainable health and well-being through breath work. If you share the same vision, I would love to meet you in our group. Thank you.
Thank you so much, Nevsha. Next, we have Liam Gilchrist, co-founder of Lexical Labs.
Thank you. Perfect. Thank you. Hi, I'm Liam Gilchrist, CEO of Lexical Labs. At Lexical Labs, we believe in contracts powered by machines, driven by anyone. Contract review is slow, expensive, and fraught with risk. I was a lawyer for years reviewing contracts, and risk is everywhere. Humans, even trained lawyers, make mistakes. Contracts generally aren't even reviewed by lawyers. And chances are, once an agreement is signed, it's put in someone's bottom drawer and never seen again until something goes wrong. It's a ticking time bomb. So our solution is Tiro, an automated contract review tool that guides users through their contracts. It's like a 24/7 AI virtual lawyer that automates the boring but super important stuff. Customers simply upload a contract that they're negotiating, and Tiro will analyze it against their business requirements. So it can be used to review or amend the contract. It can be used to create a digital issues list or a red flag report. Tiro can automatically risk score contracts as they're uploaded. It can sound alarm bells if dangerous clauses are signed, or it can provide complete visibility over a portfolio of contracts. So let's look at it in action. Here it is, analyzing a contract. It's summarizing the key issues found on the right-hand side. So Tiro empowers business users and contract managers to review their own contracts, freeing up lawyers and contract specialists to focus on the valuable, rewarding work. It can cut the cost of review by up to 80%. Now, that's really important, but what we've found is it's actually the improvements to risk management and people's lives that's truly transformative. And Tiro works because we have a founding team that absolutely understands the space. The founding team collectively have over 45 years of top-tier legal experience, 20 years of cutting-edge software development experience, and a PhD in developing AI algorithms. But most importantly, we have poured our heart and soul into this project, into this problem for over 5 years. What makes Tiro unique is its ability to analyze complex business contracts. That's because of two pillars. First, we can read a contract and analyze a contract in the same way that a lawyer will read it. And second, we have the flexibility to adjust our output depending on the customer's required workflow. Now, I want to focus on that first pillar because that's really important. And there's a lot on this slide, but what I want to focus on is lexical insight, because this feature goes right to the heart of our product. It's one of the reasons why we have been developing it for 5 years, probably the reason, because we wanted to build a solution to the problems that Simon and I face every day in our legal careers. Say that you've got a customer needs to analyze their liability exposure to a complex commercial contract. They could be buying a complex piece of machinery. Now, many contract analysis tools can identify and find key liability clauses, which is not a trivial problem in itself. But in a complex contract, we're talking about contracts with well over 100 pages. It will have hundreds of clauses in it, multiple schedules. If you're looking at the liability positions, they'll be scattered throughout the agreement. They'll be in numerous, complex, interrelated, probably conflicting clauses. So Tiro analyzes everything holistically. What is the liability caps that are found in this agreement? What are the carved outs? Are there any exceptions? Does anything conflict? It's only with this level of detailed analysis or lexical insight that we can actually understand what the customer's liability position is. And it's this focus on complexity that leads us to really focus on large enterprises as our target market. Now, our initial beachhead customers are with manufacturing and engineering companies because they really, due to the nature of the work, they really feel this pain point. They have huge amounts of contractual risk. But really, our market ultimately is any large enterprises because they have high volumes of routine, complex contracts. Later in the year, we're also going to be tackling the faster scaling agile businesses as well, more mass market companies. So let's just look at a few examples for how it works. One case study, one of our customers, Jero & Co., a large Japanese energy company. Their legal team has 4 English-speaking contract lawyers on it. They used to, previously, the business team would send them routine commercial contracts. The lawyers would review them. They'd spend about 50% of their time, half their time, analysing those contracts. And the turnaround time was 4 to 5 days. So we replaced this system with Tiro. Tiro would analyse the contracts. A contract lawyer would review the results and send it back to the business. And the results were transformational. We reduced the time to review each contract to under 24 hours, and we cut the cost to Jero of the work by 80%. And the contract lawyers were freed up to focus on the value and strategic work that they were actually being paid to do. Another example, more focused on risk here, a large global equipment manufacturer with annual revenues of $4 billion. We worked with their central legal team. So they had a small team of 2 people, but that team had visibility over 7 departments, which were responsible for negotiating over 3,000 contracts every year. They wanted visibility over these contracts, but obviously they could only touch a small fraction. So we implemented Tiro again. We built them a digital playbook. We implemented a risk scoring system designed by the central legal team. And this meant that the contract managers who were negotiating the contracts, generally not legally trained, could have the benefit of Tiro's advice when they were analysing them, but also that central legal could then have full visibility over anything that's analysed, and that any problematic issues or clauses could automatically be escalated to the legal team. So very quickly, I've discussed 2 customers. We have 5 large enterprise customers at the moment, generating 80K in pounds in ARR. We expect to reach 100K in ARR in the next 4 to 6 weeks. And we have a good pipeline under discussion. Part of the reason we're raising is because we really want to invest more in our pipeline. The market opportunity is huge. We've got a $2.4 billion total addressable market in the UK alone, and a serviceable addressable market at the moment of just under $1 billion. But we do have global ambitions. So this is just the UK. The global market is about 10 times this. So there's lots of space to play in. So very quickly, just ending up, we're currently looking at raising, we're looking at up to 1.2 million pounds. We've got 100K committed so far. And the purpose of the funds will be primarily to invest in our sales and marketing team. And the round will be EAS eligible. So if you would like to speak to us, we'd love to speak to you. Myself and Will, our CTO, is here, and Simon, our CCO, is online for those of you listening on the web. Thank you.
Brilliant. Thank you, Liam. We're now going to break for a short lunch break. So please enjoy some food and have some conversations, and we'll see you after the break for some more presentations.
In a fast-paced world, time spent navigating the ins and outs of raising capital can either make or kill a business idea. This adds complexity to your life, keeping you up at night. Where do you start? Failing to raise can mean setbacks. Losing momentum and shareholder support can make your vision seem out of reach. For most, backing by VCs are hard to come by. They only back about 1 out of 100 ventures they see. So, what are your other options? And if you get a pool of them, then what? It takes talking to 30 qualified investors to land 1. And if your idea is a big one, you might need more. Well, say hello to Wholesale Investor, a global In a fast-paced world, time spent navigating the ins and outs of raising capital can either make or kill a business idea. This adds complexity to your life, keeping you up at night. Where do you start? Failing to raise can mean setbacks. Losing momentum and shareholder support can make your vision seem out of reach. For most, backing by VCs are hard to come by. They only back about 1 out of 100 ventures they see. So, what are your other options? And if you get a pool of them, then what? It takes talking to 30 qualified investors to land 1. And if your idea is a big one, you might need more. Well, say hello to Wholesale Investor, a global leading investment platform. We're on a mission to give you access to an expansive pool of investors. At last, ditch the uncertainty. Use state-of-the-art AI to cast a wide net. Want to grow at scale? Why not pitch at scale? And zero in on investors that are a match for you. Our platform, Chris, works hard on making you visible 24/7, so you can get a faster yes in your very own deal room. Your dashboard gives you oversight, empowering you to know your next move, getting you to a faster yes, and freeing you up to focus on getting to the exit line while keeping 100% of what you raise. Our successful clients know that building a business is hard enough without the ongoing pressure of raising capital. That's why we make it easy to expand your network from the palm of your hand. So to get to a faster yes, ask yourself, are you ready to get backed? In a fast-paced world, time spent navigating the ins and outs of raising capital can either make or kill a business idea. This adds complexity to your life, keeping you up at night. Where do you start? Failing to raise can mean setbacks. Losing momentum and shareholder support can make your vision seem out of reach. For most, backing by VCs are hard to come by. They only back about 1 out of 100 ventures they see. So, what are your other options? And if you get a pool of them, then what? It takes talking to 30 qualified investors to land one. And if your idea is a big one, you might need more. Well, say hello to Wholesale Investor, a global leading investment platform. We're on a mission to give you access to an expansive pool of investors. At last, ditch the uncertainty. Use state-of-the-art AI to cast a wide net. Want to grow at scale? Why not pitch at scale? And zero in on investors that are a match for you. Our platform, Chris, works hard on making you visible 24/7, so you can get a faster yes in your very own deal room. Your dashboard gives you oversight, empowering you to know your next move, getting you to a faster yes, and freeing you up to focus on getting to the exit line while keeping 100% of what you raise. Our successful clients know that building a business is hard enough without the ongoing pressure of raising capital. That's why we make it easy to expand your network from the palm of your hand. So to get to a faster yes, ask yourself, are you ready to get backed?
I'll take that. And that does both the internal and testing, testing, 1, 2. Yep. That's it.
Yeah, that's for the other room. Testing. Okay. So this is the nightmare period that they call it for every event, trying to get people away from the lunch area back into here. So look, typically what I love to do at this sort of part is people always have a lot of questions for us from a WI perspective. So just a bit of context and history. We've actually been around for 13 years, right, to give you some sort of history. And we started out as a magazine. And then what we realized was that it was actually my first time, I remember it was 2009, 2010. I had one of our clients ring us up and I say, look, we just want to say a big thank you to you. I'm like, what are you saying thank you for? So we've just had an investor come in for 10 million out of Singapore. And I was like completely blown away because I had no visibility over it, right? And what I realized was that this space is an ecosystem. And what's beautiful about it is people tend to wear multiple hats. And so one day, for example, some people could be raising capital for something. Like, for example, one of our presenters is actually interested in looking at companies to invest into, right? In Sydney, we had the situation where we had family offices that were actually paying clients as well as looking to make investments along the side. We had sponsors that actually invested into one of our clients. This space is just such an interesting one, but really what makes a difference for us is that we strongly believe in the power of ecosystems, and we strongly believe in the power of bringing people together. So for 13 years, the way we've always thought about, the way we curate companies, right, is that for us, what's really important is that curate. We're always looking at what is the background of the people who behind the companies. We typically love companies that, or the founders behind it that have that sort of been there, done that experience. We're looking at sectors which are of high growth and of interest to investors as well. You know, the old saying, a rising tide lifts all boats, just applies to our area too. We try to make that simple for ourselves. Then for B2C businesses, we're trying to understand what are the growth metrics, you know, that this company has been able to produce over a period of time, or what have they done that's relevant that an investor could find interesting? And if they're B2B businesses, we're trying to understand who are their current clients as well, because effectively when B2B businesses have blue chip clients, then effectively what that means is that they've done some sort of DD or curation on that business, or sorry, procurement process, and then use their service. So there's some of the things, and then industry awards for the more technical businesses. And to give you context, some of our best successes have been some of the hardest businesses to actually work with, more technical businesses. And we've had great success in a lot of different ways as far as taking companies, bringing Australian companies over to the UK, obviously working with UK companies directly, and even taking companies to ASEAN as well. And in this ecosystem that we are building, we just want to bring together different parts, because I love the idea that you guys as an investor can add strategic value to a company, whether it be through networks, whether it be through just your individual sort of your knowledge, or sort of, you know, your what you bring to the table from a from intelligence point of view. But really, I said, often one investor can change the trajectory of a business's course, right? So that's what we're always working towards from a company. So on that note, hope that gives you some bit of perspective about how we sort of curate opportunities. Enjoy the next session.
Thank you, Steve. Next up, to start the afternoon session, we have Stephen Ringler, CEO and founder of Space Store Limited.
Testing, testing. Good afternoon, everybody. My name's Stephen Ringler. I'm the CEO and founder of Space Store, and I'm also a rocket scientist. And I'm here to talk to you about all things space today. So Space Store, we're all about bringing space experience to Earth. That's what we're here to do. When we started off on our journey, not the latest slide, but that's all right. So we'll just make a little course adjustment. So when we started off on our journey many years ago, we learned that basically 90% of people on Earth want to have an experience of space here on Earth. It's a pretty big market size. But problematically, it's kind of hard to access space. Okay, you've got on the higher end, we could all spend about $250,000 and take a ride with Jeff Bezos or Elon Musk. But then maybe on the lower end, you could go out to some place like Space Center to go experience it. And so we said, no, we want to make it more accessible. We want to bring it to the high street, and we want to bring it visual. We want to make it so that everybody can experience space. So how do we do that? How have we done that? We do it through a number of different channels. One is on the high street, our retail outlet. Here's a picture of our profitable shop that's in Didcot. It's a proof of concept store. So for those of you from out of town, Didcot is about an hour west of here, but we run all sorts of fun events and experiences at our shop in Didcot. One of the things we do is experiences. So if you come and visit us a little bit later at our table, we've actually brought a sample of some of our experiences. We have virtual reality experiences to take you into space. We have replica spacesuits. We have asteroids that you can hold that are billions of years old, just to name a few. We sell merchandise. We have over 200 curated products that are very space authentic, anything from games and gadgets to art and apparel. We have a cafe, and at the cafe, you can eat like an astronaut, or you can eat like on Earth. And our kids' play area is, which is educational, is really one of the big attractions, as well as people just come to work and see live space data as they're having a cup of coffee. We also throw lots of events. We put on over 100 events a year, anywhere from birthday parties to private events to corporate events. As in the bottom right there, there's a picture of us at an Airbus event where we provided the entertainment. It was good fun. You can see a lot of nerdy engineers getting space in the back there. And we're all about education. We love education. We work with scouts. We work with Girl Guides. We work directly with schools. We work with homeschools. And we want people to know about space, and that a career in the space industry is available for everyone. And you can't really bring space to everyone without being digital. So thanks to the COVID opportunity, we actually invested in our own video production studio. We have a YouTube channel. With over 550 subscribers and growing, which we're very proud of. We have a fortnightly space news event. We also run our experiences online as well now, which is a broader market. And one of the things that gives us a real competitive edge at Space Store is that we work with the space industry. So we have over 12 space companies and organizations that partner with us. So to be quite honest, because I've worked in the space industry for 20-something years, the space sector has trouble connecting with the public, and we want to act as that bridge. And what's great is some of these names that you see here, like the European Space Agency, Oxford Space Systems, they actually pay us to help with that. So this is a growing group of partners that really help make our business authentic. So it's really hard to talk about competitors because there's nothing like Space Store on the market. However, we do have analogies. So for example, I like to tell the story about London Transport Museum. If you've ever been down there, they have a great walkthrough experience, a wonderful shop, and they have a cafe. But it's not space related, and that's why Space Store sits in the top right corner of being an immersive cafe and retail experience all about space. The market size that we were showing here is 18 billion and growing globally. From our perspective, these numbers have been generated from actual numbers that we have found from the pent-up demand. This is through our proof of concept store in Didcot, as well as events and pop-ups that we do. And we believe it's growing. I mean, take this week, for example, there's 4 launches that are coming up. You're going to see space in the news this week. If you don't see space in the news this week, maybe you're just not watching it. So it's a growing in popularity area. And we've been really lucky to have some very high profile collaborations so far. Virgin Experience Days, Buy a Gift, and Red Letter Days all sought us out because their market research said, hey, we need to do more space. And they've actually tripled our event bookings thanks to them. We've also are the delivery partner, or one of the delivery partners for this UK Space Agency's Nanosat design competition. Keep an eye out for that. It's being done currently with youth. It's going to be announced in June who the winners are, and they're going to win £600,000 to launch a nanosat from the UK. So that's gonna make big news, I think. It's really great. And then the other partners I'd like to share about is Mum and Bernard Ricard. We have been gifted one of 2 champagne bottles that are prototypes that are made to go into space. So if you ever want to see what one of those looks like, hire us and bring it out. So, another thing that helps authenticate our space industry access is our team. So we've got heavy hitters from retail, we have heavy hitters from food and beverage and space. We also have an astronaut, Michael Lopez Alegria, 4-time record-holding U.S. Spanish astronaut that is flying to space again this week. First to lead a all-commercial crew to the International Space Station. So I'll be glued to my TV watching that launch this weekend. Great to have Michael on board. We believe that we are a company that's just right for investment. We've raised investment before. We raised about $300,000 in order to prove out our concept. And we did that. We proved that our stores are profitable. And now we're raising $500,000 to scale up. We're opening more stores, doing more things, trying to take this business to the next level. So how we're going to distribute those funds is we are opening up 2 stores in the coming month. Actually, might have a store in Oxford in the next month. We are also building bigger and better experience. The scan and the CR kind of virtual reality experiences. I'll tell you about some of the other cool big experiences that we're going to do to draw even more people from a visitor economy perspective. So we proved the business model. In 2019, we opened up our first proof of concept store, and it was profitable after 9 months. We took COVID to go digital, and now with this new funding, we're going to start opening 2 stores a year per year going forward. So our customers, they say that we're 5 stars. Virgin experiences, we're also 5 stars on. There's trillions of stars in the universe. So I'd like to invite you to join us and change the way the world experiences space. Thanks, everybody.
Thank you so much, Stephen. Next up, we have Tony Beaukier, CEO and co-founder of Fantasy Rugby World.
Hi, nice to meet you. I'm Tony Beaukier, CEO of Banksport and creator of Fantasy Rugby World, aka FRW, a free-to-download mobile app game for rugby. Fantasy games are a kind of game in which you become manager of a virtual team and where all the results are based on real-life player performances. Basically, our goal is to rejuvenate rugby and to become the first global digital experience around the game that rugby lovers need and deserve. Gaming, NFTs, and mobile industries are flourishing. Rugby has gone on and off the pitch with more fun than ever before. But since the advent of video games and the digital space, the world of rugby has never been able to meet fans' need for a realistic game worthy of their expectations. And so there wasn't any global app game on rugby until FRW. Like I was saying, gaming industry is going fast, with almost $174 billion in 2021, $22 billion only for fantasy game. And the rise of NFTs, we may explode those numbers, as we can see with the recent record in Europe of $680 million made by Sorare. On its side, rugby got an amazing evolution, but has still not taken advantage from this market. But it's not really a problem if you have a solution, right? By studying our target, we've seen that Generation Z or millennials consume more games, have better interest in sport, are more willing to pay for sports content, and it's evolving into the need to get something out of it, like fantasy supremacy, for example, or by betting or by NFT investment. That's why we've created the first free game with premium option, with multiple game modes, where you can play on every competition of the world, and supported by many partner features. All of that inside a concentrate of technology to get the most operational solution with infinite capacity to match our ambitious growth. Our app is clearly the perfect way to enhance rugby fan experience, with much more than a game, but a comprehensive rugby hub in 5 simple sections. First, rugby news, via article and video feeds from the world leading media. Then the champ tab with stats and information about players and championships. Fantasy with multiple game modes and features. Live results with a score from real and fantasy games, and with notification from partner media. And shop and settings with direct links to all our partners, like ticket shop, betting, etc. And because the competitors haven't taken it yet, the market is still open. They only work on the solo mode with basic rules, and they are mostly conceived as a simple additional tool to support their main journalistic activity. This is why FRW is unique, thanks to all its modes, rules, algorithms, adapted to rugby, every championship, inside a multilingual and elaborate app with the right partner to enhance it. Market revenue numbers are crazy for sponsoring and advertising, with a total of $500 billion for mobile apps in 2021. And with a total addressable market of nearly 900 million rugby fans and more than 200 million fantasy players, our aim of 1 million fantasy players on FRW seems like a reasonable obtainable market. On its side, NFT sector is clearly booming, and by replicating the existing model of football, it will allow us to increase our revenues to £15 million in 5 years' time from now. The good news is that we already have user acceptance thanks to our 30,000 users without any advertising, but only organic growth. And we've got an 8% engagement rate on our social media, 10 million page views, and an average of 1 hour spent on the app by week by active user. Antoine Dupont is our ambassador, and for those who don't know him, he's the captain of the French national team, who just won the Six Nations 1 year ago, and he has been named best player of the world in 2021. He's now a shareholder of the company, and he's helping us getting partnerships or by sharing promotional contents. But FRW is already part of the rugby world, thanks to all its partnership with many leagues and clubs like Toulouse, Bordeaux, Toulon, and with many rugby media like Rugby Pass, RMC Sport, Canal+, and also with great sponsors like Land Rover, for example, who's a kind of brand already sponsoring the World Cup, the Premiership, and the Top 14. To get FRW to the top, we got the best complementary team with Laurent Arbeau, former professional player, now head of performance in Top 14 clubs, who use all his network for public relations. There's Eduardo, our CFO, as he got more than 20 years in investment banking. Florian, our CMO, Jan, our CAO, and finally myself, who used to be a project manager in engineering, and now use all my organizational skills to run the company around my two favorite passions, rugby and gaming. But we also got great support, like with our investor and head of business development, Simon Shaw, former international player in England, and who's going to be here later today to support us. So now the potential is real, and the objective is to raise £250,000 in the seed round in exchange for 12.5% equity at a pre-money valuation of £1.75 million. This new fundraise will notably allow the development of app enhancement, of multiple marketing campaigns, mainly in UK, and the opening of many championships. So since the initial fundraising of £300,000, success is here, and the future is full of promise. Indeed, despite the hostile context due to the pandemic, we've created a strong user base, we received an exceptional support from the World of Rugby, and we already sold our product to sponsors. So to get more than £10 million in revenues in less than 3 years, the business strategy is therefore based on thinking to increase the number of players, to better visibility thanks to commercial campaigns, new markets, sponsors, and partnerships. And with the Rugby World Cup coming in France in 2023, we've got perfect timing opportunity to take market leadership on a global scale. To resume here, market is there and no one took it. We've got the best product to fill this gap with the right partners. It has already found user acceptance to prove its potential, and it's a profitable business that will scale exponentially. So thank you for your attention. I hope you're as excited as we are, and come along and join the FRW family.
Thank you so much, Tony. Now we have our next panel session of the day. Sit down. The team of experts here are going to talk through blockchain and digital assets. So here today we have Mona Tiesler, investment manager at Token Trust Investment. Chen Ard, co-founder and CEO of Solidus Labs. Wei Meng Tho, head of investments at TMT. Daniel Dabowski, group CEO at Technicorum Holdings. And Oliver Oram, CEO, founder, and Chainbound.
Hello, everyone. Can you guys hear us? Okay, fantastic. So good afternoon to everyone. I'm the moderator of this panel. It's a shame that I'm not able to be there physically, despite I'm here in London. I think it's very much COVID has turned situations very unpredictably, and to be responsible, I haven't really get myself tested, but I'm really having a very bad cold, and I do not want to pass the virus around. So I chose to be logging in via Zoom. I hope everyone is okay. First of all, I'd like to congratulate Steve and the team for hosting this session. Now, Wholesale Investors has been around for a long time. If you're in Asia Pacific, you would know that this is a main brand when it comes into fundraising. And I'm very happy to see our mates here is progressing in Europe. It is not easy because the ecosystems that we want to bring in together from an investor point of view, it is a lot of hard work. And I've been with Steve for almost coming to 8 years, and I've seen the company progress. But most importantly, I've seen while technology advancing, fundraising has been advancing, the core value of Wholesale Investors has been helping so many companies in Asia Pacific to be successfully accessing to funding, helping investors accessing to top deals. And I think we'll continue to do it. And this, I'm sure, is going to take more momentum ahead in Europe. So I actually run the family office fund out of Singapore, but I'm living in Zurich, Switzerland. One of the things that we constantly look at is how the blockchain and the crypto market has been progressing. We have been early investors of Alibaba, SpaceX, Tesla, just to name a few. So we've been in the advanced technology game, and I'm very sure that, pardon me, I'm very sure that this endemic phase of this whole situation, and now we've got a highly complex situation to handle in Ukraine, is advancing, making digital assets to be becoming more mainstream. So today I've got an opportunity to host the panel here. My distinguished panel, I'll let you guys go around the table and introduce yourself before we kick off our discussion today. Perhaps I will let Daniel do his introduction, and then we'll go physically around the table. Thank you.
So, hi everybody. Thank you so much for the invitation. I also am sick and I'm not allowed to travel. You know, this is the world we live in, but on the other hand, this is the world we live in, which means that it's awesome that we can be connected like this. Of course, in a few years, this would improve even more. My background is very odd, but also very exciting. I think I am born in Romania, in Transylvania, and I moved to Sweden as a young boy. And then I struggled as any immigrant kid to fight for a position. And I found a position for myself in the art scene. So I'm an educated art major, but then I changed my career and went into web TV, equity crowdfunding, financing, and now in crypto. So I'm group CEO of a Singapore-based crypto advisory company who has a few companies in the group where we assist a lot of people who want to do ICOs, IDOs, NFTs, metaverses, basically anything in crypto. And either we can do it in our group or we know exactly who can do it. We launched a few coin projects last year. I'm launching one right now called Influencio. It's about targeting micro-influencers in the major marketing advertising space. It's not just another influencer coin. It's not a coin to be shelled by influencers, but it's a $193 billion industry where advertisers pay a lot of money. And then you have 100 million micro-influencers, people like all of us in this panel, who are not monetizing on the content creation on social medias. So definitely we can build with Web3 and blockchain a fully decentralized payment model where not only we are empowering the micro-influencers of the world, but also allowing advertisers to reach them. So it's hard for me to give a broad perspective of who we are right now, what we do. But at the end of the day, I'm proud to say that I'm leading, in my opinion, and in many opinions, one of the world's best crypto advisors. And then in addition, as I mentioned, we're launching a few coins. Then, of course, my background from the art scene is also super exciting. So we are leading in the Nordics right now on the NFT scene. We launched NFTs for music, art, journalism. And just right now, this night, we concluded a NFT product, the first NFT product, with one of Sweden's largest and best painters, and with Tradera, which is basically the eBay of the Nordics. A very exciting project. We got a lot of attention, a lot of non-crypto attention, of course. So a lot of my work is to educate people and bring them into crypto, and at the same time, try to demystify the world of crypto so that many people can enter it. So that's my background. I'm very passionate. I'm very optimistic. I hardly see hurdles. If I see a hurdle, I see something that we can solve. And my energy is always I try to be positive and proactive. I've been in crypto since 2015. I helped the company raise funds where Bitcoin was a payment. And already then I saw a huge opportunity. I've been following it since. I bought and sold my first cryptos in 2016. I thought I'd made an awesome deal because I made like 45% profit on my first deals. Obviously, I shouldn't have sold then, but no, lesson learned. So that's about me. Thank you for listening. I'm super excited to be in this panel, and thank you once again for the invitation.
Thank you, Daniel, for your introduction. Maybe I could turn this to Mona. Mona, would you please give the floor an introduction?
Sure. Can everyone hear me? Okay. Hi, guys. I'm Mona. I work as an investment manager for a crypto-specific VC. So we only invest in blockchain technology startups. And our headquarters are in Germany, but I'm based here in London. I'm also very excited to be here. Quick background, I used to be a strategy consultant, then went into the entrepreneurial space, did 2 startups, did an MBA, then ended up at a neobank who does crypto as well in Berlin, and then over many different occurrences in life, ended up as an investor and doing this job now, which I really enjoy. The fund I work for, we mainly look at earliest seed stage, but really focusing more on a Series A, potentially even Series B investment, and very globally set up in general. So we invest in no matter where the company is based. And our focus really is DeFi, protocols and infrastructure at the moment. So we're not doing as much metaverse gaming or NFT players just yet, but it's something that we're looking at in the future. So I'll keep it short and I'll hand to the next person.
Yes, next one, please.
Hi, sorry, Wen, I thought you were going to, I'll just take it and I'll take the mic. Hi, everyone, it's Oliver here. I'm the CEO and founder at Chainvine. I suppose my journey in blockchain started a few years ago. I'm going to make this a bit interactive, my introduction. So how many people have heard of a guy called Rudy Canavan? Oh, brilliant. How many people have seen the documentary Sour Grapes? None. Oh, a couple of people, that's good. So basically, what is Chainvine? Oh, brilliant, thanks, good to hear. So Chainvine is basically, we are blockchain and wine. And why do we do that? We wanted to control the identity of wine and the movement of wine globally. So around about 5 years ago, we started Chainvine and we began to blockchain wine. Now, the Rudy Canavan, why would you do that? Rudy Canavan made around about $50 million pounds on fake wine. So it's a good cause, right? Especially anyone in the room who likes wine. So we've been doing that for a few years now. We're pretty well known in that sector for what we do. What we found actually by securing wine using blockchain was not only did we have this great origin data, this enriched data from the beginning, we actually had a bucket load of compliance data. So around about 3 years ago, HMRC in the United Kingdom asked me into their office. Luckily, it wasn't to say pay your taxes. They said, actually, we kind of like your system. You're moving wine around from different countries between different actors, and you have all of this data. Would you mind us plugging into your platform so we can begin to automate compliance costs of moving wine around the world, especially when they're coming into the UK, of course. So we've been doing that for about 3 years. And to give you a real figure on what blockchain can do when it's transformational, we found that the cost of the compliance using a platform like ours can reduce the cost of importing and exporting by up to 60%, and generally around 50%. That's a big figure. Wholesale investors is really interesting, actually, because our first shipments were between Australia and the UK. And we had HMRC as the government body there, and very big wineries in Australia who were shipping their wine over to the UK from Australia. And I'm very proud to announce that this morning, we had our first transaction from North America with the world's biggest winery. And this is a $1 billion company. They've just literally shipped over some wine to the UK, gone through chain vine systems into government systems, and now we're live with North America. So I'm going to finish there and then probably a few more questions. But what could go wrong with blockchain and wine? My answer would be nothing.
Well, congratulations, Oliver. Oh, yes, please, Chen. Please go ahead.
First of all, I know what movie I'm watching tonight. Sour Grapes was the name.
Sour Grapes.
Sour Grapes. That's it. So, hi everyone. I'm Chen Arad. It's spelled Chen. It's a bit confusing. I'm originally from Israel. We have those odd biblical sounds in our language. And I am one of the co-founders and chief operating officer of Solidus Labs. Solidus provides a crypto-native market surveillance and market integrity hub for crypto firms. Essentially, we provide the foundational system for a thoughtful, forward-looking, cost-efficient compliance program for really anyone who offers crypto investments or payment services. Citigroup categorized us named us category definer for crypto market surveillance about a year ago. Our story, really, most of our leadership and our founding team comes from Goldman Sachs. We were there when crypto became big enough for Goldman to first notice back in 2017. Since then, they managed to forget and come back. Very recently, big time, which is exciting. We just, we saw a lot of potential, not only to create new revenue opportunities and new wealth, but also to make the world better, to provide financial services to the too many people who are unbanked or that don't have access to sophisticated financial services, even in very developed countries. But as part of the internal process at Goldman of evaluating the industry, it was also very clear that this is a new kind of asset rooted in different infrastructure, introducing new data types, new market structures, a very, very dynamic and evolving regulatory landscape, and that all in all, there were no existing systems that could really serve as an effective unified risk monitoring system. And what we offer today is a unified market integrity hub. It allows our clients, which include some of the biggest crypto platforms in the world, like Wabi, OKCoin, Bittrex, as well as many brokerages, market makers, etc., on the centralized crypto side, and increasingly also traditional financial institutions that are beginning to offer crypto services, some regulators, and more decentralized platforms. So we offer them a unified market integrity hub, which allows them to unify all of their data, risk data points into one place, and move over time from a static to a dynamic risk monitoring reality that allows keeping markets open and monitoring for risk across various elements of risk throughout the client journey, the investment journey, in a much more surgical and dynamic way. And we believe it's the key to enabling the merits of crypto while mitigating the new risks without stymieing the potential of decentralization. And I'll stop there.
Excellent. So it looks like we have a very diverse panelists here from selling wine investing, and now we've got the payment as well. I think this is very much mainstream topic. I would not just be very specific, but rather for the benefit of our audience, I would like to get some comments and opinion from each of you with regards to the current situation again. I think we are all observing how the digital asset play is trying to bring the new evolution aside of the new asset class. But look at the NFT collection, where recently I think Ukraine has raised 65 million sponsorship to help battle against Russia. And I think we know that a lot of the global regulators are also trying to get a very close observation, because after the sanction, the only way, in my opinion, beside Go, is probably the crypto side, in terms of how they were allowed Russians to circumvent the sanction.
But also, sorry to interrupt you, but also it was fascinating to see, of course, that money was raised on Thursday, on Wednesday, and then already during the weekend, the Ukrainians could buy weapons and ammunitions and stuff like that. And of course, in a regular banking world, that would never work, right? The banks are closed in the afternoons, evenings, and weekends. So it was extremely interesting to see how an effective decentralized network can work for, of course, those who are in the system.
Exactly. That's why my come to my main point is agility, as well as I think we're finally seeing that crypto is acting for good. And my question to the floor here is that from an investment point of view, I think all of you had done fair investments for the past years, and now the world is looking at all of you as a specialized field. All the time, digital asset prices have always been highly speculative. So now, with this, again, this progressive actions on using crypto, how would you look at, from an investment point of view, would you see that this is the best time to really educate the market? Please go ahead, Daniel.
Yeah, no, definitely. I think so. As any investor, you want stability and almost knowing for certainty that an investment goes well, right? It's very few investors who gamble. And I think, the more a market establishes itself, the more you have proper data on failures and successes, that's the best thing for investors. And at the end of the day, you want to hit critical mass, enough investors in the system who are making enough money to motivate others. We also, of course, want the losses. You want to also quantify the losses, how much money has been lost. If you look at the traditional venture investment segment, there's a lot of data, right, since the 1920s almost, on what a good investment is, how to look at a good investment, but also what percentages to expect on a bad investment. The same in the startup sector. So I think right now we're definitely entering a new bull period. I think also we hit enough critical mass. I'm a bit surprised that crypto didn't surge more during the Ukrainian conflict, because a lot of utopian democratic people who believe that crypto could be a gateway to democracy and equality have waited for this moment, waited in quotation, right? You don't wait for a crisis, but you want to see how a new technology behaves during a crisis. And you can absolutely see that the traditional banking system, the traditional systems have failed for Russians, Ukrainians, and everybody else. And I don't mean oligarchs and Putin here, of course. I mean regular Russian people and regular Ukrainian people. But my understanding is definitely we are getting closer now and closer to a pivotal point where traditional financial institutions can start looking at investing in crypto and not just speculating on the currencies, but actually investing in crypto companies and understanding the benefits and the negatives of investing in a crypto company.
Yes,
Obviously,
correct.
we've seen many crypto investments so far, many investments, many people who have invested, but those early ones always tend to be the early gamblers, the only, the gutsy ones. So we are look, Sequoia investing in OpenSea at $14 billion valuation when a company is 1.5 years old. That's an anomaly. But on the other hand, it also shows that people at Sequoia are investing. And in my region, there's a lot of VCs who have hired blockchain and crypto specialists just to understand what's happening so they don't miss out on a good opportunity. Thank you.
Mona, what do you say about from an investment point of view?
So from our point of view, I think we are not adapting our investment strategy depending on bull or bear market sentiments or any kind of situational causes. The reason is I think the strategy that we tend to go for is a very diversified portfolio. So we don't just invest in, for example, DeFi protocols where the token is highly volatile to the market, but also in B2B players, in infrastructure that supports mass adoption and use cases as such. So I think it's really about diversifying the portfolio and having also maybe a view into a little bit later stage. Again, that's part of our strategy. So looking more at the Series A plus type companies because they have proven a bit their runway. Hopefully they have some revenues. Hopefully they are potentially even profitable. And even if they don't make any revenues for, 20 months or so, that they could still sustain themselves, right? And that's something that we do look for when we invest in a company. And another point I think that's quite interesting and from the strategic point of view, the way that I look at investments is that also looking for strong co-investors. It was just mentioned there are big funds, Sequoia, there's Andreessen Horowitz, there's Paradigm who raised billion-dollar funds. They of course have the capital to support their investments depending on, it doesn't matter what the market is doing, they have the ability to support their investments through those times. So another thing that we definitely look for is a strong conviction and that we can support them through the tough times, but also strong co-investors that definitely have the funds to support the investments throughout difficult, but also all the good times as well.
I'll just add from a practitioner's point of view, if you look at perhaps investments in fine wine, which actually outperformed crypto last year, if you begin to marry a digital asset with your fine wine, you actually turn what is quite an opaque alternative investment asset into a more solid and agreeable investment asset. If you begin to digitize your commodities using distributed ledger or blockchain, and I want to make out one note there, it doesn't have to be totally decentralized. And there are other protocols that don't say we have to be a complete open cryptocurrency. So there's a difference there that we've got to actually establish. There is a line between total decentralization. Centralization is not all night and day.
Is it my turn?
Yeah, please go ahead, Ian.
Thank you. Getting used to this new dynamic, just like the financial world is getting used to this new dynamic of decentralization. So I guess a few thoughts, both as someone who works for a company that focuses on infrastructure and providing risk monitoring that helps the industry be safer and more mature, and also as a company that just is in the process of finishing our B round. When I think about it, when you think about a gold rush, usually, historically, the gold rush in the United States, the people who made the most money were not the people who mined gold. They were the people who built the railways, the post offices, and all of what enabled other people to mine gold. And I think, from my vantage point as an infrastructure company, it seems to me like there are a lot of large investors who are really looking for that, for what's going to be the railway, or in our case, the guardrail, for this industry. I think that at the end of the day, almost every industry, and specifically the companies operating in very nascent and industries, and we have to remember that this is a very nascent industry. I mean, if you ask me if this is the new internet, we're still in the early 90s at most, right? I mean, most of us, even the people in the industry, don't completely understand where it's going. So it's really, these kind of industries are tested usually when it's a bull market, not when it's a bear market. I was here, like some of my colleagues here, like my co-panelists, 2016, 2017, where there was a ton of excitement, met a lot of different companies, and many of them are still good friends and counterparts today, but many of them disappeared in 2018 when Bitcoin was low. And while we are in a completely different place, I agree that here at this point I meet very few people who don't think that crypto, blockchain, and even decentralized finance, which is the bleeding edge, is not here to stay. We can expect that there are also going to be some harder times. And that's why when we look for investors who also, understand that and are thinking in the long run, because we're so early that there's nothing but the long run, if you ask me, unless you're looking for short-term opportunities, which is also fine. And obviously they exist plentifully. I think that what sometimes scares me, not scares me, but something that I'm very wary of is the fact that, we work a lot with regulators, and we deal a lot with financial fraud. That's what we help prevent with financial market manipulation, etc. The triangle of very new technology that's still being battle tested, especially one that deals with a lot of money already, right? We had an over 800% increase in the decentralized finance sector in 2021. So that's one piece of the triangle. The other piece is, of course, evolving regulation. Regulators are still not on top of it, although they are more, as they proved in the context of Ukraine, in the ability to trace funds, and make sure that they're not being used that the blockchain-based assets are not being used to circumvent sanctions, right? They're getting there, but they're not quite there yet. And finally, a huge amount of FOMO, fear of missing out on buzz. That triangle is a very fertile ground for manipulators, for abusive actors, etc. And we really try. Sorry, I'm just going to let our moderator know that we have 4 minutes left. I'll also try to speak more briefly because I think he can't see the sign, I was told. So I'll just finish by saying that, we have to constantly be wary. We can't just think about the highs. We have to think about the lows, and we have to think about building very good, strong infrastructure. And in my view, investors who are not focused on, companies, opportunities that are thinking long term, that are thinking about regulation, because not only that it's coming, it's already here. That are thinking about what would a full institutional adoption of this text would require. It would require compliance. It would require risk monitoring. If you look at Fidelity, I actually believe that institutional investors are already here. Fidelity digital asset surveys show that 98% say that institutional investors say that they really want to invest in digital assets. 50% of them don't yet do it because of risk monitoring concerns and compliance with regulatory concerns. But that means that there are 50% who are already doing it, right? Anyway, I try to think about what happened in other industries. And for example, Facebook, such an amazing company, really connected people, but I'm not sure if it will be remembered positively in history. And I think it's very important for our industry and for people who are investing in it to think what we need to do in order to make sure that we are, and that the opportunity here that is so great, does not fizzle out because we're too optimistic and not concerned enough with risks. Sorry, longer than I intended.
Well, it's okay. Now, I think we all understand that digital asset and crypto is here to stay. While we are investing into this disruptive technology, more important, in my opinion, is to invest in a sustainable business. At the end of the day, it's all about the business that is able to create the value to your target market and also to your stakeholders. So I think that we left with two more minutes, and I'd like the panelists to address. If I were to today look into this market, I may be too late always to many people, and I'm not talking about Bitcoin. I'm talking about getting into the venture business as investor. So what is the takeaway would you like to give based on your practical as well as the experience that you had? Please go ahead, Daniel.
Yeah, thank you. So first of all, I don't think it's too late. I think it's very early. I think, this is like internet 1995. Of course, the technology was there, available. A lot of people knew it about it, but it doesn't matter how much we love it and how much we are connoisseurs and early adopters. The big key to the entire industry will be once, the masses coming, my auntie, my uncle, my sister, my father. Those are the target audience. The same like the internet. In 95, very few people understood what the internet could be and become for the companies, and I think there where we are. So we went. You're definitely not too late. I think we are all too early, and I think it's one of the hardest things. We have a lot of opportunities in front of us, but also a lot of craziness. So for me, when I'm investing in companies, I always look at the individual. What have they done before? Are they surviving? Do they have the right mindset to pivot when needed? Are they driven enough? What's the hunger? What's the point behind it? And I totally agree with you. Projects that are just, they have a bit of a makeup on it, a bit of a metaverse or crypto on it, doesn't make sense. It has to have a real life purpose, where blockchain and crypto is just an emphasizer or a helper. It can't be, let's do a project on crypto blockchain for the fun of it. And if you can't reach 100 million people, you don't aim to reach 100 million people in this environment that we live right now, I think you're doomed to fail. So I'm looking at scalability. I'm looking at, is this just another forced crypto project, or does it have real life crypto usage? And then, of course, as in any investment, I'm looking at the team or the drivers behind it. Why are they doing it? What's the purpose? And are they in it for the long run? Of course, a lot of people are afraid about rug pulls and such, as you are in the startup world, but there's definitely a lot of opportunities in front of us. Thank you so much.
Okay, next, please.
I think we're already over time, so I'm going to try to keep myself extremely short. What do we look out for? I would agree with what Daniel said, so I'm not going to repeat that. I think one topic that I'm really interested in at the moment is generally tokenization of real world assets. So real estate, fractionalized ownership of real estate, or art, a Monet painting or something as such. I'm quite bullish and interested in that space, so I'm looking for investments in that direction. But in general, if I'm looking at a team, if I'm looking at evaluating investment, I definitely look for something that's really gonna be a big conviction bet for me. I want to see that this is going to bring the masses on board, that it's going to help the world, in my opinion, turn into a Web3 world, which I'm excited for. And I would say that that's the direction that personally I'm heading for the investments that I do. But I definitely agree with Daniel, and I will stop here to give the others some airtime. And thank you for having me today.
I'll need to keep it even shorter. I would say this: focus on one sector and demonstrate the features and benefits. Stop fixating on decentralization and cryptos. What are the features and benefits? Why should I use your platform? What's it going to do for me? And if you show the features and benefits of your platform, the regulators will like it, your clients will like it, you'll like it. It's as simple as that. Focus, nail one sector, move on. Thanks. Wine.
I will try. I will try to keep it even shorter. The way I like to think about it is, an autonomous car. We can compare decentralization to this idea of no middleman, which is really at the basis of all investment opportunities in the DeFi space. An autonomous car can only go as fast as its brakes are able to stop it. And so focusing on infrastructure, it makes it safe, makes it viable, makes it actually adoptable, not just accessible because it's open to everyone, but also accessible because investors know that they're not being cropped 20% off the top and 20% off the bottom. I think specifically in decentralized finance is what's really going to enable the space. Obviously, I'm biased, but that's what I think.
Okay, looks like we are time out. Thank you very much, everyone, and thanks the panelists for giving us all of your very valuable opinions. So I think with that, I would like to conclude this session. Hopefully the next time we have more time to talk about this hot topic. So Thank you once again and enjoy the rest of the session. Thank you. Bye.
Thank you so much for having us. Bye-bye.
Thank you so much, guys. Thank you so much for coming in. Now we're going to start off the next panel session, the next presentations of the day. First, we have Jake Al-Rasul, Client Relationship Director from GPAC.
Thank you. Hold it. Done? Yeah? Sure? Can you hear me? Speak loud. Thank you, Megan. Hello, everyone. I'll wait for everyone to leave. There we go. Cool. The room's empty now. So yeah, thanks for the introduction, Megan. Great to have you all here today. I'm going to talk you through our investment opportunity. So I'm just going to go straight into a bit about who we are and what we do. So the company's called Global Patent Assertion Capital Corporation. It's a very long name, so we've shortened it down to GPAC, which I'm sure you'll all agree is much easier to say. So GPAC is an intellectual property monetization entity with the focus of generating revenue through IP monetization strategies, mostly patents. The company implements strategies and patent litigation and patent licensing programs, while also focusing on IP portfolio growth and maintenance. So just to really cut through that jargon, what we do is we raise capital for litigation and assertion opportunities. We also raise capital to grow and develop our portfolio of litigation cases. Okay, so why invest into this sector? Well, firstly, it's uncorrelated to global markets and property. That presents a diversification opportunity. It also means that it doesn't go track the markets. We don't see the peaks and troughs in this particular sector. Secondly, the experience of our partners in this field is very significant. The experience of our partners or our service providers means that we can achieve higher than average returns for our investors. And then thirdly, it's a rapidly growing market. So the litigation funding market is currently valued at around $13 billion US. That's set to increase to just under $28 billion within the next 5 years. So it's an exciting and diverse new opportunity to look into. Okay, so why IP litigation and where is the value really? So IP owners typically don't have the finances or the network to maximize the value of their intellectual property. So that becomes a problem. Funding becomes a problem, expertise becomes a problem, and monetization of their intellectual property becomes a problem. That presents a solution for GPAC. We have access to funding through our network of funders globally. We also have the network of expertise, and we have the experience of monetization. This then presents an opportunity for investors to invest into a litigation fund or co-invest into a litigation fund. So as I mentioned earlier, we have a portfolio of litigation cases or legal cases. These legal cases go through a very strict due diligence process before we take them on and put them into our portfolio. That portfolio then sits there as a fund. We then have two options for investors to access that fund. One is through a short-term investment vehicle where you can invest over 90 or 120 days. Returns in that vehicle are anywhere between 5 and 20%. And then we have a longer-term vehicle where you can invest between 2 and 4 years. And this is actually taking part into litigation cases. Taking the long-term route moves you into our portfolio of cases. And that's where you have an opportunity to have event-based distribution. So what that actually means, as these legal cases conclude, or as these legal cases get bought out by larger funders, that money goes back into the fund. You being a part of that, you have a share of the distribution. Okay, a little bit about the team. Tony is our operations director. Unfortunately, he couldn't make it here today. So myself and Craig are here. Tony works with our service providers or our service partners. He works on the monetization strategies of every opportunity that comes to GPAC. We also have a patent attorney based in the US who reviews any opportunities prior to them going through the due diligence process and then being put into our portfolio of cases or being rejected. Myself, I work on the investor end. So I help find investors globally. I'm based in the Middle East. I've been out there for the last 8 years. I've worked in the investment space for just shy of 20 years now. So I predominantly work on the investment side. Snapshot of the market. So this year we're looking to raise 25 million US dollars. Last year we raised 9.5 million US dollars, which gave an average return of 19% to our investors. 72% of those investors reinvested with us. So the retention rate is quite high. Lastly, just going on to the ask. So what we're really here to do today is we're looking to raise 25 million US dollars, as I've already mentioned. We're looking to do this through 5 different investment vehicles. That will range from a 90-day investment opportunity all the way up to a 4-year investment opportunity. And those vehicles will be available throughout the next 12 months. What we'll do with that money, that will help us progress our current portfolio of cases and also look at new opportunities that we can acquire and put into the portfolio. And then lastly, I haven't mentioned yet, I spoke about the portfolio a couple of times now, and the real hook here and the real hook for investors is the valuation of that portfolio. Our portfolio is independently valued. That's currently valued at 2.2 billion US dollars. Okay. For anyone that wants more access on this information, we've had an independent valuation done by a US bank called Objective. For anyone that wants information on the case reports, the valuation itself, please come and find us. There's a lot of sensitive information in there, so NDAs do have to be signed, but we do have an investor portal for you to access and have a look at to get a better understanding of what we do. All right, that's literally everything for me. We are right at the end of the room. Please do come and find us, ask us any questions. It's a very niche space to be in. It's also very, very exciting. So please come over, ask as many questions as you want. We're happy to help. That's it. Thank you.
Thank you, Jay. Up next, we have Tony Donnelly, CEO and founder of Climax.
Everything like 3.5 to 7 million valuation in 5 years. And potentially 735 valuation based on an annual program. Interestingly, we have two exit routes already planned. We tested it in Europe and America. Distribution, supply chain, and more importantly, those markets for today are really focused especially in design our product. And that's the time. Always remain safe in the sector in 2020 by 1.8 users. We're at 50,000 of possibly the most important point for us, and that's the part of the regular process. And that's the part of the license, part of the family membership of the process planning coalition in response to our ESG program. Our MVP evaluation has been 20% validated. The requirement of 25,000 investors in MVP will have 5 months valuation of 2.5 million in place, not uncommon in the sector. Retaining them qualified valuation complex. And the money that we're raising now is in the actual sweet spot with the SSC capital and both which report seeking. Those raises that are most attractive are sitting within that range still. Nevertheless, I'll give you a few points. It's fragmented, socially active, depending on. So it includes police companies, rental companies, travel management, software as a service, and mobility as a service independently as it stands. But it includes a range of subject matter experts who are all got critical data. But they're dependent on territory. They're dependent on territory and all the critical. Not involved in the business life. I'm actually to the nomination that he's the architect of the Untitled myself. We're supported by a shadow board of people who come on and look at this distinguished plan happens. We have another team stick working. Fun and simple. This is by simple, flexible, possibility.
Thank you so much, David. Next up, we have Rosanna Jaggard, CEO of .coms.
Hello, my name is Rosanna Jaggard and I'm the CEO of .coms. So .coms, what does that mean? Doctor Communications, simple. This logo is designed to be translatable into any language for anybody to understand the problem that we are trying to solve. Being married to an NHS surgeon is not easy. They work long hours, they're constantly on their phones, their personal devices, and they always try to make sure the patient is the one that gets the best level of treatment. We have a product that we have been developing to try and improve patient care and improve the life of the clinicians administering that care. So our strapline, clinical communications to elevate patient care. Our product will affect every single person in this room and outside of it, every living person, either directly, unfortunately, or indirectly. You will all benefit if patient care improves. And the only way we can do that is by delivering technology to help people delivering that care. So it's a secure medical communications app with bespoke clinical functionality to improve patient care, further medical research, and offer AI capability.
So I'm going to talk you through some scenarios, and this is something that I see on a daily basis, and this happens, so I'm not exaggerating. So imagine you have an elderly relative who comes in under my care, and she can't get her painkillers for 3.5, 4 hours because they can't get hold of the doctor. The doctor's busy, it's understandable, but they can't proportion it to a member of the team because they haven't got the communication systems to do that. Then you've got another problem the next day. She's going home. They can't write her discharge papers in time because there is an urgency to be doing something else, which is frankly more clinically important. That patient's discharge gets delayed. Then you have got a bed issue because you can't admit the patient, the new trauma patient who's sitting in A&E waiting for a bed. They then don't get their operation that day because they haven't got a bed to go back to, and they block A&E for 12 hours. You then end up in a situation where that delay in theatre time costs anything between £2,000 to £3,000 an hour. You've got a lost revenue model. Then you end up with a scenario where that patient has a misdiagnosis because I can't see what the paramedic sees at the scene of the accident. I don't have access to those photos. I would predict some of those diagnoses if I knew what the mechanism of injury was and how that crash had happened. And I don't have access to that data. Then you end up in a scenario where I discuss the patient with my colleagues, and only to find that I have to do that on a social messaging platform, and I'm putting their data at risk by doing so. Because if I lose my phone, my registration's at risk, and that's the problem.
Let's just go over that because there's quite a lot in there. So the medical data is not included in the record. The problems with social messaging is it's used in desperation because there's nothing else. And GDPR is on a direct collision course with that. The miscommunication causes mistakes. These people are busy, they're under time pressure, there's mistakes that will happen if they're not given the right tools to communicate. And what we're trying to do is replace those dated paper systems, which won't be updated in real time, which can easily get left behind at the coffee shop or in the loo. We're trying to replace those with somebody's personal device. They already know that we're always having. And we have very few people because everybody will have their personal mobile phone on them. And work phone, work phone. That's the problem that we're trying to do. So the solution, we have obviously a senior clinician within our team design the product. It's the third NHS designed or third product that we're putting into NHS. But we've also got medical investors who've actually designed that we continue to create that design. That is the delivery problem. Our solution is quick and cost effective. The NHS aren't having to shell out on hardware. And we're accredited by the NHS and the government, and we're ready to go. So the value proposition, there's a lot to this. We're not just a communication platform, but what we are delivering is a new type of medical data, an annotated data set, which will drive further research, drive learning, drive better treatment, and also give better outcomes for patients. So let's just go over and pick up on the ones we haven't covered. The AI capability that will come through and actually enable senior doctors to get another form of opinion very quickly. We're also creating a clinical network, the likes of which the medical teams and the medical industry doesn't have to date, because this is not just a UK problem. There are 43 million clinicians or healthcare staff all over the world, and they don't have that network to access the second opinions. Imagine a world where .coms had been around pre-COVID. Imagine the difference that would have meant in terms of learning and speeding up that share of information. The revenue streams doesn't come from the users. Let's be really clear. These are for healthcare staff who are not paid like bankers or sort of, they're not wealthy individuals. So what we are suggesting is that it's the institutions that pay the license fee. They then use this platform. They have the information to supplement the existing patient records, and that information stream then contains a lot of learning. It also contains the reasons why decisions were made. Our competitors, why have they failed to deliver? Not one of them has a medic within their team. Not one of them continues to work in the NHS. We're continually learning, continually facing the problem, and continually reiterating things. WhatsApp, classic. It's quick, easy, everybody has it. That's why they use, and that's who we are competing against. Our market size is huge. This is continuing to grow. It's over 6 billion if you take the license fees of institutions into account alone. We're saying if we get 10% of that, that's 500%. Our milestones so far. So we have a great, really experienced group of angel investors. We've raised 600,000 to date. We are TR7 ready, so our technology is in place. We are now focused on user engagement and growth. We're working with the 40 Years Clinic. We work with UK Motorsport. We work with medical service their events, and we work with the NHS UK. So this problem is global. We see that's where .coms will go. So just to quickly go over the revenue and data. The medical data that we're creating on this platform will be annotated data sets inputted by the professionals. There's very, very little error. We've got a clinical network which will add to the company value. That network, based on current case studies, is about 45 million. And the license fees alone per annum would be about 10 million. That is a UK figure alone. And again, what are we doing this for? We're doing this to improve patient outcomes. Our team is diverse and it's experienced. We've got our key players here, but between us, just the 5 of us that you see on the screen, there's over 100 years of experience in business delivery, tech development, and NHS medical experience. We're raising between £500,000 to £750,000, which will give us a decent runway of up to about 12 months, just beyond. We are primarily going to be spending that money on resourcing to enable us to deliver on our vision. We're valued at £7.4 million. And thank you for your time, and I invite any questions.
Fantastic. Thank you, Rosanna and Matthew. Next, we have Andrew Wigney, CEO and founder of Vault Technology, who will be joining us online.
Hello, my name is Andrew Wigney. I'm the founder and CEO of Vault Technology. We're going to the battery what LEDs can put on the pole, and that is turning high-performing, environmentally unfriendly product and turning it into a high-performing, environmentally friendly green tech product. The AA battery was first produced way back in 1907, and there's been very little innovation since. For a chargeable AA technology, very little has happened in the last 15 years, until now, that is. Volt has developed technology to allow battery manufacturers to build the world's longest lasting, fastest charging, best performing, and most environmentally friendly rechargeable AA batteries. So Energizer, they say they've got the world's longest lasting AA battery. Well, not anymore, unless they use Volt's technology, that is. So Volt's technology is in battery management. It's not in the power source and the cell inside. So what that means is a battery manufacturer can use any power source inside, and Volt's battery management technology lets the user have a 1.5 volt rechargeable battery. And with all of the new technology in cells being made for electric cars to look at doubling the energy density and create a faster charging battery, this sort of new cell technology can be used by the battery manufacturers to create an even better battery, so long as they use Volt's technology in terms of the battery management, that is. So over the past 7 years, we've created some various prototypes from our very early stage proof of concept through to fully functional oversized prototypes, and then down into fully functional actual size prototypes. Our current fully functional prototype is now ready. Everything works well. We've also created a patent portfolio during this time. The next step for Volt is to create an ASIC. So that's an application specific integrated circuit. All of the discrete electronic components from the prototypes needs to come into a custom chip. This is why we're raising money. This has got to be done before we can go to commercialization, ultimately, and then revenue and the exit. So how does it perform compared to an existing battery? Here we've done some testing in a 1 watt constant power test. This is like in something like a high performing flashlight or a high performing motorized device. A single use disposable alkaline battery lasts around about half an hour. They don't perform that well in high power devices. And a regular rechargeable battery does perform reasonably well, and here in this test lasted 138 minutes. Volt's prototype back in 2015 outperformed a regular rechargeable, and as lithium-ion cell technology got better over the last 7 years, our prototypes continue to perform better and better. So this actually provides whoever uses Volt's technology a roadmap for the future to produce new, faster charging, longer lasting batteries. Does anyone care? Why not just use disposable batteries? They're low cost, they're easy. Well, think about this. Each year, almost 10 billion AA and AAA batteries go into landfill. And if we lined them up end to end, it would only take 10 months to reach the moon. When you think about that and the number of batteries, it's crazy there's not a better way. We need better rechargeable technology. One battery made using Volt's technology can replace around 1,000 disposable batteries. Now, will consumers care? Do they worry about things like this? Well, there is a global trend that we're seeing to rechargeable technology. So IKEA, for example, as of October last year, stopped selling single-use batteries. Now, they're foregoing 300 million batteries a year in sales to be a better corporate citizen. There is also in Europe the so-called batteries directive, where they're looking to ban or restrict single-use batteries when there's a viable alternative. And batteries made, rechargeable AA batteries made with Volt's technology are a viable alternative. So the future of battery technology is affordable and sustainable performance. The market is mature. There's a lot of products coming out with battery on board, but the global AA and AAA market continues to be steady and mature at approximately 10 billion units per year. Many product manufacturers prefer to use AA, AAA batteries. It allows their customers to just very quickly swap out. For example, Hasbro sells the Nerf blaster, and it's around about 10 million AA batteries a year are bundled with their various Nerf blasters. We've got game controllers, camera flash units, the list goes on. But will people buy a new technology battery if it's available? Well, there's history to show that people will purchase new technology. Back in 2005, Sanyo released the Eneloop battery. This was a rechargeable that didn't go flat as quickly. It was low self-discharge, and they sold 300 million units in their first 7 years. Now imagine the sales if that was Energizer, Duracell or Panasonic selling that, but it was Sanyo. So it just shows the potential in the market of new technology. So Volt, we've got a solid team of engineers, IP experts. We even have an ex-Energizer executive, and we're supported by a wide-ranging commercial advisory. There's a problem identified, there's a patented and patent pending solution that we've found. We have an extensive patent portfolio, including ratified patents and patents pending with continuations planned. There is a global mature market with a trend to rechargeable green battery technology. We can see this history of commercial success for new technology as shown by Eneloop. Volt's technology provides significant performance improvement over existing technology, combined with a roadmap to further improvement. There's customer validation of this type of technology. There are companies in China now bringing out lithium-ion powered with a 1.5 volt regulator, similar technology, but nowhere near as good. They're not competitors, they're potential customers. Instead of using their chip, they could use a Volt ASIC. That gives us multiple income potential. So we're not reliant on one channel. And we have an international team of industry experts backed by commercial advisory. So this current raise is for New Zealand $5 million with a post money of 25 million. Over the last 4 months, we've raised 2.2 million. So we're well on our way. The asset creation process has started. So a projected exit based on Eneloop sales, so based on a battery company coming in and selling 300 million in their first 7 years, we're looking at about a 5x. But if we can get global adoption of this technology, we're looking at a 10x. So, are you ready to invest and join the Volt battery revolution? If you are, or you'd like to know more, please contact me on the details below. Thank you very much.
Thank you, Andrew. And now we have another online presentation from Andy Kristen, co-founder of Liti Capital.
Yeah. 1 second. All right. Hope you can hear me. Hello, everybody. My name is Andy Kristen. I'm one of the co-founder and the Chief Vision and Operation Officer at Liti Capital. Liti Capital is a fully operational Swiss private equity company on the blockchain that is specialized in litigation finance. So our core business activity is to finance legal claims against a portion of the award. So litigation as an asset class has two interesting properties. First, they are highly lucrative. They provide an average return ranging between 50 to 100% per year. And second, they are uncorrelated, which means that they are quite independent of the state of the economy and they are barely affected by economic crisis. So what problems are we aiming to solve at Liti Capital? Well, this asset class has remained, quite inaccessible for investors. They were only accessible to a handful of quite sophisticated ones. It is a totally illiquid type of asset class as we speak, since investors' funds were locked up for at least 5 to 7 years. There's another issue that is that the crypto space is still perceived as a risky territory for investments. And finally, there are high costs to access justice. So Liti Capital was one of the three first companies ever to tokenize its equities. So on the Swiss law, Liti token holders are exactly the same as shareholders. They have the same rights, they have the same level of protection. But by using blockchain and tokenization, we can actually enable the access of this really appealing asset class to all investors. And so therefore, we can increase or improve the fundraising potential for the company. Second, we can now combine high return type of asset class with a liquid investment. And so we provide much more flexibility for investors without compromising the ROI or the return on investment. And last but not least, there is what I like to call the one-way crypto optionality. So our token is backed up by the litigation assets. And remember that I said that those assets are somehow immune to economic downturn. So despite what happens on the crypto market, despite of the volatility, it doesn't really matter, right? The company can still generate revenues and pay out dividends from the assets under management. But if there is a positive trend in the crypto market, then investors will be able to make additional investment profits, by just looking at the appreciation in the price of the token. So therefore, Liti Capital provides a really nice and safe way to get an exposure to this emerging crypto market. Talking about the market of litigation finance, briefly, it is still a very niche market, though it is already a multi-billion-dollar industry that is growing at a really, really fast pace that is expected to double by 2027. And the recent events that the world has faced recently, I'm talking about the COVID-19 pandemic or the recent geopolitical issues that we are experiencing right now, all that will just increase the demand for litigation finance and bring more capital into the industry. So how does our core business model work? It's actually fairly simple. We do fundraise and then we deploy the capital into the core assets of the business that are the legal cases I mentioned previously. And if everything goes according to plan, we pay out dividends. Each time we win a case, 80% goes back to LITI token holders or shareholders. That's exactly the same under Swiss law, while 20% gets back to LITI Capital as performance fee. So let me just guide you through an hypothetical case scenario where LITI Capital would commit an investment of 7 million against a 30% ownership in a claim that is valued at $50 million. If everything goes according to plan, right, skipping a few steps here, projecting ourselves in 2.5 years, 3 years from now, shareholders will get $12 million pro rata to the amount of shares they own in the company. And that is just for one single case. So I always get the question about where is LITI Capital and what's its growth potential? And I think that one way to reply to this question is by looking at the current market cap, which is roughly 9 to 10 million US dollars, and to compare this to the potential value of the assets under management that are estimated at $250 million. So just by taking these two values here, you see that the gap is roughly, a gross potential roughly of 25 times. Now, if you want to be a little bit more conservative, you could compare the enterprise value with the amount of capital that we have already paid for the different cases. And here you will see that every dollar worth of tokens is actually backed up by $3 worth of assets, right? So this means that the company is undervalued. Just to mention as well a few financial indicators, our IRR per year is estimated at 278%. And as I said, we are building the value proposition for the liquidity, and we have right now an average of 18 million US dollars of trading volume per month. Our management team has a collective experience of over 70 years to continue making LITI Capital a success story. And since a year now, we have been building up strong partnerships with various law firms, trading platforms, and other key partners in the blockchain crypto industry as well. So what's the opportunity for investors? Well, I think, at least I hope that I could make you aware that the litigation finance as an asset class is extremely appealing, and that at LITI Capital, we try to make it even better than before. I hope I could convince you that the company is still undervalued. And just to talk briefly about our cases under management, we are on track to have a positive outcome within the next 3 years. And we plan to pay out dividends this year for the first case. So that's going to be an interesting moment for the company. We are seeking another $30 million to unlock a new case of a new pipeline of cases. We already fundraised 27 million as a mixture of cash and assets. So if you are interested in our project, please don't hesitate to write to me. You have here my email address. Clara is in the crowd normally. We have a stand there, so just pass by and talk to us. Thank you very much for your attention and enjoy the rest of your day in London. Bye.
Fantastic. Thank you, Andy. Now we have Dmitry Golubtsev, founder of MatLogica. Just make sure your microphone's on.
Right. Welcome, everyone. I hope everyone had a good lunch and coffee is taken in. So we're going to do maths today, but I'm not going to bother you too much. I want to make it enjoyable. My name is Dmitry Golubtsev, and I'm a founder and CTO of MatLogica. I'm also a mathematician and a computer enthusiast. We are presenting today a solution that helps financial institutions and other fields to supercharge their computing analytics and scale it much better to what currently is available. This opportunity is to invest in our 95K remaining CIS round and 405K in EIS following this year. So what is the problem here? Many companies today require a lot of computer analysis and rely on lots of computer simulations for their day-to-day activities. This includes running financial simulations, doing machine learning, doing scientific research, and geophysics, as well as weather modeling. For MathLogica, it all started when I was working at a big financial institution, and at that time, I had almost 20 years experience in this field. I look at various ways how we can implement something that's called algorithmic differentiation. Bear that in mind, it's not very important, but it's a very interesting and curious technique. I look at various options how we can implement that. And of course, I did not like any of them. I wanted to invest my own tool. I approached my manager and explained him what I'm thinking needs to be done. And thankfully, he said, no, we have no appetite to do that internally. So I wrapped up my project and started on a new journey and establishing my own company to deliver the solution I really wanted. Right. What do I really mean? How the solution can help practitioners? I don't want to go into too deep into mathematics, right? But think if you need to drive a supercar and you don't know how to drive it. You normally would use something in your brain to sense your surrounding and steer your wheel, accelerate, brake, etc. Most likely, you're not going to do a job because you don't have any instinctive behavior. Like it's not controlling you with your spinal cord, right? It's controlling with your brain. So you're not going to do a good job. At MathLogica, we let client analytics to do this first lap of driving, and we report all the decisions made. After the recording is done, we form instructions that help us to accelerate further loops. An example of this, when we talk about simulation, people develop very complex software, relying on a very high-level tool to do that. Unfortunately, these high-level tools, although very flexible, they come at performance cost. So they cannot perform as someone with a lot of driving experience can. So what MathLogica idea was to let client analytics do its first lap, report what it's doing, and then replay it many, many times in parallel and in a very optimized way. So what we deliver is the flexibility of high-level tools and the efficiency of a very low-level optimized solution. Now, in practice, if you don't have this tool, you have to spend a lot of time and effort to get this to this performance. And you don't want to do that. Right. So what is the algorithmic differentiation part of it? Think that your objective is to minimize time lapse. And algorithmic differentiation allows you to tweak parameters of your car to minimize the speed. So you compute derivative of time lapse time with respect to parameters of your car. This is the differentiation part. It's very crucial for machine learning technique for training and for financial institutions to compute their risk. So MathLogica solves a problem on multiple scales. We provide companies with a lot of simplification so they can reduce their cost in developing. They get the performance. And what's recently become very important, we reduce CO2 footprint. Because many companies, before, they tend to just throw money at the problem. We don't like it. We don't like people to waste resources. We want to reuse what they already have. We're not new in this field. We have competition. We have competition in open source and a big game, such as TensorFlow by Google. But we are targeting a different audience, and we understand it very well. Market potential is huge. At the moment, we're focusing on financial fintech because we have a lot of experience, understand their problems. We can field benchmarks demonstrating our solution. But our solution is also scalable to general machine learning problems and science. Current status, we have had a funding from family and friends. We had a grant from Innovate UK, and now we're finishing another round for CIS this year. We also have commercial success. We have completed one regional bank for our license fee, plus we do pay POCs, plus we build more benchmarks to demonstrate how our solution functions and demonstrate the potential. So this is our projection. We started in 2019 with a small team, and now we're looking to grow and expand our sales team and development. We have a diverse team. Myself as a co-founder, and Evgeny is my classmate, my university mate, and he is our mathematical support person. Natalia, she does business development for us and team covering sales. We also have industry professionals advising us on route we can take. Yeah, so we are looking for to finalize our 95K CIS round. We have a little room available there. When we started this event, we had full amount available, but now our current investors stepped in, and we have just a little bit there available. But we're looking for connections to do our EIS round following year. Thank you very much.
Thank you so much, Dimitri. Next up, we have Oliver Baker, CEO of Ambient Heating.
Oh, right. Well, good afternoon, everyone. Welcome to the Graveyard Slot, and thank you for your interest in ambient heating. My name is Oliver Baker. I'm the CEO, and I'm joined today by my colleague Richard Davis, who's just at the back there, and we'll both be delighted to see you afterwards. Oh, I see. So our purpose. The purpose of Ambient is to become the primary low-carbon heating technology for the home and office in competition with heat pumps on the path to net zero. If we do that, this will be, or when we do that, this will be a company of national significance, if not international significance, given the size of the net zero project. The problem we're fixing is quite simply that the cost of electricity, and we've got to migrate to electricity, is 4 times the cost of gas. It is widely accepted that low carbon homes will use electricity rather than gas. And so in a straight switch of technologies, if we do nothing clever, we're going to be simply increasing your utility bill by 4 times the moment you try to go with a net zero agenda. And therefore, electric solutions need, frankly, ultra levels of performance in order to achieve net zero, whilst at the same time avoiding fuel poverty. And there is one technology that is heroically doing this already, and it's called heat pumps, and we're all quite familiar with them. The advantage of heat pumps is they have a 3 times coefficient, which means they produce thermal performance or thermal comfort using only 1/3 of the energy of a conventional system. So that's a good step towards clawing back that difference in unit cost of energy. The downside is that they are expensive, some 60% more than other conventional systems, and they're unsuitable for all sorts of building types, up to half the UK housing stock, by virtue of their poor thermal efficiency, the size of the building, or the fact that they're high rise. So what's the solution? Well, we have the solution. It's called computer controlled infrared, CCIR. We're very keen to differentiate ourselves from infrared generally. CCIR has 2.69 times the energy performance of a conventional system. So we're right up in the heat pump area. Our costs are 40% below heat pumps, and we are suitable for all housing stock, including small, high-rise, and less thermally efficient buildings. So this is what the market wants. Heat pump levels of performance, but with a much cheaper and easier install. How CCIR works. In short, we use computers and not thermostats to control the infrared system. And strange as it seems, that makes us unique in the world of infrared and indeed conventional heating. We use infrared panels, which are, by the way, totally safe. And we control them with algorithms and AI. The computer control is exploiting how infrared is absorbed and stored by building materials, so making the house a store of energy. And it does so by a controlled pulsing of electricity rather than a constant supply of electricity, and that's where the energy saving comes from. So our data tells that our systems are only pulsed on for 14.4% of the time, whilst delivering constant thermal comfort. And this, of course, is a massive energy saving, and no other infrared system on a thermostat is going to come close. So how do we compare with the competition? Let's look at a typical 2-bedroom house, which is on the diagram you can see. And as you can see in the first row, that all conventional technologies on the left on thermostats have a performance ratio of 1, whereas heat pumps on the right, and indeed ourselves, have a performance ratio of 2.6 and 2.69. That means we are 2.6 times more effective at delivering heat per kilowatt hour than the conventional systems. This means, in terms of running costs, that for this house, the cost of electricity each year is £1,000 for heat pumps and CCIR, compared to over £2,000 in conventional technology. But a heat pump has by the highest upfront cost seen in the second row at £17,600, compared to about £9,000 for CCIR, which is equivalent to a storage heater. And this is the unique combination that we bring. Very efficient running costs, but with a relatively modest upfront cost to give, in the bottom row there, the lowest lifetime cost of any technology through that unique combination. And this is the key metric in the market in which we're operating, lifetime costs. We have achieved good success to date with over 1,000 systems installed. We have customers in England, like bottom left, the 68 retirement properties in Surrey. In Wales, at Merthyr, the second one along, the 31 flats within a housing block in Merthyr. In Scotland, the tower block you can see there, we've installed over 47 systems in that block of flats, in fact, the entire block of flats, and elsewhere as well. But between all those, and indeed our 1,000, we barely scratched the surface. This is an 8 billion market. I need to remind you that 85% of UK homes are on gas at the moment. There are 1.5 million gas boilers supplied each year, mostly in the replacement market, but also in the new build market. And all that must switch to low carbon heating, electric, and it's going to do so in the next few years, as I will come on to discuss. In the short term, we're focused on the B2B market rather than B2C, for reasons around logistics mostly. And if you allow a 50% market share for heat pumps, then that describes a market for us of 1 billion a year for each and every year over the next 10 to 15 years, by which time we will have flipped into the B2C segment as well, which will double our market. And that's just in the UK. And this is a very applicable technology overseas. So we'd expect this to double and double again. Why now? The UK government is bearing down on net zero, with net zero targets for 2050. It has already decreed that there'll be no gas boilers installed from 2025 in new build. It's already flagged that from 2035, there'll be no gas that gas will be banned in all replacement technologies. And so the pressure is on right now. Customer segments are as described there, with routes to market, both direct marketing, but also working with partners in the market. And we made some considerable success in that area with some really good customers and partners in the marketplace. We're a small team of 20 based in Wakefield. Myself and Richard have a good history of growing and indeed exiting from businesses. We have a fantastic advisory board with considerable experience in clean tech and startups. We are seeking to raise £1 million in this round, of which we've already got 0.4 committed, pre-money valuation of 11.8 million. Use of funds, essentially in marketing. We're also introducing a new product with 300,000 only on day-to-day OpEx. We have a number of key milestones, which are all about beefing up our sales team in the UK to focus on regional markets. And we're also introducing a new ceiling tile version of our product in the summer. Investment highlights. We've got a unique and proven technology with the only ultra-performance electric alternative to heat pumps. We got some significant company wins already, customer wins already, and we sit facing a massive technology. There is a clean tech revolution going on out there, and we are very much part of it with a market opportunity that is absolutely enormous. So we'd be delighted to see you join us on the ride. Thank you very much.
Thank you so much, Oliver. Now we have Michael Jansen, CEO from City Zenith, joining us online.
I'm Michael Jansen, City Zenith founder and CEO. For the last 25 years, I have invented technologies that make buildings and infrastructure more efficient, more sustainable, and more profitable. Early investors in my last company multiplied their money 17 times within just a few years. And City Zenith can go much further. We recently signed $4.6 million in new contracts, and were appointed to the World Economic Forum's prestigious Global Innovators Program. So what's all the buzz about? City Zenith's 3D digital twin software platform, Smart World, is revolutionizing how major building and infrastructure projects are designed, built, and run. Developed by the chief architects behind Google Earth, Smart World makes building professionals 20% more productive, cuts 35% of operating and maintenance costs, and eliminates 50 to 100% of all carbon emissions in buildings of any size, all using one tool. Market sources say the 2020 global digital twin market was worth $3 billion and will rocket to $48 billion by 2026. And we are already recognized as an early market leader today alongside Microsoft, Siemens, and Philips. So what's driving it? A hugely inefficient built environment, costing the world hundreds of billions of dollars every year. Today, 90% of all major projects are behind schedule and over budget, and cities can be blamed for 70% of all global carbon emissions. Smart World is solving such problems, and how we do this is unique in the market. Unlike other digital twin products, it is not a service, but a true software platform that enables customers to easily create their own virtual 3D twins, integrating a vast array of data sets and AI services to solve highly complex problems common in major building projects. Real estate owners, developers, architects, city planners, and major infrastructure operators love the scalability, user-friendliness, and out-of-the-box integrations with existing tools. Indeed, this is a great time for the company and a great time for shareholders. We're now targeting a 7 to 10 times return for investors within 3 to 5 years. Or even earlier, thanks to a new regulated secondary trading platform. We're on a mission to eliminate carbon in cities around the world, one building at a time. Please visit cityzenith.com and click on Invest to find out how to join our investor community and gain real shareholder value. We've recently welcomed 5,000 new investors from over 20 countries, and we welcome you to join us too.
Fantastic. Thank you, Michael. Next, we have our next panel session of the day. Our panel of experts are going to be talking about the state of fin services in fintech. So joining us today, we have Deval Gore, Head of Mayor's International Business Programme at London and Partners, Priya Guliani, UK President of Government Blockchain Association, Andrew Aldridge, Partner and Head of Marketing at Deep Ridge Capital, Nico Buchel, Co-founder and CTO of Fiat24, Kevin Montserrat, CEO of Consilient Ventures, and Shaul David, Head of Banking at Rails Bank.
Thank you. And good afternoon, everyone. As you heard, my name is Deval. I head up the Mayor's International Business Programme. Absolute pleasure to be here. Great to be here at the Emergence 2022 conference. And as we've all been saying, it's great to see everyone in 3D. I'm sure we're not going to tire of that phrase too often, too soon. Got a panel session talking about fin services and fintech. Fintech is the phrase that I particularly am familiar with. Fin services probably less so, but I guess they're interchangeable. But we've, more importantly, we've got this expert panel who are going to be sharing their views and insights. Investors, fintechs, blockchain practitioners. Let's get stuck in. And we've got half an hour, I believe, so it's going to be pretty rapid fire. So I'm going to throw some questions over to our guests, but also please do use the opportunity to introduce yourselves, your companies, and your kind of focus areas as well. So let's get straight into it. So let's go for the jugular. And these are very open-ended questions, folks. So and some of it may be rudimentary. So please kind of run with us. But I'll start with Shaul David, who I've known for a few years. He's head of banking at Rails Bank. Shaul, will fintech startups replace traditional banks? And I'll just put a pretext because I was reading a blog by our friend Frank Skinner, who talked about fintech 1.0, disrupt and destroy, and he thinks we're at fintech 4.0, which is around collaboration, and the next one around 5.0 will be integration. Over to you, sir.
Thanks, Deval. Great to be here. But was at the last Emergence. It was 2019. Things have changed since, but great to be here. So Rails Bank is a banking as service platform. We're a global platform. We connect our customers to the global financial infrastructure so they can embed any financial product in their user experience. To answer the question, I think the short answer is no. Fintechs are not going to replace banking. Banks have a very unique place in the economy. They create money, they lend, they do a lot of things that fintechs have not done. Not fintech 1.0, not 2.0 or 3.0. Where I think we are at the moment is, I think we're starting to see, to me at least, the end of the term fintech. The 1.0 was the front end, how create better apps and better experiences for customers, but the products were the same. What we're seeing now is a separation of financial product infrastructure or manufacturing and the distribution. And the distribution is moving away from the traditional banking system and to a larger extent from the fintech 1.0 to basically anyone. Any company can now create or add a financial product that aids its customer experience. And by doing that, maybe they all become fintechs. They certainly are not banks, but if everybody's fintech, then there is no fintech anymore.
And what about how do you think the pandemic has, I mean, we've talked about this for 2 years now, you know, the digitization, acceleration of such, you know, branches versus online. You know, what have you seen at Rails Bank in that regards?
Well, we've seen a lot of interest in what we do and digitizing experiences. But again, we're seeing interest from non-financial companies. And that could be brands within retail, sports, the creator economy, any company, because every product experience either begins or ends with a financial product, be that payments, be that some kind of a buy now, pay later, or a way, or a loan, or whatever it is. And the last 2 years have really showed everybody that what you thought you needed a branch for, actually, you can achieve it in many other ways. The branches were closed for 2 years. And financially, we all still got served. So do they have a place in the future?
And one of the things I think we all appreciate is that human touch. I mean, what are we doing? We're trying to solve problems here for people often. So that's something that I certainly use as a barometer when I'm looking at solutions. Thank you. Moving on to maybe a segue, perhaps not. I'm going to move on to Priya and then Nico. Perhaps you can join in afterwards. Priya Guliani is UK president for Government Blockchain Association. Priya, this is again open-ended. I hope you don't mind. But what's the current trends that you're seeing in your space? What are the strong use cases? I keep asking that latter question because I'm still trying to find something that, at least in my simple head, I can put my arms around. But maybe your thoughts around what's happening and what you're seeing.
Sure, thank you. Open-ended questions are great because they open up more values and suggestions and opinions, so that's great. I think blockchain technology is definitely transforming regular financial processes into entirely transparent procedures built on secure and efficient transactions. According to Session, I think the size of global blockchain market is forecasted to reach about $40 billion by 2025. Blockchain is undoubtedly the most significant financial innovation of digital transactions because its management is distributed, which means it cannot be controlled by a specific individual, company, government, or bank. The total number of global blockchain wallet holders rocketed to about 80 million worldwide in 2021, which is a big evidence that blockchain technology is helping to pave the path for fully democratized financial landscape as users can finally recapture full control of their wealth. In terms of use cases, I think there are plenty in fintech, but it certainly has revolutionized KYC. So right now, trust and identity verification is performed through intermediaries and incumbents. Blockchain has the power to alter or even eliminate the trust element that's central to our current financial ecosystem. Having said that, I think blockchain is paving the path for a better flow of currency worldwide as well with respect to payments. Typically, banks would charge, for example, some 10 to 15% of the amount transferred as a remittance fees. However, with blockchain, this figure can fall as low as 3%. And then obviously DeFi transactions and cryptocurrency penetrating the mainstream economy are some of the other use cases that we can see. Thanks.
Great, thank you, Priya. I mean, my neck is going to kill me at the end of the night. It's a good thing only one person's hybrid. Nico, perhaps you can kind of come in as well and share your thoughts from the space. I mean, there's a lot of buzzwords. I mean, there's a whole kind of DeFi, Web3, NFTs, cryptocurrencies. They're all kind of all intertwined, interlinked. Maybe firstly on yourself and Fiat 21st, what you guys are doing in Europe, and then perhaps your thoughts on the space.
Our strong focus is on decentralized finance as well. That allows us to run a bank simply by smart contracts. That allows us to scale literally unlimited, and allows us to run a bank on very low cost. And that's what we are focusing on. We offer, however, DeFi nowadays is still not for everyone, it's democratic, but it's not so easy to use. So we put our focus on the user experience to onboard like the rest of the 99% of the users, and as a license Swiss bank light, we offer the on and off ramp to the DeFi space and back from the DeFi space. Actually, that's what we are focusing on.
Just generally, your thoughts on the blockchain space generally. You're in the payments space and primarily, but what are you seeing as peripheral?
Well, we offer payments as well as investing. We leverage just the blockchain for payment and the DeFi protocols for investing as well.
Great, thank you. Let's get the investors involved in this conversation. And please, folks, do chip in with your thoughts as well, because I know these questions open-ended as well, Priya. You all got thoughts and views on these things. Andrew, over to you, sir. A bit about your company, but also what are you seeing from your side in terms of how the metrics have changed? What are you looking for in terms of invested companies, and what do you expect the investee to be doing to make sure that they kind of hit your radar?
Sure. So, hi everyone. My name is Andrew Aldridge. I'm from Deepridge Capital. We invest across the tech spectrum, so we're not fintech specific. We do have a number of companies in the fintech space. I think the key thing from our perspective is I'd echo kind of the comment before that we're kind of getting towards the end of the term fintech, in the sense that what we're looking for is solutions to problems. We don't like buzzwords. We don't look for buzzwords when we're investing. We don't look for those themes. We look for companies which are solving a real life problem. And I think the other thing that I'd agree with Sean on in particular is he used the term consumer or customer engagement. And that's what fintech is, genuinely, is creating customer engagement, whether that's B2B or B2C, whether that's transaction, whether that's actual consumer engagement or whatever it might be. It's about linking entities together and improving that process. So what we're looking for in that space is organizations that have found a real world problem and have found a solution for it using the technologies on offer, which obviously Sean and Nico are doing already. And I think that's the key thing, is that anybody looking for fundraising from a VC should be articulating what their problem is and how they're solving it, not necessarily going into great depth about the technology, because ultimately the guys doing the technology are the experts. We are the ones that are trying to find that commercial gap that they're trying to fill.
And just a little bit on Deepridge, your portfolio, you're sector agnostic, is that correct? But you've got a reasonable demographic in fintech.
We are tech agnostic, so we invest across the tech spectrum and life sciences. But within our tech, we've got sustainable tech, we've got blockchain, we've got fintech. I say we don't invest in buzzwords, but we obviously do by proxy. So we are agnostic across that. We range from early stage seed, so from 50k up. Our biggest investment today is 15 million, and the cap of our companies ranges from kind of 500,000 up to 180 million. So across that early kind of seed and Series A funding space.
Yeah, and it's interesting how we've been tracking the numbers. I'm sure we all do in terms of rounds raised. Last year was a phenomenal year. I mean, quite frankly, all of the sort of models that we've been accustomed to were thrown out the window last year before, given the backdrop. Fintech seems to be still riding a wave. I think it was 164 million, if I'm not mistaken, the pitch book kind of tracked last year globally. And certainly what we're seeing on our scale up is that there are a lot of companies that join our program who are international in their growth, are kind of hitting this sort of the lower end of Series B now. I don't know whether that's a pattern or not, but
yeah, I think I'd agree. I don't think fintech's on a wave anymore. I think fintech is here. It is financial innovation going forward. It's just that it is on a tech platform, and that's how they're doing things. There was an interesting panel earlier about blockchain, etc. And I'm sure Bill will agree that blockchain is here to stay, and it's just now the platform for doing various things that probably we don't even know about yet that they're going forward, and that's in the financial space as well. So fintech is here to stay. It's not a fuzz. It's not a buzzword. It is absolutely the future of financial services, because everything has to be tech-based as we go forward.
Yeah, perfect. Kevin, I'd like to bring you into this. We were talking earlier, how do we unblock perhaps the sort of the clunky nature of the capital flows? You've got some thoughts and views on liquid versus liquid and secondary markets. Do you want to share your thoughts, and perhaps start off with yourself and Consilience Ventures?
Sure, thank you. Hi everyone, Kevin from Consilience Ventures, and effectively Consilience Ventures is our own venture capital arm at Consilience Group. So effectively we specialize in building Web3 powered infrastructure for the private markets. So we enable VC funds, incubators, accelerators to access liquidity and expertise they need to succeed. So our thesis is if we enable VCs to raise money quicker, if we enable VCs to access the expertise, the deep tech expertise that is required to actually take the businesses to market, we believe that entrepreneurs will benefit from it. So our standpoint is really about empowering the investment community around worldwide by enabling them to create liquid funds and then to help them to create pools of knowledge around their funds. And so effectively by using blockchain and Web3, effectively we are enabling those funds to be securitized. As is everybody aware of securitization is, right? We're not jargony. Everybody, if we're going too fast, just let us know as well, because we can be very jargony. So what does that mean? Here it means that when you create a liquid fund, it means that you can use the assets as a payment method. And it's completely changing the way effectively funds will operate in the future, because the wealth will be distributed with the people working around those funds. And that's really what excites us here in this market, is that the entrepreneurship world should be open to everyone. It should not be exclusive to only certain male and then only with some kind of people with some kind of privilege. It should be open to everybody. And this is what actually Web3 is actually doing. It's opening up the market. It's about democratizing the world of entrepreneurship. It's about democratizing access to capital. And we can't do that today with the current VC fund structures. And so effectively what we are offering is a complementary solution that works alongside the traditional VC to enable funds to be more liquid and to enable them to engage their community so that their startups can build with the market and not for the market. And there's a radical difference here in terms of building with and for. And that's really why DeFi has a massive potential here, because there is no intermediary anymore. I'm building with my customers right away. And I think this is what's exciting about the DeFi world.
Yeah, it's fascinating how online communities have galvanized, convalesced, and the power they yield. We know the stories. We saw it last year. And I guess what we were saying earlier is just the ability to be able to extend out opportunities and expose retail investors. There's a discussion about literacy and understanding as to risk management, but nevertheless, starting with your opportunity to invest in companies that perhaps weren't available to you. You want to share some thoughts?
Yeah, absolutely. I think that's where in the UK we've got, we talked about liquidity, we talked about kind of funding structure. I think we still got a very, they're trying, but the FCA in the UK are still very archaic. So if organisations trying to raise funds, there are still barriers and structural barriers in the way. So, for example, you talk about retail investors or Joe Blogs on the street, if you like, kind of wanting to get invested in early stage companies. There was a hell of a lot of barriers in the way from the FCA preventing that. There's the technology there, there's the VCs there, there's the managers there. Actually distributing that to the end user is actually the biggest problem at the moment we've got. And then beyond that, in terms of liquidity, beyond that, in terms of later stage, is that we're still in the UK, we're still miles behind the US in terms of kind of secondary funding and IPOs, etc., and then floating businesses.
Even worldwide, I'm just going to try to interact with the audience here. The private market is about 6 trillion, right? It's actually 13 trillion if you include real estate and pension. But if you just focus on the private market, do you guys have an idea of the percentage of actually secondary shares transaction? Have an idea of a $6 trillion market, how much of that is moving, to a second hand? Just have some guess. Everybody wants to go. Nobody wants to go. Everybody's shy. Yeah. 10%. Do we have more? Do we have less? Of the $6 trillion market, of the private market, 0.5%. The reality is we've got 2% transacting, and so it's a $6 trillion market, and only 2% is changing hand on the secondary market. So even if in the US they are a bit more advanced, we have still 98% to go. Yeah.
That's an interesting point, and it's not just from the investor perspective. It's distribution, right? There's how do we get to the 99%? How do you get to the 98%? And for your investee companies, how do they reach the 99 percentage? And this is the great question around fintech and for all companies. How do you start from scratch? Do you build the tools and then you go out for after 6 billion? How much you have to spend for that? Or do you B2B, which again, some fintechs have turned B2B in order to gain advantage from customers that have already got their own community. So is it a building a community? And I don't believe in nobody builds a community. Community either creates itself and you tap into it, or you're not. But it's all around distribution is the key.
I can see, Bria, I'm not sure whether I was reading your body language. You're nodding away. Any thoughts from yourself?
No, I've just been inching actually to answer your first question and then sort of put a wrapper to what Andrew and Sean mentioned before. So we normally just talk about either's and or's, that whether it's traditional banking or it's startups. I wanted to say that why don't we actually think of or promote the partnership model, because both of the models have their own advantages in terms of, for example, when you talk about banks, they have consumers always trust banks over startup companies to responsibly hold their money. And then banks have decades of trust built through customer relationships, right? And then if we talk about fintechs, with obviously they having those flatter organizational structure, have the ability to pivot and iterate and ease of adopting new technologies, that seems to have like a clear advantage compared to banks. And they can obviously target niches, as Andrew mentioned, personalize the experience they deliver, solving particular problems, and remain relevant as technology trends and user expectations change rapidly, which is quite difficult for otherwise banks to do. So I just wanted to sort of wrap around and say that I don't think it's a question of either and or. It's about combining the two for value-added benefits. Banks would obviously gain technology and insights from mergers, acquiring startup companies or mentorship programs. And then the fintechs can gain from what banks have acquired thus far, the customer relationships and etc.
Thank you, Priya. It just reminded me, and we've heard the story about Apple purchasing Credit Kudos. I think just as a slight tangent, I mean, I find that fascinating. I mean, I guess it was inevitable, but as that operating system they've just purchased, in terms of that data play and credit rating, and what they build on top of that would be interesting to observe. I'm just very conscious of time. I want to just kind of bring it down to earth and just ask you guys, and Priya, what are you seeing in terms of challenges? I mean, we are, you know, we sometimes we can be accused of drinking the Kool-Aid, particularly here in London, when it comes to fintech, which is a good thing because the numbers stack up. But nevertheless, it's not all easy. I just want to hear from you as to what you see ahead and some key challenges that you're trying to overcome.
So I'll just get started with one of the biggest challenges. It's us. The challenge is the education, is that most people are not coping up with the pace of innovation, and we are all just so far behind what's going on in real. So we're all specialists here, and we know exactly what's going on in our industry, but we know that as soon as we are stepping out of this industry, we're completely lost. And so we just have to recognize first that we know nothing, and we just have to work as communities to be able to tackle the big challenges ahead of us. And that's why I'll just reiterate by saying that Web3, it's about a community. It's about us together going after the biggest challenge. We can't be divided. We can't be segregated. We just have to work together. And I think this is really the biggest challenge. It's about education. It's about being aware that we've got to work together, and there are now systems that we can use to work together, but we have to be educated.
Thank you. Here. I echo that.
You want me to go on?
I'll go back to my last point about reaching out to the 98. I mean, again, we are speaking in a bit of a bubble here in London or elsewhere. There's a lot of people that don't see the benefits. We call it underserved or underbanked or unbanked. There are the people that might have a bank account, but they can't access some of the products, or they don't want to, or all sorts of other reasons why they're not maximizing the available products. How do we reach them? How do we convince them that they to trust the system? How do we convince them to do more? Yeah, I think that's the biggest challenge. It's not about technology.
Nico?
Yeah, one of the challenges is also if you're talking about community, it's about regulations as well. So it's important to be in a jurisdiction which openly supports blockchain and DeFi space.
Thank you. Andrew, and then we hand over to Priya.
Yeah, I think I touched on it before. I think it is that further stage funding for companies. I think in the UK, we've got a fantastic early stage ecosystem of funding. Yeah, we've got a great angel community. We've got some great seed-stage funding. Things like the Enterprise Investment Scheme, the Seed Enterprise Investment Scheme are great tools in the UK for starting a tech business and growing that business. But I think once you get to kind of beyond Series B, so there's a lot of private equity business cash flowing around. Once you get beyond that, you still don't have the appetite for IPOs in the UK for tech companies. That's still got to mature. And that whole kind of later stage will drag along the industry with it. Whereas at the moment in the UK, particularly in London, London is great. It's a fintech hub, absolutely stunning. It's also one of the financial capitals of the world, and that hasn't caught up yet with the fintech revolution. So I think that's going to be the next stage, is when you start to see the FTSE 100 and 250 made up of fintech companies.
Agreed. Last word from you, Priya.
Sure, yes. I think I was going to talk about regulatory regimes because regulation of cryptocurrencies and DeFi more broadly would determine the role played by banks and other traditional financial institutions, but that's already taken. So I'm going to point at cybercrime. Every organization has to consider the inherent link between performance, innovation, and cyber risk, and realize that protecting everything is not going to be economically viable or even possible. So you have to think of what are the most important strategic initiatives that can help you out. But obviously, if you talk about public blockchains, they are potentially compared with internet, and private blockchains could be compared with the intranet. So attackers always seek for low hanging fruit from side to side, and confidential information stored on a blockchain will likely become a high priority target if such controls were inadequate. So I think that's cybercrime, and having the right cybersecurity arrangements is quite important.
Thank you, Priya. Look, I mean, half an hour, some pretty chunky topics that we tried to skim over. If only we had another half an hour, but I think we're closing up now soon. So a round of applause to our guests, our panelists. Thank you very much. And if you guys want to contact any of these folks, including Priya, I think their contact details will be shared at some point soon. Thank you.
Thank you so much.
Thank you so much, guys. Thank you for coming in. That was really, really great. We're now going to have a 10-minute break. So please feel free to go out and get a coffee. And then we'll come back in for the final presentations of the day and the final panel session. And then after that, please stick around because we have drinks for a networking session. So I'll see you in 10 minutes.
Goes 1, 2, 3. This goes left, right. Can I test it? Ah, it's a small, okay.
How far into last time?
1, 2, 3. 1, 2, 3. It's not very long.
Afternoon, everyone. Thank you for joining us. We're going to start the next section of the presentations with Ralph Knoll, founder and CEO of Impotech.
Inoptech. Great. Thank you very much. Good evening, everyone. My name is Ralph Knoll. I'm the founder and CEO of Inoptech. Inoptech delivers safety and performance for everyone who's moving fast in different light situations. And it gives you lots of advantages, which I will show you in a minute. It's a vision enhancement system comprising glasses and lamps. So we were awarded Innovator of the Year at the New Scientist Show in London. This is our latest design. Here are some problems we can solve. 10% fatal accidents are happening due to impaired vision. We can solve this. We are potentially life-saving. Also, AR displays are not readable against the sun. We can solve this problem. Pilots are complaining about lightning, deep standing sun, and so on. Again, this problem can be solved. Even in outdoor sports situation, you have sometimes challenging light situations where you have an accident. You can prevent this. As you all know, displays are not readable in the sun. You know this when you have your laptop in your garden, but we can solve this problem. Also, AR, like Samsung, Google, Facebook, they cannot operate outdoors because they cannot dim the light. And if you want to see AR content against the sun, you need our system. Last thing, and this is another vertical, very important one, which we will address in the first place. We have already learned it's a horizontal technology with many, many applications, but we need to focus on one vertical at the beginning, especially as a startup, and this is migraine. There are 5% migraine patients in the world, super light sensitive. The migraine can be triggered by light. Little bit of background. For the past 200,000 years, our whole visual system was trained for walking speeds. However, people today travel faster than walking speeds. We have wheels and wings. So for this reason, even for healthy people, our eyes are outdated. We need our upgrade. Little joke here. But it's true. It sounds funny, but it takes 30 seconds to adapt if you run into a dark tunnel. And we can shrink the 30 seconds down to 0 so that you can see instantly in the dark. And this is the advantage. Again, the guy with the migraine, we can protect him from too much light. Here's an example. As you can see, this arrow is changing, and this is the normal sunglass, and the intensity is also changing inside, because the sunglass is nothing else than a piece of glass with a little fixed tint. And here you can see the arrow is not changing. So we keep the illumination at the eye always like a flat line. It's always constant. We cancel out all the variation. It's basically the anti-noise for light. You're getting this? This is a very important slide. If you understand this slide, then you understand what we are doing. Here is the same, in other words. You enter a tunnel, you leave the tunnel, but the illumination at the eye is a flat line. It's always constant, and you can pick how bright you want to have it. And this is worldwide patented. It is unique. We are the only company which is able to do this.
On a little side note, we can also distinguish light. I don't want to go too deep into it. It means basically if you have two rays, one is called signal, one is noise. With a normal sunglass, you cannot distinguish these different kinds of light. So in other words, we can distinguish light with our smart glasses and lamps, and this is the outcome. All essential displays are visible no matter what, and therefore, again, it could be potentially life-saving. So let me summarize this briefly. You have seen, number one, we deliver instant adaptation in real time. So when you enter a tunnel, and this "and" is very important because we can do both. We can enhance the contrast because humans cannot see against the sun. In other words, we provide you new human abilities. Please forgive me for the Superman, but I think it's a good picture because now you can go beyond yourself. And migraine patients are in full control over their own lives. Here's a list. I don't want to go through the whole list, but you see already there's a B2B market and a B2C market. And within B2C, we are addressing the first one, which is migraine. The numbers are fairly big. 5% have it, have this have migraine, and 65% have light sensitivity. So we are looking at 3% of the world. You have to remember this number. It's a huge market. It's really big. They don't want to take more opioids. They want to avoid pain, and therefore they are willing to pay any price. Price elasticity of demand is similar to insulin or pacemakers. What we do, we combine 4 different sunglasses into one. So currently, what these migraine patients do, they change the glasses with closed eyes. They fiddle out another sunglass, and this is super dangerous and annoying. And we say, keep the eyes open, and we deliver an all-in-one solution. So at the Biohacker Summit, I learned from ladies like this, they want to buy it. They endorsed it already. It's very interesting for them. The market is very big, potentially 1 billion if I combine summer sports and winter sports with the migraine. So it's in total a very big market. The margin is 400 euros. So we earn 400 euros contribution margin per glass. We will sell it online. We have all the patents. It was the most massive patent filing in the history of the startup, I guess. I've been told so, with 8 patents in 10 countries. We have a good team, very experienced, all boomers. Yeah, we showcased that the technology worked on various shows. Here I'm sitting, but the lady is protected from the glass, from the light. We have been endorsed publicly by the president of AA for having a very good technology. This is the money we need, about 2 million, to finalize the product, and business angels can invest in my own holding, or alternatively, they can invest directly into an optech. Those doors are open. We can also carve out industry-specific daughter companies if we want to. So we're actually talking about 3 potential exit cases. So if you invest in the tip of the whole construct, you can benefit in any case. So this was my presentation. Share price is going up. Still, we made already 400%, and we will deliver a tenfold if you decide to invest. I thank you very much. And if you want to get in contact, I'm in Germany, but the company is a UK company. Thanks a lot.
Thank you, Ralph. Now we have Marcus Belletti, founder and CEO of Loretti.
Hi, I'm Marcus Belletti. I'm the founder of a company that is going to focus on modern mobility. At Loretti, we believe in mobility working for people, not the other way around. For that, the future of mobility has to be global, connected, secure, seamless, and accessible. The last 100 years, the cars have always been about the driver. The next 100 will be about the passenger. As you can see, the electric and autonomous technologies are already taking over mobility. So the real question is, if you don't have to drive a car, how would you spend your time in it? Corporate travelers today are suffering from productivity loss, efficiency, costly bills, and fragmentation. So we're creating a mobility tech solution that is going to give back the richness of time, to be more productive, to be more connected, and energized. Let's take an example here. On a typical international journey, let's build a scenario. I'm sure most of you will have experienced something similar to this, where let's say you have a 5 o'clock flight to Frankfurt. You took a ride or drove to airport, you waited there, and you got another ride on the other side of the destination. And by the time you got to the meeting, the entire day is dominated by it. So there is a loss of productivity in all of this. So what we're trying to do with Lawton is that we're building a software and hardware combination to make this car as a smart device. So that way, imagine in the same scenario I gave you, you got into the car, and the car understands the purpose of your journey, and you need to pull up your work data. It's right there in front of you. Right. These are 3 modes in the car that our hardware software solution is being enabled to provide that end-to-end connectivity during the trip change. Productive mode, you can pull up your work data as you sit in the car, so there's no need to pull out your laptop. And that's my favorite feature, by the way. It's Explorer mode. Imagine in that international trip, you're going from place to place, and how many times have you missed something very interesting when we've been into to places that we haven't been before? So that heads-up display, it brings in all the interesting places and local attractions to your preference. So it's all AI powered. And the third bit is, this is, imagine you're going on a family trip, you want to distract your kids and put them at the rear seat and switch on, activate the cabin theater. You got on-demand movies or games, activate them. So that's our car. And the entire experience is enabled by a core technology called Mira.os. Mira is an AI-powered operating system that acts like a personal assistant when you're in the car, but also creates that experience beyond the vehicle door. Now, Mira is also a multi-purpose technology that works hand in hand with the fleet companies, corporations, and also B2B, B2C family office, super-driven families. So a good use case here is, as and when fleet companies mostly use a huge fleet management software, what our system does, it sits side by side with the fleet management software, creating that administrative interface where you can bring all your operation on a single iPad. The same thing is true for the for multinational corporations as well. So let's imagine IBM or any of these big companies in different cities. It brings up all the executive itineraries or create the visibility and predictability between those itineraries onto a same platform, which connects to the car. So that way, your entire mobility is streamlined. So this way, every Mira user can connect to every Lawton vehicle, and vice versa. Now, Lawton is, I mean, the whole system with Mira.os is about creating or making mobility as a two-sided interaction between the passenger and the vehicle. So we're the first company to be installing this technology in the car. And our business model is quite modular. The development model is 80% of our car is sourced as a single commodity, and we install our proprietary components such as design, technology, and interior componentry to create that experience. And of course, as it comes out, the best way to understand this is the overpitch model. Overpitch, they use Range Rovers and do up the interior, right? So in our case, we put in the technology in there. So whoever the partner OEM is, the differentiation here is you don't buy just the vehicle, buy the entire ecosystem. That's our USP. And just like our development approach, our offering is also quite modular. Any hero user will be able to access our vehicles on demand, just like Uber. And our vehicle target price is 80,000. So currently we have 3 dealerships signed already internationally. And a lot of our technology is also transferable to other modes of transport. For example, for the last 50 years or so, nobody in the auto industry lagged behind updating passenger experience. That means we left the seat as it is. So Loyalty is a place where you got in a study, let's say, you had 6 hours of flight and 45 minutes of journey ahead in the car. So we all know that the last leg of the journey usually creates a lot of fatigue. And we brought in, this is a place where we have osteopathic experts sitting down with neuro experts to create that sleep. And based on your body postures and how the entire seat interacts with you, taking that stress data from the body. And we have a lot of software revenue software and service revenue from on-demand mobility users. We also have a lot of technology licensing for multimodal. We're currently signed up with a couple of train companies in Europe, and also one airline company. Our market strategy is quite self-reinforcing. A lot of our product is mostly digital and software. So we plan to install that basic version in on-demand taxis, such as London taxis, New York, and Luxembourg. So that way we can introduce what the Loyalty way of traveling feels like. This way, it does 3 things for us. 1, it captures users into the ecosystem. Second, it validates our pricing assumptions and helps us to roll out globally more smoothly in, let's say, months or so. And the third is to increase the demand for our flagship product, which is Mira One, which is a car. Just scoping the fleet market and on-demand TAM is over $1 billion. And we haven't really priced out any European and American markets because B2C is fairly for our Middle Eastern and Asian markets. So that's where we're selling the vehicle as a single component. The difference between our competitors and us is that our competitors focus on the product. We focus on ecosystem. If you want to address mobility as a whole, you focus on the journey, not on the car. So this is where the ecosystem proposition becomes quite important. Someone told me once, a great product influences markets in a great way. Great ecosystems, great economy. So, and it is true for us because we are able to naturally be able to convert our competition into partners. And a lot of partners actually came from our competition side as well. Our business modes are primarily supported by these elements. Back in 2018, when nobody was focusing on passenger experience, we're the first ones to develop the technology and introduce that into the market. And soon after we announced, major OEMs, Mercedes and VW, have announced some similar technologies as well. And our entire business model is based on the partnership model. Currently, we have a couple of British OEMs and a European OEM as an option for us to source the vehicle. And we've been back in 2018, when we first started the company. We introduced this operating system to be in just for the car. But what's been proven in the last 4 or 5 years is that a lot of multimodal companies, including a company that's designing Hyperloop, they basically came to us and they're interested in buying our technology. And this all validates our business model at the moment.
Sujith, I'm going to have to stop you there. We're out of time. Sorry. Thank you so much for coming. Next up, we have Anna Arno from. Sorry, Sujith, I'm so sorry, Mark.
That's all right.
It's been a long day.
By the way, we are fully subscribed as of yesterday.
Thank you, Marcus. Sorry to cut you off there. Now we have Dr. Sujith Krishnan, founder and CEO of Metronomic Inc.
Thank you. Marcus, you can't leave the room, I suppose. You've taken 6 minutes of my time. Anyway, so my name is Dr. Sujith Krishnan. I used to be a surgeon in my previous life. I haven't practiced for like 15 years, so don't come to me for medical advice, definitely. I run a company called Metronomic. We've got a company in the UK called Metronomic Limited and a US subsidiary called Metronomic Inc. We are primarily focused on the US market. And at this point, what we do is offer a solution for maternity. Our long-term goal is to kind of build condition-specific platforms and apps that will cover various chronic diseases. But we started off with maternity, trying to address the problem of maternity primarily in the US market. There are about 4 million deliveries every year in the US. A large portion of that do encounter complications. Diabetes, preeclampsia, preterm, these are kind of some of the common issues that pregnant mothers go through. In spite of all of the advances in medical technology, you still have issues of this sort, and a large portion of them are not identified early enough, so that you end up with, say, a preterm potentially happening without prediction, or a GDM, gestational diabetes, happening without being predicted, and you end up with potentially, a C-section earlier than you would have expected. I have an interesting story about my son's birth, which probably take up about 12 minutes if I actually spend 10 minutes here, but I'm outside. You can come and talk to me when I'm there, and I'll tell you the long, interesting story. My son, just a short version of that. We were hoping that he would share his birthday with Barack Obama, but eventually he ended up being born on the 14th of June, which is Donald Trump's birthday. So that was obviously an issue that we didn't, figure out. My wife ended up with, late-stage gestational diabetes, which wasn't predicted, and then she had a C-section that that potentially was kind of something that we think we should have been, we should have been prevented. So the other thing about maternity, I suppose, is that pregnant mothers use a lot of aids, social tools, things like what to expect and all that. But generally, there's very little that flows from the doctor to the patient between the visits. They usually see the doctor every 4 or 6 weeks. And after that, it's all Facebook and what to expect and, baby center. Very little clinical advice coming between visits from the care team to the patient. And so this is kind of what we try to address with our platform called Materno. Materno essentially is a doctor-to-patient communication platform. It combines a lot of technology and clinical sort of, clinical guidance into the technology. So there are 3 tenets we've kept in mind as we built it. The first is about being appropriate. So we've actually created the care plans and the clinical evidence-based guidelines into the platform so that the doctors can, stratify patients based on risk and then put them on the appropriate plan based on the cohort that they belong to. It should be based on, say, their ethnicity or their risk profile or even their comorbidity. We also are working on AI algorithms that allow us to predict risk early. So as early as, let's say, the first trimester, we're trying to predict the risk of the 4 or 5 major complications that we think, lead to a lot of cost in pregnancy. The second part of our platform is focused on accountability, putting, control both in the hands of the patient and the clinician, the physician, so that both of them have all of the advice that's uniformly spread out and both of them can focus on their own condition and their outcomes. The last aspect, obviously, is affordability. In the US, obviously, cost of healthcare is a big issue. Pregnancy, I suppose, the total spend in maternity is about $160 billion for the 4 million deliveries that happen every year. A large part of that is because of complications. The week spent in NICU is an extra $100,000 to the insurance company. So the idea with a platform like Materno is to try and pick complications early so that eventually the cost of care comes down and out-of-pocket costs also go down. In terms of the platform itself, there are 4 major modules. The first one is a care plan module, which is where the doctors get interested by, which is evidence-based protocols that have integrated into the technology so that they can put their patients in the right care plan based on the cohort that the patient belongs to. And we also allow them to personalize the plan for the individual doctor, for the individual patient. The second part is the telehealth capability, which combines audio, video, and chat into an integrated sort of interface with the clinical data right there around it. The third part is the remote monitoring. We kind of integrate Bluetooth devices so that physiological parameters can be captured real time and then made available to the treating team on a dashboard so that they can take the right sort of decisions and escalate where needed. The final part is the app itself, which is what the patient uses, which is where all her data sits, and it's available to the clinical team every time she goes, and also the long-term goal with the platform is one, to use the historic data that's available with the group to try and build predictive algorithms based on patterns designed to identify for some of the major problems. And also use the real-time data that comes from the remote monitoring system to potentially inform the risk for that incident. So obviously, the platform is focused on the patient and the physician, and those are the two sort of key stakeholders. In the US, obviously, all of this is driven by insurance. For the payers, the benefit over the next few years, hopefully, with our platform, would be lower insurance payer. For the patient, it's better sort of outcomes and better communication with their doctor, and for the doctor, hopefully increased revenues and better patient satisfaction. So this is the market size. Femtech market across the world, about roughly $90 billion. The US is obviously the biggest chunk of that. More than half of the money gets spent there. In the femtech space, the pregnancy solutions, the digital solutions for pregnancy are about $2.5 to $3 billion right now, which is expected to grow to about $11.5 to $12 billion in the next 9 to 10 years. There's a lot of out-of-pocket spend already by pregnant mothers on various sort of aids, and so that's the sort of area we're looking to target. I'm hoping I can ignore you. Sorry, like the previous person there. So, like I said, the complications that we're targeting are things like DBM and preeclampsia. And so, in very simple terms, the mothers are monitored a little more, aggressively in that sense, and so we pick up things that are happening. This is the business model. We offer the platform for free to the doctors and the patients, paid for by insurance largely. There are 4 new codes that CMS in the US has come up with for remote monitoring and care management, which wasn't traditionally used in pregnancy. Those were generally used in chronic diseases, but RPM is now becoming the norm in pregnancy as well. And so that's kind of what we're targeting, try and figure out whether we can, build extra codes and generate that extra revenue, both for the physicians and obviously for us. We also run the service along with it, not just the platform. We offer them the care management service. We actually have care managers in-house who are kind of the pregnancy coaches that the patients in practice are right. In terms of competition, the closest competition for us is a company called BabyScript that's been around for about 8 years. We're obviously much newer, and we think we've built a better solution than they have. A lot of clients that are already using BabyScript are talking to us because they like our solution better. And in terms of go-to-market, our initial focus are these the private sort of OBGYNs in the US, are about 15,000 of them, who are called the self-employed OBs. And then the next step would be to go to the bigger groups of the provider chains. And the last step, obviously, is global rollout. This is the team. I'm the founder. My co-founder is kind of a silent partner, is the initial investor in the company, is based in the US. The team is largely focused on the US market, head of sales there as well, and the CMO based in India. In terms of timelines, we raised about 1.2 million so far to build the platform. We spent the last year and a half, roughly 2 years, building the tech. The tech team is largely based out of India. I'm based here in the UK, and the sales is in the US. We've started doing early trials from 2021, and then we just about launched. Now we've actually done a commercial launch in Maryland last month with actual, bills going out insurance company. We look to raise 5 million for a fee with a safe that's open. Doing the 1 million safe parallelly along with the 5 million safe on the rate. So the safe is probably the easiest for early bit coming to our company. The 5 million is to get us to that sort of stage. Get about 200 doctors onboarded, 10,000 active users, and reach about 250,000 and monthly revenue. Beyond maternity, obviously, other areas of women's health, infertility, postnatal, there's lots of things that we can do beyond the pregnancy area itself. And then post that, we intend to focus on other products. That's the thing. If you scan the QR code, you'll get more information. And I'm outside. I'm the one who doesn't have any standees behind. So look out for me.
Thank you so much, Sujit. Next up, we have Alina Arno, Sustainable Investment Specialist from Bedford Row Capital.
Hi, hello. First of all, thank you for staying here. Thank you for staying here at 4 p.m. because I know that many of you are already tired and want to get home. So I will make sure to keep it short. My name is Alina Arno. I'm Sustainable Investment Associate, and my personal role in this process is to help investment managers to do good and to raise money. So Bedford Row Capital effectively provides the same sort of role as investment banks, or as it was called, merchant banks. We help companies access global market. So in 2008, when the financial crisis happened, all the investment banks were concentrating only on huge benchmarks and large issues, and ignoring mostly the market, the issuance market. So in 2016, Bedford Row Capital came, and hence all the products which we have are unique because you will not find them at a huge investment bank, which gave us availability to receive a couple of awards, which you can see on the slide. So everything what we do is listed on the Frankfurt Stock Exchange. So we've done first listed for European fixed corporate. We went through step market approval, and in 2018, we became private limited company and first listed originate to distribute transaction in Europe. So I will start with the second point here, why I'm actually staying here. So I have a unique opportunity to access yield and liquidity, and I promote investment opportunities that were recently structured. So we complete the origination and syndication solutions for issuance of that instruments, which you can find on the slides, which are high yield bonds, short-term commercial papers, green bonds, and actively managed rate. I want to highlight the fact that here you have the ability to source a range of different products. So my colleague will join to say that we're using proprietary blockchain tech.
Sorry, I forgot to introduce me. My name is Ayman. I'm a relationship manager in Bedford Row Capital, as well as a consultant. As a financier myself, I find it sometimes, I do get investors that confirm that they want to invest in our product, but it's very hard sometimes for the investment to reach the company itself. Therefore, Bedford Row Capital, we've developed this proprietary blockchain technology, which enables transparency and accountability when it comes to the transaction process, meaning that there's a daily reconciliation, investments, and associated impacts on fields available for the distributors that confirm these investments, but also then make sure that the money is then smoothly allocated to the products these investors want to invest in. So yeah.
So these are recently open investment opportunities which we have to today's landscape. The first one is RSP Sustainable Income, which seeks to outperform EPOR plus 550 BPS. They seek to find better returns investing in sustainable companies. Recently, it has plus 18%. The second one is gold streaming and royalty financing, which is called Webster. It's 11%. The maturity is 3 years. I will come back to this one on the next slide as we have a proper case study. The third one is ethical Bangladeshi conglomerate. It's 9%. It's it is called Dishbandung. It includes a couple of factors inside, which are the sugar and textiles, and these returns in dollars, hard currency. Fourth one is disruptive patented clean tech, Altec Chemical, which is 11.35%. They provide 99% retention, which is quite popular nowadays in the market of electric vehicles. This is one of the key materials we use. So yeah, why Raptor? It is a business model that enters through commodity cycles, making Raptor a stable proposition for this volatile time, which we currently have. The first one is a unique business model of gold streaming and royalty financing. It has good returns. It has exposure to gold, and it's inflation resistant. It's very relevant to nowadays. It is diversified and scalable. It is diversified also by region. It is in US, it is in Canada, Australia, and New Zealand. It is an ethical investment which follows a couple of sustainable development goals followed by United Nations. And it has management with 50+ years of mining experience. So this is pretty much the whole information which I have for you today. So I'm very happy to answer any questions you have, and don't be afraid of me, or if me or anyone will come to you and ask for your business card. And now you have me here on stage, and I'm happy to answer anything you have.
Yeah, so in summary, we don't only just market investment opportunities, structure and market investment opportunities, but at the same time, we look for innovative products, and we do the structuring for them as well. So if you guys have any questions on our company's operations and stuff, feel free to ask. Thank you.
Fantastic. Thank you, Alina. Next, we have Asad Khan, founder and CEO from Snowflake Luxury Gelato.
Thank you. Afternoon. So quite a unique opportunity for us to be here today. I think we're the only ones offering gelato as well. So you can taste our products, which is a great differentiator. So I'm founder and CEO of Snowflake Gelato. Started out 10 years ago, and it's been an exciting, really interesting journey. Before that, I was in finance, and I thought I'd leave the corporate world to do something really trendy and cool, which started a gelato brand. It was pretty trendy. It wasn't that cool in terms of the hard work, and it's been a great, great journey. And I'll talk a bit about our journey so far and the success that we've had, what we're looking for raising funds for, and what our growth plans are. So our vision is to become the world's most loved gelato brand. And I don't say that flippantly. We've been established 10 years. Our repeat customer base is 70%. So we've got a really, really loyal customer base. Once people try our gelato, like many of you may have had the opportunity to, if you haven't, please do come to Paolo Riviero, our head chef. He's there and providing our quality gelato sample. So becoming the most loved gelato brand for us is our global kind of vision. We are also now a global brand, which I'll come on to in a second. So the story so far. Just bring up this quick timeline. So we started out in 2012 with our first store in humble Westbourne Grove. And within 2 years, we won Great Taste Supreme Champion, which is the BAFTA for food. Our raspberry sorbetto was the #1 product out of 10,000 products that year that was submitted into that competition. And winning that spurred us into both Harvey Nichols, and then we got a pop-up at Selfridges. We then remained in Selfridges for a further 5 years, and we then opened up in some flagship locations such as South Kensington, Marble Arch. We've been in Bicester Village for 3 years out of the last 5, which is a great accolade as well to our brand and to our kind of success as a retailer. And we then launched this great product called the Billionaire Soft Serve that got us on CNBC and over 112 million hits in terms of views of individual users seeing that great product. It was an ice cream cone sold for £99, and we sold quite a few of them. It's quite iconic, and it was a big splash on lots of media. The following year, we did another big hit with something called Avolato, a vegan-based avocado product served in the avocado shell. Again, a big, big global hit. Business Insider's so innovation is a big part of what we've done, and we want to grow on that side as well. Last year, we launched our first international store in Jeddah through a franchise program. And we also went on to the sea on Carnival cruises. So we've got 2 parlours serving our gelato. In that time, we've won over 30 Great Taste parlours as well. So in terms of awards and accolades, we are the most awarded gelateria in the whole of the UK. So Snowflake is about great provenance. We use organic Jersey milk and cream with all of our gelato. We use fresh fruits for our sorbetto. And for example, our raspberry sorbetto, which was Supreme Champion, has some simple ingredients: fresh raspberries, Kent or Scottish, spring water, grape sugar, and pectin, one single stabilizer, which is a natural one. So we really are about premium ingredients, provenance. We're a creative brand, we're an aspirational brand, and we have transparency in everything we put into our products. So our gelato, we make it as a clean label product as possible. Organic Jersey milk, organic Jersey cream, great Italian pistachios, or it might be hazelnuts, whatever the ingredients might be. But we choose the best ingredients that go into our gelato, and you know, we really are proud of having a great quality product, which is renowned across London. Talks a bit about the awards there. That's Paolo and I back in 2014 with the Great Taste, and the coverage we had. We were on ITV Live. We were on Channel 4, CNBC. Great coverage. Real great hits. We've had, and what we're looking to do as part of our growth is to we can also more products, which was a huge hit with the millions of kind of people covering it. That became the single best-selling product in June 2021. The single best-selling, that doubled our revenue in the previous year, and that month as well. Real great hit. So the market, in terms of where we're at, we're in a iconic location, London, where we're expanding now as well. And we win deals, landlords, and again and again. This is the village, Westfield, London. We were in 2018, and we got 4 awarded West Stratford. We've got a great relationship, great landlords. Might be able to build those partnerships and work with them. And we're also working with TfL and access to our organization. So that's our journey to date. It's been an exciting, incredible journey. It's becoming a global brand already, and also winning so many awards and great kind of coverage. So the journey ahead, you know, what that's like. So June of this year, 3 sites on the side of top line, and we're going to run those corporate sites for our strategy going forward. Franchise one. We have like numbers on this one, so it's important for us to do ourselves directly. We're opening in Qatar, the location in Qatar. It's been announced later on this year, but it's a very prime location. They're having the World Cup there this year as well. That's a flagship. 2 sites opening up this year. In South Korea, we're at head to term stage for a 50-store rollout for 3 years in South Korea, and we're also in discussions for a unit in Dubai and Kuwait. In terms of where we're at in the market, the competition, there's a size for gelato. So gelato is kind of a bit more premium quality Italian ice cream versus kind of traditional ice cream, American brands like Ben & Jerry's or Haagen-Dazs. It's much more authentic and artisan. So the 3 big players at the moment globally are Grom, Venki, and Amorino. Amorino being the largest with 200 stores. They're a French-based company, and you don't have to be Italian to create gelato, as Amorino have shown. But we feel that as a brand we can exceed and grow over more than 200 out achieve Amorino as well. So the potential marketplace is also there. There's not a crowded place with not too many players as well. So how are we going to get there? We're investing in our team. So we know that we've got to invest in the teams in the stores, allow that team to really engage with our customers, really create that moment of experience, and make sure every customer leaves happier. We've got a core leadership team now, which we're looking to add on to. We're looking to add on to a lot more marketing, a lot more operations and management as well. And we're looking to raise 1.6 million, which will fund Trafford, an innovation centre, to take on some of those innovative products that we've had real success with and create more of those innovative products. An innovation centre is going to be co-hosting our marketing team. So all around innovation, marketing, new products like the Billionaire, like Alvalato, the strawberry freshers, and supporting management marketing. So some of our growth with numbers, which I'll explain like this, I'll skip through this, but we are looking to become 3 million EBITDA company in 5 years. So our
Thank you so much, Assad, and thank you so much for the delicious gelato. Next, we have Andrew Glover, CEO of Air Broadband.
Good evening, everyone, and congratulations. You've made it to the final presentation. So the only thing now that stands between you and drinks is me, I'm afraid. So Air Broadband, who are we? We're a full fiber broadband company aimed at consumers. We're not actually building the networks, we're reselling the networks of everyone else that sort of builds them. Not only that, but also moving into smart home technology as well. Why? I mean, the landscape is changing rapidly. This is a massive investment area in terms of disruption to the market. We've had an incumbent for donkey's years and new entrants now. There's a lot of money going into infrastructure investment over the last 10 years, and that's causing disruption to the whole of the market. And we are one of the few suppliers who are now selling these new networks. There's a lot of other sort of connections going on, but those providers need people like us to actually sell their product. So to get their return on investment, they need work from ourselves as well to help do that. And of course, in the last couple of years, we've seen the whole work from home. Everyone suddenly realizes that they need a good, solid, reliable connection in order to be able to work as well as entertain and enjoy themselves when they're at home. Why do people choose to work with us? We're actually incredibly flexible, both in our pricing, and we work with our partners. So we understand the market very well. We've been in this industry for quite a while, and we've also automated all our systems as well. So it's a low sort of margin, but high volume business. And so it's very important that we sort of manage that development, which we've largely done. But also we're competing against some very entrenched large providers. But I probably don't need to tell most people in this room, you don't like them. They don't deliver a great service to you. And we're obviously working to sort of change that, which obviously you can do much easier when you're smaller. Obviously the challenge will be to keep that going as we sort of grow. But we're seeing a lot of people who migrate away from that. People have already got a connection, they just need a better one with a better level of service. Clearly the market is, as I say, is growing. At the moment, about a third of the country can get a full fiber connection. That's about 30, last Ofcom was about 32%, I think. That's growing, and by 2025, that should be 75 to 80% of the country covered. So our base, the people we work with, is growing enormously, and we're growing on the back of that. Not only that, but the partners we see and working with, as I say, they're sort of growing. So City Fibre, for instance, we're in a target market at about 200,000. There'll be 500,000 in a couple of years' time. They're targeting a total coverage of about 8 million, and we grow on the back of that as well as with all the other providers. The numbers are obviously sort of crazy, but the point about this is not so much that number, which is the whole sort of UK sort of broadband market. But what we're wanting to do is actually move beyond that. Broadband itself is just a sort of utility. Increasingly, it's going to be sort of given away almost. So we're moving more into the whole smart home technology. So why do you buy broadband? Well, you don't. You don't buy gas and electric. You buy the appliances and the systems that you want to use. And the same is true with this. So increasingly, whether it's security, whether it's elderly care monitoring, whether it's your heating, your electric, everything is becoming connected and you want to access from anywhere. So we're starting to build bundles and products that fit together in that whole ecosystem. And just on that sort of point, just ask yourselves, go away and do a quick check how many devices you think you've got connected at home. We reckon that most of our customers have between 20 and 30, and that's just the start. What have we achieved so far? We grew from about 300 customers to over 1,000 last year. We're growing at about 10% a month. We've partnered with most of the wholesale providers at the moment, and we should have OpenReach also connected within the next couple of months. So we've also put together the whole sort of automation journey, and we've built the sort of the brand, and we're putting together the whole sort of marketing process. So most of the building blocks are in place. We're just now growing on the back of the relationships and partners. That's just a sample of the people we sort of work with. As I say, we work with virtually the whole of the industry. Once OpenReach is on there, that will fill that out completely. And we're adding new ones all the time. So our plans, we're aiming to become, in the next 3-4 years, a top 10 US ISP in the UK. We're looking to build that customer base to 20,000, and then beyond that, 100,000. As I say, we're growing with our partners, but the key is also then adding that smart home product and bundles that will take us into increased value add and retention of customers. So once they've got a smart connection, they're less likely to want to trade on the actual broadband itself. Very quickly, who am I? I've founded about 4 companies now. They're all still going. Sold one of them. I'm also chair of the UK Trade Association, which gives me unrivaled sort of connections into the rest of the industry, and part of why we're sort of acknowledged and recognised and respected within the industry as a whole. What are we looking for? We're looking for £1 million. We've probably got about half of that already pledged or already funded from a number of sort of quite strong industry people who've got good experience and bring added value to it. And we're doing that as a sort of 2 million valuation. We reckon that £1 million should take us to about 10, 12 to 15,000 customers, at which point we should be then cash generative and cash flow positive. So $1 million should get us to that sort of investment point. So just obvious things. Most of this is a marketing thing. This is a marketing play. We just got to get out people and explain why they want to move to us, why it's a better technology. So a lot of the investment is going into marketing and development and education. But obviously we have to buy equipment to sort of send out routers, etc. to people. And we would expect that probably in a couple of years' time, we'll either be sort of right for a acquiral by another sort of provider who's missed out, wants to sort of build into this ecosystem, or actually it's to develop the returns get better and better the longer we sort of stay in this and build. So there's opportunities to continue to sort of grow. That's it. Drinks await, and delighted to talk to anybody if they want to catch me out.
Thank you so much, Andrew. Not quite ready for drinks yet. Now we have one of our keynote speakers and co-sponsors of the event, Anthony Rose, CEO and founder of Seed Legals.
All right. Hello, everyone. And so usually I talk at WeWorks, you know, the perfect startup space. So it's rather nice to see this is not so much of a startup. They've been around for a while. Business models have changed. Anyway, I'm Anthony Rose, founder and CEO at Seed Legals. Seed Legals is the #1 place in the UK for doing your funding round. So what I want to do over 10 minutes, I think I might be the only one to stick to 10 minutes, is to tell you a bit more about the life of a UK startup and how we can help every step of the way. So you're running in the park, you have an idea. So by the way, who here is a founder and who founders, investors? A couple of investors. All right, great. So I'll talk 80% to founders and 20% to investors. So as a founder, you get started, you incorporate your company, and the first thing you need to do is do some agreements to protect your IP. And our stats suggest maybe 10% of the time founders split up. They don't agree with each other, they don't agree with the plans. And so one of the first things you want, founders should sign founder agreements that have got share vesting. So in case you don't end up with the problem of them owning some of the shares and then you become uninvestable. So you can do all of these on seed legal. The next thing is your cap table. So when you incorporate your business, you're going to make 100 shares, ordinary shares between the founders. Don't go off and do the things that Zuckerberg does with special super voting shares. It's literally 100% of the time, investors force you to undo it later when they discover the founders have done something that adds more friction to their funding round. So at some point, you're going to want to give up on Excel to manage your cap table, and you can do that on seed legal. And then initially, you're going to start paying people. But if you can't pay the market salary, you're going to get some shares or share options instead. And you want to create an EMI option scheme, you can do that. So the next thing is SEIS. And I see, look up at the back because we had a discussion about EIS. So, typically in your startup, once you raise a few £1 million, you're going to go to a VC. And the VC is going to want preference shares and anti-dilution and a board seat and investor consent. They're only going to want to invest in VC once you've got revenue. But how are you going to get there? And that's where the very nice SEIS, EIS tax incentive comes in. So you want to go to target initially angel investors and promise them their tax deductions. And to do that, you probably want to get your advance assurance. So you write to HMRC, you now need to provide the name and address of investors for up to about a quarter of the amount you're raising at least. Otherwise, HMRC will come back later. And we help you do that on seed legal. So I think about 1 in 3 of all SEIS, EIS applications in the UK is now seed legals. Response time from HMRC is pretty great. So you've now done your advance assurance and you're now looking to fundraise. And the question is, how much do you want to raise and what should your valuation be? So how are you going to value your company? Well, you can go to TechCrunch, the valuation there, and then take a 0 off the end because those are insane US valuations, don't work in Europe. Or you can go to your accountant and ask your accountant to value your company. And your accountant will say, are you profitable? And you go, no. And they go, do you have revenue? You go, no. And they go, are you losing money? You go, well, yes. And they go, what funding do you have? Well, I put a bit of money in every month. And they'll go, well, not only is your value probably 0, but I think you're not a going concern. So asking your accountant is not useful because your accountant will value you based on your past, whereas investors are valuing on future potential. So you can also then make a 5-year business plan. And in your 5-year business plan, you can go, well, year 1, make nothing. Year 2, I'm going to make $1 million. Year 3, $5 million. And you make up some numbers, run some formulae to come up with a company valuation. But I think astute investors know that those are BS numbers because they're all made up. And you can put a nice formula, but the number you come up with at the end is no better than the number you start with. So how do you get to a number? Well, on seed legals, we do 1 in 6 of all UK early stage funding rounds now on seed legals. We've got huge amounts of data. And from that, we see that companies sell a median of 15% equity in a round. So let's say you're raising £200,000 and your pre-money valuation is £1 million. This means after the round, post-money is 1.2 million. The investors will own 200,000 out of 1.2, 16%. There is spot on 15%. So all you need to do, in a sense, is multiply the amount that you want to raise by 5 to get your valuation, which is brilliant. But of course, this moves the problem to how much do I want to raise. So all startups, I think, go like this, which is, we know fundraising is slow and takes a long time, and we're going to do this every 12 to 18 months. But let's say we want to raise enough to last 18 months. So how many people do I need to raise investment for? Well, I need 2 software developers, I need marketing, I need sales, I need a data person, they're the founders. And the number always seems to be, I think, like 8 people. And then you work out, well, it's 50K each, that's 400K for a year and a half. So I need to raise 600K, multiply it by 5, and that's a 3 million pre-money valuation. And now you go to investors go, 3 million, what have you built? And you go, I've got nice PowerPoint. And they go, it's a bit rich for just that PowerPoint. So I think it goes something like this. Founders put a median of £26,000 of their own money into the business up front. That's what our data shows, because no one invests just on a one. And then you may raise £50,000 or £70,000 in a friends and family round from people you know. And then you may do your classic £150,000 angel round. And then maybe £500,000 or £700,000 seed round. And then a few million Series A round once you've got some revenue. So at Seed Legal, you're there every step of the way. The idea is, in your mind, you want to do or you're ready for an exit. If you dilute by 15% time, 3 funding rounds, you create a 10% option pool, founders will still have more than 10%. So that seems to me like the game plan. If you want to raise each round at 3 to 5 times the valuation of the loss and raise 3 to 5 times the amount, that seems to be the way to go. So that was all about how to do funding round. Back in 2018, my goal was to show you how to do a funding round. And then in 2019, my goal was to show you how to not do a funding round. So what do I mean? Well, when you do a funding round, you have to go find investors. And let's say you want to figure out you need £1,000. You go find all these investors, that takes months. You have to line them up to go on the bus together, and you have to agree a valuation with them, and then you're going to give away all this equity at today's valuation for money that you don't need for a while. So when you do a funding round, you've got a few problems. One, it takes a long time to find it. 2, you don't actually need all that money today. What you really need is a bit of money today so you can hire some developers and get on to the next step. And what if you could do things differently? And that's what we call agile fundraising. So the big spike in the middle behind these where you've got your funding round. But before you do a funding round, you can raise what we call a seed fast. That's our brand name. It's an advanced subscription agreement. The investors give you money ahead of the round individually. And you says, I give you money today, and you will give me shares when you do your next funding round. And to incentivize me to come in sooner, you'll give me a 10 or 20% discount from your next funding round, so I'm paying a better price for coming in sooner. And if you don't do a funding round in some period, then you'll give me shares anyway to protect me at a valuation we agree now called the long stop valuation. And if it's SEIS or EIS, then HMRC is going to require that the long stop date is no more than 6 months from now. So our seed fasts are insanely popular. It means when you go to one of the wholesale investor events and you meet somebody and they say, can I invest 20K or 50K? Instead of saying, come back in, June, July or wherever, you can go, yes, what's your email? Great, I'll send you a seed fast later. So that's a way to get bridge funding in a sense ahead of the round. And you might think about some fraction of the amount you want to raise, you can now raise opportunistically between now and the round. But then I found companies coming to us saying the opposite problem, which is we're looking to raise 500,000 and we've got 300,000 lined up. What should we do? Should we delay the round or should we close it now and get a smaller amount? And smaller amount, well, we'd like the whole amount, but delaying it, we're going to start losing investors if we keep waiting. So I thought, well, there has to be a better way. And when you do a funding round on Seed Legals, there's now one click provision to turn it into a rolling close round. So you can close your round with a smaller amount, which could include the converting seed fast that you raised earlier. And then you can say, I can top up any amount between now and Christmas, or you set the period. And you can do that without further approval needed. So you can then raise more with what we call instant investment, which is just a deed of adherence. An investor subscribes for more shares, joins your last round essentially, and the game plan is, in order to have no further approvals, it's the same or higher priced shares your last round. But putting the two together, fundraising has turned from this like 12 to 18 months, go big or go home, stressful activity into something that's more agile and opportunistic. And there's about as much raised now outside of the funding round as in a funding round. So head over to Illegals. We're now, by the way, about 160 people based in Auburn. So I ran here, and we're here to help on every possible funding round. And we've got a little stand back there, and I'm around for later. So thank you very much.
Fantastic. Thank you, Anthony. So now to finish off the day, we have an expert-led panel session on the state of renewable energy. So here joining us today, we have Leo Groen, Director at Spartan Group, Francesco Perticari, Managing Partner at Silicon Roundabout Ventures, Nuno Tome, Energy and Infrastructure Advisor at Notice Energy. And we also have Wei Meng joining us again online from Leone Capital.
Excellent. Good afternoon, everyone. It's really a pleasure to be here with you today and have the opportunity to speak with our distinguished panelists and Wei Meng online. Good to see you again to talk about what I think is one of the most critical areas of transition in society today and the world more holistically. And I think until recently, prior to the COVID pandemic, I think consistently renewable resources, energy, and security around it had been the single most cited concern for future generations and the way in which the World Economic Forum comes together to identify risks in society. So that's certainly been on the back burner the past 2 years where we've seen things happening in the health sector come and go. And I think this is really a good opportunity as restrictions start to clamp down and people start to continue with their lives, at least here in Europe and North America, to really revisit what it is to be in the renewable energy transition, what that means for society, and everything that comes with, I think, the investment opportunities around financing that energy transition, which has been in motion over the last 30 years. So just before I go a more detailed conversation here with each of the panelists, I'd love to give them the opportunity to actually introduce themselves, share a few words on their background, and then we can go into some of the more detailed discussion points that we have. So, it would be great if you could kick us off with a brief introduction on yourself.
Yeah, sure. Hi. I understand that we are sort of the last session before we went to drinks, so we'll try to make it very, very interesting and appealing. Renewable energy, I've been working on infrastructure and specifically renewable energy for many, many years now, 15 years or something like that. My first solar farm was in Spain, and it was a giant of 5 megawatts. At least we thought it was quite big. These days, kind of a testimony for what the industry done and progressed in 10, 15 years. A 5 megawatts solar farm is something that it doesn't often doesn't bear the reference in your portfolio. But 10, 15 years ago, it was a mammoth of an investment and a massive piece of infrastructure. I've done early stage development of solar assets and wind assets. So I went up mountains in Scotland trying to see how the wind turbines will look in here. It's not fun. I've been involved in construction and refinancing of a number of assets, and what I see of the industry is going forward. We haven't seen anything yet. It will multiply by a factor of many zeros in the years to come.
Hi everyone, I'm Francesco Perticarari and I'm actually a computer scientist. I guess I'm on this panel because I started to invest in deep tech as an angel a couple of years ago, and now I'm launching a deep tech fund. And I guess what Steve and I were talking to, Steven from Wholesale Investor, with me joining this panel, is that it's all nice and great to talk about a big level with private equity and big investments in conferences that, yes, we need new energies and new energy storage systems and new advancement in climate, not just in renewables per se, but you've got to back deep tech companies that build new types of storages, new types of hardwares, and new types of technologies, because otherwise you're going to have a bunch of B2B SaaS doing reporting at the top level, and then still you don't have new types of fusion reactors, you don't have new types of hardware that speeds up machine learning algorithms, so that it costs actual less power to be computed, and so forth. So in terms of what I do now, focused on launching the fund and investing as myself into deep tech companies.
Wei Ming, over to you.
Yeah, so thanks for having me back. We have been, as a family office fund, we have been investing into infrastructure for almost 2 decades. We owned basically telecoms infrastructure. We've got energy sector. The past 10 years, we've moved into ESG and we've owned some renewables. Recently, been keeping me very busy is very much about the hydrogen sector. So we've also got into the hydrogen asset as well. Thank you.
Excellent. Thanks very much, everyone, and look forward to this discussion then. So before we go into the details around specific, let's say, investment opportunities and where people are spending their time and focus, I think there's an elephant in the room that we should probably address head on, which is the macro climate and the macro environment around what is happening at the moment when it comes to security of supply, the ramifications of some of the world's dependency on dedicated specific few people and few sources of that energy. So, I mean, just a general open macro discussion. What are the ramifications of this developments in the world on energy security supply, and what does that kind of bring as an opportunity set going forward?
I'm happy to have a go at that one. I did some research. I was doing some research on that over the weekend, and then I opened The Economist around Sunday evening. And half of it is dedicated to this. It was quite frustrating, actually, so to some extent. But I think the key point is that what we see now, with sort of horrible events across Europe and all the issues that affected the energy market a little bit before the summer last year, they're not going away with the move to renewable energy. If anything, you will have slightly different actors. But the issues are relatively the same. We need a huge amount of materials, need a huge amount of mineral and equipment and the like to do what we need to do to replace the energy generation from carbon-focused type of energy sources to renewable energy. So the issues are the same. The actors are slightly the same. I think the key message, hopefully, is that we learned what we've seen over the last few years, and especially over the last, well, I guess, a month and a little bit, and find a way across different actors in the world to regulate in a proper way the way this is going to work. And this is also relevant for the there are a number of countries where, sort of blessed or cursed with the resources that are needed for what we need to do in renewable energy. The way this is going to develop, it needs to be developed in such a way that they're protected from the sort of curse that affects them. But in order, I think the key message is it doesn't change to what we do with renewable energy, but we need to learn the lesson that we I guess learned over the last few years.
And does that mean, I mean, are you saying that renewables could be the end to the, let's say, supply dependency around oil and gas? I mean, is that a realistic path forward that you see countries should be, or let's say, not just countries, but the world should be preparing for?
Well, maybe I should take it. I think in the meanwhile, for the next 5 to 10 years, is very difficult. But of course, the current situation with the Russian energy cutoff, I think we are seeing that there's a lot of disruption taking off. In fact, in Europe, a lot of governments are struggling to build alternatives. And this is one of the issues right now here in Europe, that the renewables plants are pretty much it's not able to cater. I think we've seen over the past 10 years in the renewables, especially in the solar and the wind power. But I think the whole world, not just in Europe, faces 3 most important things, in my opinion. First of all, we really need to go into green decarbonization. I think second thing is that we really need to also tackle circular economy, and why it's so important to be associated to decarbonization and green. It's all because I think there are too many issues that we are facing as part of the climate change. And one thing that we have learned, perhaps with the advanced science and technology engineering expertise, we have found solution that would be able to treat waste I think be it whether it's municipal waste, industrial waste, agriculture waste, I think it's time for us to really combine how are we going to treat waste and turn it into energy sources. And that leads me to the third part, I think the alternative in energy. The green energy in this case is really hydrogen. And this is an area where my team and myself, we are constantly looking to invest with some co-investors to really build those new technology is going to make a difference.
Absolutely. No, I think that's a lot of good context there. We touched on several points. So from decarbonization to what we can do on the ground, operationalizing some of the resources that we do have available in terms of waste and recycling that. So I guess, one of the key enablers of that would be a term that you also introduced, Francesco, deep tech, some of the ways in which we're touching on this. So, I mean, what does deep tech actually mean in the context of energy, renewables, and these types of resources?
Right. So I guess in general, it doesn't mean anything. It's just one of those words like AI that don't really mean anything.
People like to hear.
Yeah, like, I studied machine learning. I didn't study AI, but, fair enough. I worked and I applied algorithms, but then when you go to conferences, you like to say like, yeah, I developed an AI system. What does it actually mean? So deep tech is the same, it means different things to different people, but ultimately it's a short-term convenience for basically technologies that require advanced innovation at science level, whether it's computer science or actual, physical material science. People include also bio and, and pharma, and I think it's correct. I personally don't invest in those because it's a different beast. It's its own ecosystem. I think it's fairly separate from the hardware and software. But you're right. I think it's kind of like a massive opportunity for both startups and investor specialists in this case, because now all of a sudden governments wake up, and corporates wake up and it's like, oh, we have to be net zero by a certain date. And then how do you get there? Nobody has really figured it out. So I think that's like one of those shifts that empower startups a little bit, like, the internet or whatever. Just there is something happening on a tectonic level, like global level, government level, corporate level. And then there aren't just enough solutions at corporate existing level to tackle that. So that means you need new startups to just come out with a better storage, new startups that come out with better hardware sensors, monitoring. I mean, one investment I've made last year is in IoT, in the PropTech space to effectively help portfolio managers at actual building level to bring the cost down, but also and now starting to talk to cities and actual councils to bring down consumption, to monitor, but also bring down and have actionable output, not only input, like, oh, I should bring down my consumption of electricity, not actually bring it down and decrease costs using a mixture of hardware and software. So things like this that maybe would have had a harder time to sell to institutions, now I might have an easier time to sell because governments and corporates just don't and cannot innovate fast enough, don't have the solutions because they don't exist. And so suddenly markets open up. So I think it's a great time for opportunities for startups in the deep tech space.
I'll just continue on that actually, because that is sort of the key point. Yes, we're not going to replace the energy needs that currently supplied with oil and gas. We're not going to replace it tomorrow with the solar panels. I'd love that, but it's not going to happen. But the other thing is, and we sort of touched upon on the waste industry. There's a mantra of sort of reduce, reuse, and recycle kind of thing. And it's starting from you need to reduce. If you can't, reuse. And if you can't do all of these, well, by all means, you can recycle. That's sort of okay. But that's usually not necessarily a net positive. It's a less bad solution. And in the energy world, is sort of a parallel to that to some extent. Is we started with the production of energy with all the wind and all that stuff. That's really good, and there's a massive opportunity in there. There's still immense needs and opportunity for investors to do many things in there. But a key focus that the industry needs, the society actually at all needs to focus is reduce, and that is reduced by social behavior changing and technology enabling us to use less energy. There's no other choice. We need to use less energy and find ways to do that, social, technical, any other.
So then, Wei-Meng, I know you've been deploying capital into deep tech as an investment thematic for many years now. I mean, how do you look at the opportunity set within specifically this area of energy and renewables?
Well, massively. And we are deploying capital to enable capital access. Basically, there's a lot of technology out there, because in the infrastructure investment in this category, it is capital intensive. Second is a highly regulated environment. And last but not least, you need institution players to come together to co-invest. So I think for us, we pretty much like greenfield, deep tech stuff. We always pave the way how we could be the catalyst in terms of creating this enablement for green infrastructure. And therefore, I think it's important for venture capital to be more active in this field, so that the follow-on in the institutional front will be having more support to continue the funding into this category of infrastructure. And I think second is I would also hopefully I can see more government coming into the picture to help into the greenfield projects. A lot of the greenfield projects today are highly participated by the VCs and family offices. So it will be good to get the government to be more active in the space.
Absolutely. I think it's one of those dynamics that really requires, stakeholder engagement across both private and public sector in order to, I think, achieve the desired outcome that we have. But then if we go one level deeper and really focus about, where are people spending their time from the investment landscape? I mean, there's a lot of hype around clean tech the last years, and some people even saying that clean tech is the new fintech in 2022. So, I mean, when you guys are approaching this industry and looking at it, what kind of things are you looking at? How are you sourcing investment opportunities and going beyond just, monitoring sustainability solutions versus actually implementing solutions which are fundamentally changing the composition and the way people are consuming energy and using recycling solutions, for example?
How we spend our time in assessing, well, I mean, like I said, my focus.
How do you find the companies that are worth backing to do this?
I mean, I invest at pre-seed seed, and I haven't said that, so maybe you wouldn't know. So I run a tech community, Silicon Roundabout. That's how I got into venture. So companies normally come along, or people get referred into the meetup for us to connect, and we've been helping them with visibility since before doing the deep tech. So that's myself, and I think that's an important distinction, because whilst government and corporate engagement and big funding is needed, I also worry that hides the problem that companies still need to get there. And so it's all great and nice that the EIF is launching this mega European fund about growth stage stuff, still managed by bankers. So question mark on the utility of it. And the British Business Bank, of course, follows suit. But then there is still that angel level. And I think the problem is that because most of people, especially for example in UK, make money in fintech and it's all this recycling, they tend to still be attached to the idea of I'll invest in a B2B SaaS, user growth traction, a new payment solution type of thing. And I think that to your question, in terms of finding the companies are right there. You just need to be available to invest in companies that might be pre-revenue. You need to accept that if it's deep tech, and you need to accept that you're going to invest in the technology, and you need to have the technical team to assess that. So, like I said, either you're an engineer yourself, or if you're a larger fund, you need to hire those sorts of people. You can't keep doing the same things you were doing before and still expect the same results if you want to enter this space.
Yeah, absolutely. Actually, the other thing is very important, in my opinion, is the off-taker. I think today a lot of energy companies, they are trying to also go green. And this is the, once in the lifetime opportunities to them. It's a golden opportunities for these companies to really get more access to, the green tech. A lot of the projects we see, typically those companies, they've got a lot of incubation program, but in terms of executing, it's still very conservative. So, one alternative we found is to really get the off-taker to work with the consumer. And the end users are very important. I think if they can come together as a value chain, working together in the innovation program really try to pilot some of those projects, I think that would be wonderful, because a lot of the time we as an investor try to do our due diligence is always the value chain itself, at the off-taker and the end user level is still very uncertain, and this is the highest risk is posed.
From my side, sort of more again more infrastructure kind of focused, but in general, I guess looking at investment opportunities is trying to identify what I guess I like to call them sort of self-reinforcing mechanisms of some sort. And one of the things that I find an absolutely fabulous investment opportunity and a massive tool to address the issues that we have with climate change and the like is domestic supply. The domestic or residential sector is one of the biggest contributors of CO2 emissions across the world. And we now have sort of the self-reinforcing mechanisms around, which is technology, prices, cost of installation of technical solutions. All of this is sort of aligning themselves in a number of ways to create a massive opportunity to replace something that is called the utility sector, which is a dinosaur. I mean, it is something that was created or developed over the last 50 or 100 years. And if you look at the size of the challenge to replace this industry is massive, but it's not really needed anymore. It was based on the concept of you generate on a coal-fired central station somewhere far away, and then there's a big power cables that transport energy to your home, and then I guess you consume it. That doesn't need to exist anymore. And then all the costs of the energy, the cost of the equipment, well, is creating such a set of self-reinforcing mechanisms that allows this to be a massive investment opportunity that will have not only returns for investors but also returns for or positive returns for the fight against climate change. And again, going back to the theme of reduce the efficiency on energy in residential portfolio or residential assets is a massive opportunity to reduce. We always focus on it is much cool to look at a solar asset or a wind turbine or all that generating electricity, but the other side of the equation is reducing consumption is a massive investment opportunity. How to monetize that? It is challenging, but it's a massive investment opportunity in there.
It's a very good point, and that's actually what I wanted to ask you next was about. I mean, in terms of the developments and progress we're making in this space, I mean, how much of the opportunities that we see is really business model innovation, so going after and changing, let's say, the way in which stakeholder value is attributed across the value chain versus actual technological advancements in creating more efficient energy sources and supply. And I think the reason why that's such a topical point within the renewables sector is because a lot of the investment and capital that goes into sustainable energy financing and bringing us on this transition is hardware linked, right? Or physical product infrastructure assets, which from the technology sector is a bit of an outlier, right? Because typically people like to invest in shiny new SaaS and enterprise software things that are understandable, recurring revenues, fixed margins. And here we're talking about things which are potentially very different from that, but still equally important in terms of how we go to market. So how do you, differentiate between those two segments of the opportunity landscape, and where do you spend your time investing?
I guess it depends on the audience as well. If you're talking with an infrastructure investor or a bank or something like that, this is established technology, and there's some element of or established tech piece of infrastructure, and we're just overlaying some very, very well known technology sort of around it. But technology to do all this, it already exists. I think it is business model and integration of pieces of technology to enable again sort of the jargon of the prosumer model with production and consumer. Sort of difficult question to answer to some extent, but I think you frame the opportunity in a way that it is use of established technologies. It is an infrastructure asset to a large extent, and then you bring in stuff that is not necessarily cutting edge science, but it is. I think that the risk in there is the integrating of some new technologies into an old asset class to some extent, and how do you incentivize a little bit how to do a little bit of that change in terms of user consumer profile as well.
Well, if there is a difference in business model, I would say is that at the end of the day, the consumer, a lot of the industry consumer, as an end user, they would be also the stakeholders to also co-own. So a lot of these projects today, of course, the banks today are starting to heavily get into this space for the past 4 to 5 years. I think project financing is no longer an issue. Pretty much is the tech companies, and here we are talking about still at the venture level. New tech pretty much is struggling because they still need, they don't have capital, so they have got very strong technological advantages over conventional engineering methods, but they can't access to capital due to the risk level that people are not able to evaluate them. So I think that at the end of the day, the venture capital specialists needs to take an active approach. So I hope we can see more VCs coming into this space, looking at how to bridge the gap. This is very important. How I think we can also see now institutional investors, the pension funds, are also willing to get into the venture stages. So at the end of the day, the specialization is able to construct the investment thesis. The users, the end users or the consumers are willing to get into the project. That will be very important as an ecosystem. So that would be the new business model that I think that could be sustainable.
Absolutely. And then just conscious of the fact that we're the last thing separating us from Steve and then drinks, I would just say, it is an area that's full of innovation and opportunity, albeit different maybe from other segments and sectors of technology. Francesco, I mean, you're running an early stage, seed fund and pre-seed fund. I mean, what is the golden use case? What is the most exciting things that you're focusing on at the moment and you're spending your time on in terms of new companies coming through in this space?
Well, I mean, in general, right now, on the software side, there are quite a few interesting things I'm seeing in the cybersecurity space and edge computing and new type of computation, neuromorphic, more relevant to this, and hardware as well. I'm seeing finally some semiconductors companies coming up. In terms of relevant to the renewable here in this panel, like I said before, the decarbonization efforts at consumer level, and consumer could be corporates in the sense of actual hardware and or software that decreases consumption, not just to produce, and new means of productions, and new means of storage. So I would say new types of productions actually coming out with new material science and new types of storages are at the moment extremely exciting. And in a secondary way, ways to reduce energy is either direct, like when we talk about building energy, for example, or indirect, like I mentioned before, at semiconductor level. AI, it's an elephant in the room that consumes so much power, but there are ways to actually invent, like basically model new systems of hardware of semiconductors that are specific for AI and that consumes less and produce actually better results. So these, in this context of renewables, there are sort of three main areas I love to look at, and I'm seeing great companies coming up from UK and Europe.
I'll do very quickly, actually. But one thing that we can, there's a massive amount of assets, renewable energy generation assets already producing. And one area when we can enable sort of new business models and new technology is actually the early deployment of new technology to the existing assets. Prove that this improves efficiency and improves generation, improves your ability to control your assets, and from then on, sort of justify or prove the merits of this new technology, and that opened up a huge amount of opportunity. I mean, renewable energy, a solar farm or wind farm is a relatively straightforward power station to operate, but it's still a power station that needs to be operated in a careful and kind of it requires some love every now and then. So if you're able to deploy some of these new technologies, and you can prove to your external infrastructure long-term cash flow focused investors, look, this increased your production, your cash flow by 3, 4, 5%, and you haven't spent really that much. That opens up a huge amount of opportunity for new deployments of generation assets.
Well, for me, it's very simple. We need funding. So I think the whole world needs to understand that with climate change and with the current situation, there will be a lot of demand, and therefore demand also that equals to funding. So if more people were to come in to really fund projects, I think it will be faster, and therefore we can accelerate the pace of decarbonization and creating alternative energy. Thank you.
All right, guys, and thank you very much. It's actually Nuno's birthday today, so thank you very much for also taking the time.
Thank you.
We'll look forward to seeing you guys outside. Thanks, everyone.
So just for you, I just want to add one last comment. I just want to say a big thank you to Weemang as well, because I know how sick he is right now to be doing this panel session. So a big thank you to mate, and also really enjoyed that. Just the final comment I'll make is that we've done a lot of work. For whatever reason, Australia has a lot of good renewable energy tech companies, and I had explained to me really succinctly about how this is going to work. You can actually see this unfolding at the moment. The first stage has been solar and obviously wind as far as the energy sources. The second layer has been obviously what you mentioned as far as battery and the storage of energy. The third layer related to microgrids, and then the fourth layer related to personal, basically to everyone's individual homes. The coolest thing about this area is the technologies that are coming out relate to each of those different areas. And the other thing that really excites me is if you think about, you mentioned about how outdated the current grid structure is. If you think about that, not only is there a layer of opportunity for the technology, but all the infrastructure that sits around that. And you're seeing in Australia at the moment, for example, people are buying up car washes to convert them into electric vehicle charging stations. And then you think about how that transfers across the value chain. Then you think about companies like Tesla and what they can do when it comes to sort of autonomous driving, and then how that then adds another layer of economic opportunity for everyone. To me, I picked 3 areas which I think are the most exciting for us to focus on going forward. And renewable energy technology, I just cannot see a bigger space in the next sort of 5 to 10 years on all at the sort of base layer technology, but just also an entire macro opportunity as well. So thank you very much, you guys. Really appreciate your involvement in the session. And again, thank you to Weemang, who I know how sick he is for being involved in today.
Thank you all.
All right. So that obviously concludes the panel session today. So the next session, I'm just going to do a quick introduction for it now. As part of the Emergence interview with Jason Calcanis, who's one of the top names on the planet. And for me, this was one of the best interviews that I have done. I learned so much from this session. In fact, we're only able to show half an hour of it today. There's actually a full hour video which is going to be released after this conference. But effectively, when you think about this whole angel investing space, what makes it exciting is this, how much money has been made over the last 5 years. Nothing is what's made over the next 5 years. So when you listen to this interview, I really do a deep dive on what he's looking at, the way he sees things, and then also what he sees going forward. There was no issue in that pretty much answered everything. At least the first element be for half an hour, we end up going for an hour. So that to me, I said, shows you the importance of this as an area going forward. And I said, I hope you guys all enjoyed the interview. After that, obviously, it's going to be drinks and networking and so forth, which is the fun part of today. And also, I just want to say a big thank you to Anthony for being involved. Because as I mentioned to you, whether you've got investing companies that are in this space, the majority of them actually use these vehicles. And as anyone that I've spoken to today, I said, I don't know how you launch a business efficiently in the UK without using these vehicles as part of your process. I wish they had a company like them in Australia, because it's amazing what they provide from the software perspective. If you spend any time with them, you just realize his brain is operating at another level about how he thinks to make things more efficient for founders starting up. And that's the kind of thing that we need as founders building our businesses. So thank you to Anthony. On that note, enjoy the Jason Calcanis interview. I'll see you all during the next session.
Hi, welcome to our feature keynote interview for Emergence 2022. We're joined by the most prominent angel that I know on the planet, Mr. Jason Calcanis, who's the founder of Launch, host of This Week in Startups, and also host of the All In podcast, and also the Syndicate. Welcome, Jason.
It's a pleasure to be back.
I'm very happy to have you back. And I was just thinking about I remember our chat from last time, and we're sort of making predictions around COVID and how that was going to play out. And geez, what a surprise that ended up being for the year.
Pretty crazy. It certainly has changed a lot about how we do business in Silicon Valley, and that's something we can get into.
Definitely. Now, obviously, there has been a wild start to 2022. It's fairly obvious. And I thought before we get into the fun stuff, sort of talking about what you're looking at and so forth, I'd just love to understand from your perspective as an investor, like what are you identifying as the risk factors when you're thinking about your own investments, your own portfolio, and how you're sort of processing what's happening at a macro and also, just in your own country?
Yeah. So there's always going to be macro events going on. The world is very dynamic, and we all know, every hotspot in the world. Hopefully we don't have something that's a global pandemic again, but obviously we have the situation in the Ukraine, situation with inflation, and then previously we had our real estate bubble here. There's always something going on. And what I found I'm in my second decade now of investing in startups, and my third decade as a business executive, is, the great companies are built through down markets, up markets. In a down market, they gain market share. They have to be a little frugal, more focused maybe, but they're gaining market share. In a hot market, they're dealing with a lot of noise and competition for employees, for marketing spend, and for customers. So there's the silver lining, and there's pluses and minuses to each type of environment. The thing that does not change is great founders starting companies that have awesome teams, a great product, and that delight customers. And, I'm over 300 investments now, and you can really start to get some philosophy or signaling after you do this for a decade. And the signaling I've learned is, great teams make great products that delight customers, that become addicted to those products, which then generates revenue, which allows you to expand or upgrade the team and allows you to build a better product. If you can stay focused on that flywheel, everything works out just fine. And the problem is sometimes in a hot market like we're in, or in a crash like we're also in, it's like both things in the same year. Yeah. You can see people get distracted, wildly distracted. And sometimes there becomes a disconnect between the value of a company and maybe their execution level, what they've achieved. And so when we saw that happening over the last 3 years, we realized, wow, some of these valuations, $50 million before they have a product, or $25 million, and it's, they have 3 employees and a prototype. Sometimes that would make sense if it's a serial entrepreneur who's got the greatest prototype in the world and it's groundbreaking and there's a competition. Sure, that can happen. But when we start to see that become the standard, we looked at it and said, maybe we should take all of the companies in our portfolio and help them raise money since the market is so hot. And so we slowed down on new investments. Actually, we probably did the same. We didn't increase the number of investments, is the way I would say it, because we were, really increasing the number of new investments we do every year. And we just started a little SWAT team inside of our company. And we put one of our managing directors on and said, talk to every founder, ask them what their funding plans are, and let's start doing some analysis of that. And we would have 50 to 60 of the 300 plus companies we had invested in raising money at any point in time, and probably 200 of them were active. So 25, 30% of them raising money actively at a time. And every time 5 of them would finish their financing, 10 more would be on top. So we got to a point where I think the peak was like 62 people were raising money. And so we just started really dialing that in and helping them raise money to take advantage of a very hot market where funding was a little bit easier, valuations were high. Maybe they can put a little cash in the tank and then deploy it if the market ever came apart. Now the market has come apart. And so here we are. We're looking at opportunities that maybe the valuations are coming back down to normal, people who were able to close in that vibrant
It'd be
market.
great to give a context of what you see as the high valuation versus normal now, because I think that provides a real, because as you know, with founders, sometimes, they feel that they go through a bullish period like that, like what we sort of experienced last year. And as you know, sometimes they're not changing their valuation to reflect what's happening in the market. So some sort of perspective about how that's changed would be great.
Sure. And just as a preamble here, founders should go for the highest valuation they can get and raise as much money as they think they need to that they can successfully deploy. So don't mind anybody getting a high valuation. The market is the market. If the market is running a little hot, people can pick and choose what investments they want to make. So I don't blame anybody for doing that. There are things that can happen that can get you caught in a little bit of a valuation trap. So we'll talk about that in a moment. But to your original question, when I invested in Uber, Thumbtack, Calm, Density, all these great companies, they were $4 or $5 million companies in their seed round. Now seed rounds tend to be $10 to $20 million. I would say most often 8 to 12. And there was a moment in time, a lot of the companies coming out of Y Combinator were kind of trying to one-up each other and beat each other's valuations and trying to get to 15, 20, 25, $30 million and raise $5 million in a seed round. 15 years ago, an A round was $3 to $5 million. So now we have seed rounds, no governance, nobody's taking a board seat, no lead, party round. And that's a bit of a recipe for a disaster, because then when the market corrects, in order to fill into let's just pick a number, $30 million valuation, in a corrected market like we're seeing now, you would probably get 10 times your top line, maybe 20 or 30 times your bottom line, your profit. So a $30 million company's probably got to be making $3 million in revenue, $250,000 a month, $250,000 a month. That's not impossible to do. It's quite possible, but you just may have raised that at a $30 million valuation before you had even a product in market. And that $5 million got you to maybe the first 2 quarters of having the product in market, 18 months or something on your plan. And now you're in that valuation trap. Now people might value the business. If let's say you just got to 1 million in revenue, they might value the business at 15 million, 15 times, very generous top line revenue. And so you raise that 30. Now you can clear a market at 15 or 20. What happens? Well, you have a down round, and sometimes that's fine. The founder can spin it. The existing investors maybe participate, maybe they don't, but it can cause a lot of gymnastics in terms of legal, in terms of signaling to the market. And sometimes it can be looked at as a debt spiral. You raised at 30, you can only raise at 15 now. What a failure. And in fact, raising at 15 might have been a huge success 5 years ago. So there are these kind of things that can happen, and especially in the late stage where you had new private equity, hedge fund folks coming into the market and saying, we'll pay 50 times, 75 times next year's revenue. And so maybe a company with 10 million in revenue raised at 500 million, at 50 times, or they were, 50, they were going to do 10 million next year and they did 4 this year. So now they're getting 100 times last year's revenue or more, 125 times and 50 times next year's revenue. That can be a real trap. And if they had a burn rate where they're burning, let's say they raised that $50 million and they're burning 5 million a month and they've got 10 months of runway, shifting gears and laying people off and then trying to fill into that valuation will take a lot of consideration. And then everybody's got to kind of wait for the company to live up to that $500 million valuation. Again, it's not a horrible situation to be in. Some people might even say it's a high-class problem, but it can cause challenges. I'm not saying anybody should, ask for a lower valuation. Of course not. Yeah. But it is just something that investors should be aware of, board members should be aware of, and founders should be aware of. Right now, those high, crazy valuations we saw during COVID, they're gone. The companies that got those crazy valuations have returned back down to earth, whether it was DoorDash or Peloton, even Snowflake, the mighty Snowflake, which is a juggernaut and growing really fast, lost 10, 15% on the day we taped this. So you're starting to see like all of this compression in valuations in the public market that makes its way to the private market. And it made its way pretty quickly.
Yeah, we experienced that from our side, especially from what we've sort of observed in Australia, that effectively you see that crossover where a lot of sort of high net worth and family office investors do invest in the small and mid cap sort of tech companies. And so when they're watching the valuations decimate, 60 to 80% across a few month period, obviously that does impact what then goes into the venture side.
Yeah, exactly.
Now, from your, if we're, as an investor, if we're to spend a day in the life of you, as far as what you, from conversations you're having with investors, from conversations you're having with founders, from session interviews that you're doing, what are the observations that you're making outside of that valuation aspect? What are some of the observations you're making from trends you're starting to see, in areas that are starting to come up that you didn't see sort of 12 months ago, etc.?
Well, the crypto hype cycle has been pretty violent, and you had a lot of scam artists and grifts in there, and I would say people who maybe can't execute. And we're starting to see on the margins people actually finish their products or start to put some products in the market. And that's what I've been waiting for, is a crypto project that had customers that were paying for a service. And we're actually starting to see the beginnings of that. And I'm not talking about a customer as in a speculator buying the coins, because that's really an investor or a gambler, one of those two, and not people buying NFTs because they have an affinity for them or they're speculating with both, but actually making a reasonable business that is a tool or a product that people will pay for and get value from. And so that's the interesting piece I'm starting to see. And, we're just starting to dabble a little bit in crypto. Now, the valuations are absolutely illogical that a company or a project, you see projects become worth $10 billion, $50 billion, and they have 6, 7, 8 developers, and they've got a ton of coins, and people are buying the coins who have nothing to do with the project to speculate on it. They put 100 million or 250 million into some foundation, and the equity investors don't have equity in the company. Maybe they have some coins. The coins don't have any protective provisions, downside protections, and maybe one group of people could sell the coins before the other, and then who becomes the bag holder? I mean, it's pretty gnarly, but I do think that there will be some interesting companies to come out of the crypto winter, and all these dead companies. It's going to, if we do in angel investing is like 1 out of 10 companies or 2 out of 10 work, I think it's going to be 1 out of 100 in crypto projects. So your odds are going to be against you, and the entry price and the valuations are going to be 10x. So if you just think about that for a second, you get 10 times the failure rate. So only 1 out of 100 become an exit. And then it's at 10 times the valuation. Now we're looking at, 1,000 to 1 odds, basically, or, the value, the number of swings you get to take at bat is lower because you're paying 10 times as much to participate in these deals. So that's why we've, largely stayed away from them, because we can make 10 investments in a fintech marketplace, consumer subscription, or a SaaS company, or a hardware as a service company with greater odds. So it's not to be a Luddite, but if the prices are too expensive, there's no protective provisions, and there's too many companies and not enough executors, I think that space is really suspect. But I am starting to see some interesting things. So I kind of feel like year 11 of crypto is year 1.
I was thinking about this before the interview, right? And I was thinking about your career. You obviously, for me, my perspective from when I observe you, you built your career off the back of Web 2.0, from the investment side, media profile, and so forth. So for you, I imagine part of this is, it's like seeing it all over again, but just, and obviously for me, the obviously identification, we didn't even talk about this last time, is Web 3.0 as an example being identified. So what, apart from the product aspect, and we're also seeing the same as well, actual real products. And for us, we even see companies just building opportunities on blockchain without tokens attached to it, right? They're just looking to basically make different marketplaces more efficient. What are the key signs that what are the things observations that you saw from Web 2.0 that you're now seeing in Web 3.0? And you've identified the risk aspect. What are some of the opportunity aspects that could be, that investors could be on the lookout for?
Web 2 had a lot of talented builders leave established companies to really build, prototypes, minimum viable products. We really didn't have that name back then, MVP. But people were hacking and building small projects that then became very big, whether it was Dig or Reddit or Flickr or Delicious or Weblogs Inc., WordPress. There were a lot of people trying, and Twitter, just trying to hack something together, put it out in the world, and see if it caught any kind of viral uptick, and if people got value from it, if they became addicted to it, gamification was big, et cetera. And you were able to deploy these projects with very small amounts of money or no money. If you just had a designer and a developer, you could iterate and put something into the world. These crypto projects tend to raise tons of money, and the technology is generally, it feels like technology in search of a problem, and that's problematic, I think. That is the challenge. When in the Web 2.0 era, people were really thinking about consumers and how to delight them and to get them addicted to a product, to get them in a viral loop, to give them value so they would keep coming back. Instagram was the easiest way to share a photo, and you didn't have to use Photoshop to make the photo look better. People forget, but back then, if you wanted to get a photo and it wasn't that good, if you wanted to make it look professional, you had to go get a digital SLR camera, upload the photo, and then maybe put it into Photoshop or Lightroom or whatever, and work on it for 20 minutes. And Instagram was like, just take a photo with your crummy iPhone or your Nokia camera and pick a filter. We'll do basically with these 6 or 7 filters what you were going to do anyway in Photoshop. And that just made it seamless, right? And that was incredible value. Now you compare that to a crypto project. They're like, we're going to use blockchain to make something that's not distributed. And you're like, okay, what is it? Oh, it's a not distributed version of Instagram. And you go, well, if there's no central person in charge, well, what happens when somebody posts something that is offensive, illegal, hate speech, they, put something terrible up there, stolen photos, copyright, otherwise. And you're like, well, the decentralization actually hurts you there. And then you're like, well, we're going to put it on an open blockchain and it's immutable. It's like, okay, well, you just put something on the blockchain that is gnarly, that nobody wants to see. Okay, that's terrifying, actually. It's like a nightmare scenario. It's like a Black Mirror episode, if you know the Netflix anthology series. Yeah. It's really dystopian. So what I found was there was a disconnect between the deployment and the use of the technology and the understanding of the user with this Web3 cohort. And I think there was so much focus on raising capital, finding bag holders, selling the tokens, selling the NFTs, that they put 90% of the effort into fundraising internationally, getting people to send crypto to a wallet, breaking all kinds of securities law, and then not on the user journey, not on the user experience, not on the user value, not on the joy or the pain, the joy you would add to a user's life or the pain and suffering you would remove from it, which is really what Web 2 was about. If we take out the friction and make life better. And so that's the problem with that whole category. And so, the idea of trading NFTs, what's the value here exactly? Okay, it's expensive. It's more expensive than doing it another way. And it's immutable. Who cares? Like, none of this stuff really actually matters in a lot of cases. And it turns out there is central, points of failure, even though people say there aren't. But then again, we saw with NFT,